stream here.
Okay, good morning, everybody. I'm Steve Kaplan, the Neubauer Family Professor at Chicago Booth and the Kesenick Family Director of the Polsky Center. And thank you so much for joining us for the 25th Annual Edward L. Kaplan New Venture Challenge. I want to give a warm welcome to everyone, the finalist teams, our distinguished judges, our generous sponsors, our coaches, our students, alumni, and live stream guests around the world. We're celebrating our students and the culmination of months, if not years, of hard work that has been even more challenging in this pandemic world. We are really excited to feature 12 finalist teams today. They represent a really wide and diverse range of industries and ideas, and it's going to be very exciting. Before we begin, I want to say a few words about the program you're about to see. So this is the 25th year, so it's a special year of the New Venture Challenge. And over those 25 years, we've been very successful. Over 300 businesses have been launched that are still operating today. They've raised over $1 billion from investors that include Accel, Andreessen Horowitz, Benchmark, NEA, and Sequoia. Those investments have helped create national brands like GrubHub, Braintree Venmo, Simple Mills, and now Tovala and Foxtrot. And to date, those teams have created more than $8.5 billion in exit value, and that's conservative, and that value is going to grow. That success has led to the recognition of the NVC as one of the country's top 2 university accelerators. And it's also led us to take the NVC model to 4 other tracks. We have a global NVC for executive MBA students, a college NVC for college students, an alumni NVC for alums, and a social NVC for social enterprises. And all of them are doing increasingly well. So now back to what we're doing today, the traditional New Venture Challenge. I want to tell you a little bit about the process, how we got here. In early February, we received 62 applications. Based on feedback from our judges, we chose 31 teams to advance to the second round. Those 31 teams enrolled in a course, and the course was split between 2 sections, one of which was led by my colleague, Mark Tebbe, who will speak shortly, and the other by me. Michael Alter, Larry Berlin, Moose Chagall, Waverly Deutsch, Ellen Rudnick, and John Morris were incredible coaches for all of the teams. And as part of the course, the students received advice and mentoring from the coaches, from Mark, from me, and from many, many people in our network whom we introduced them to. And I want to thank all of you who helped the teams. Many of you, some of you are judges, some of you are watching, but thank you very much. That network matters a ton and is very helpful to our students. The students then presented twice in class, well, it was virtually, to class judges, faculty, and students, once in April and once in May. And they got very tough but constructive feedback, and they got better. Because of the virtual nature of the spring quarter, we actually could bring judges in from all around the country and even sometimes the world. And as a result, students made an unbelievable amount of progress. It always happens, and it's happened in the pandemic. The teams work really hard, and the process adds a ton of value. And it is just magical to see what happens every year, and you will see that magic as we go through the day. So that brings us to today's finals. 31 teams came down to 12. We relied on feedback from the classroom, feedback from external judges, feedback from the coaches, and a little bit of our understanding of the strength of the teams. And it wasn't easy. There were at least 15, maybe 17 teams we could have placed in the finals, and you will see 12 of them. All of them scored well with the finals judges and with their in-class presentations. And as I said, wide range of businesses from high tech to low tech, from crypto trading to makeup. And the payoffs today are getting in front of our amazing judges and raising money. When we started in 1997, the NVC prize pool was $20,000. Today, the winning team is going to receive, or the winning teams will receive at least $1 million in investments, thanks to the generous support of our judges and a variety of sponsors whom we'll thank shortly. And most of the prize money is in the form of equity that will be priced in a future financing round. And I should note, last year's prize pool increased by quite a bit during the judging deliberations. So $1 million is a minimum, and we'll see where it ends up. So that's what we're doing today. That's where we've been. And now to tell us what's going to happen, it's my pleasure to introduce Adjunct Professor of Entrepreneurship and Entrepreneur in Residence, Mark Tebbe.
Thanks, Steve. This year we have 27 distinguished finals judges who are listed on the screen now, who represent some of the best investors, entrepreneurs, and leaders of today's business community. We want to thank the judges for taking part in today's event. We recognize and appreciate that you have made a large time commitment for a full day of MVC. I assure you, you are making a meaningful, important contribution to the Chicago booth education. Part of the reason that the students work so hard is to be able to present to you, get your feedback, and hopefully get your support for the promising business, while hundreds of other students are watching to learn from your approach and your questions. Steve and I would also like to thank many of you tuning in to the live stream, including many of our in-class judges and mentors. Over 100 people were involved in the virtual classroom judging and mentorship. We want to thank each of you who have given your time and energy supporting the MVC and entrepreneurship at Chicago booth. We especially want to thank Ed Kaplan, who, let me just clear the record, is no relationship to Steve Kaplan, but is our title sponsor for his long-term commitment as our principal sponsor since the program has launched. Ed is the former CEO of Zebra Technologies and the market leader in barcode printers. Ed started the predecessor of Zebra shortly after graduating from Chicago booth. None of this would be possible without Ed's initial vision, energy, and support. In addition, many other companies and individuals have generously contributed as sponsors to this year's MVC. Words alone cannot thank all of you listed on the screen, but it is their support that has helped us increase the investments that we're able to make in our student teams today. We especially would like to thank Rajan Khosla, who is again joining us today, for his generous gift that Rajan made to the Polsky Center several years ago. As we were working to increase our MVC student investment prize pool, Rajan suggested we increase the minimum investment of our first place team to help ensure that their initial success. Rajan put his money where his idea was, and endowed the Rajan Khosla first place prize. As a result of this gift, this year's first place prize team will receive a minimum of $180,000, and this amount will continue to grow in value over the coming years. We'd also love to thank all of our platinum sponsors, Sozo, the Vishny family, GEP, and Greg and Francine Purcell for their platinum sponsorship in today's event. We would also like to recognize and thank the numerous silver, bronze, prize, and in-kind sponsors listed here that help reward our MVC students as they launch from the MVC accelerator into the entrepreneurial world. Lastly, today would not be possible if it was not for the entire support of the Polsky staff, and we want to thank each and every one of them for helping us throughout this year putting this together, and especially today. But we especially want to focus on Megan Fox and Kyla Hill, who served as the TAs for this year's MVC course and helped to keep Steve and I somewhat organized. And also to Amber Bradley, who's the MVC's program manager. They collectively made sure everything ran smoothly throughout the year, and really had their work cut out because, again, the challenges of executing this program during COVID. But let's get on with the show. Let me walk through the ground rules just so that everyone's still familiar with what they are. We ask that the judges and only the actively pitching teams have their video activated during presentations and Q&A. Other teams that have completed their business introduction and have yet to begin their introduction should not have their video on. But judges, as we say in the class, if your camera isn't on, we assume you're not there. So please keep your camera on so that the teams can observe your reactions as they present. Each team, in true NVC format, each team will have 10 minutes to present. As the students know, we strictly adhere to this time limit. Judges, we ask that you mute your microphones and not interrupt the teams. We will then have 13 minutes for Q&A, which is down from our traditional 15 minutes due to the fact that we have 12 teams in this year's NVC. Judges, when we open up for Q&A, please use the raise hand feature in the Zoom's reactions menu in the bottom of the Zoom client. We'd like to ask our judges to be concise with your questions. Any advice we have for the teams, we encourage you to give offline after the day has ended. Time will be displayed via Zoom in a box labeled NVC timer. In the unexpected event that the online timer stops working, which we've had happen a few times in class, we'll be using the chat feature to share the remaining time marks. And again, judges, each of you have been sent a link to a Google folder with score sheets for each of the presenting teams. In case you do not have that open on your end, the Polsky team will also be posting the links to the score forms in the chat feature at the beginning of each presentation, as well as at the end of each presentation. Please fill those out at the end of each presentation. There will be a few minutes between presentations to allow you to complete your scores and feedback comments while we set up for the next team. We give you a quick overview of today's schedule. As you can see, we'll have breaks throughout the day, one in the morning, one during lunch, and in the afternoon. It is important that we adhere to the timetable for today to ensure that we get through all the plans and the judging process. We ask that everyone comes back from the breaks on time. After the final presentation today, judges will be issued to a private breakout room for award deliberation. And speaking of awards, we have something new for this year. We're offering a People's Choice Award, and we want all the non-finals judges to help us out here. During the hour-and-a-half judges deliberation, we will be showing 1-minute summary pitches to refresh your memory of the 12 finalist teams. After viewing the videos via the live stream, you will be able to cast your vote for your favorite team using the QR code or link that will be provided at the time. We aspire to have the announcement ceremony live promptly at 5 p.m. Central Time. And it will be an interesting day. And so with that, we'd like to welcome our first team to the 25th annual MVC stage, Andes STR. And so, Jamin, if you want to go to the screen. All right, and let's go ahead and enable all the student members of Andes. And Christiana, are you ready?
I think so.
Okay, and do we have the clock so that they can see it? Okay, whenever you're ready, Christiana.
Thank you, Professor. Short-term rentals are the new gold rush in real estate. The market is set to double in the next 2 years, and 31% of Americans already say that real estate is the best way to invest. We estimate there are over 1 million Americans who have the money and want to invest in short-term rentals today. Now let's see how you invest in short-term rentals. Meet Linda, a high net worth senior banker who became one of our first customers. Linda wanted to invest in a short-term rental, and if she had done so by herself, she would have had to research the right market, get a good agent, find a property, and furnish it. That's 90 hours before even renting the place out. And then she has to deal with guests, receive late night calls, and manage cleaners and repairs. Everything here is hard and time consuming. And our customers want turnkey short-term rental investments, not a second job. And that's where we come in. We help customers buy the property, we furnish it, and then we manage it for them. It's that simple. We offer individual investors fully turnkey short-term rental investments that allow them to grow wealth and diversify their portfolios stress-free. And we've been doing it already for 2 years. But wait, before we talk more about our traction, Let me first show you the experience of our typical customer. First, our customer selects one of our operating markets and tells us their budget. On average, this is around $700K with 50% leverage. We currently operate in Toronto and soon Austin, Texas. After determining what location, type of property, and characteristics will maximize customer returns given their budget, our partner brokers who have short-term rental experience send us the deals that fit the bill. We already have official partnerships with brokers in Ontario, Texas, and Florida. To evaluate these deals, we've built a proprietary engine to automatically assess if the deal is good. We save the results in our database for use with future customers. If the deal is good, we send the customer a one-page report and the brokers take care of all the details of buying the property. Let me show you more of how our engine works. Let's say we wanted to analyze a two-bedroom apartment deal. Our engine then looks for similar two-bedroom Airbnb properties within the same neighborhood and extracts their historical revenues under different levels of performance. Within seconds, our engine tells us the expected average daily revenue, cash flows, IRR, and appreciation. If the IRR is above a hurdle rate, then our engine would recommend proceeding, as well as a maximum price we'd be willing to pay. Once the broker helps the customer buy the property, then we move on to furnishing it. We use data to determine the furniture layout that will get customers the highest returns, and we work with our partner interior designers to make sure the result has a local feeling. The designer also coordinates all shipping and assembly. This is how a property ends up looking. The design process takes a few hours, and our customers typically spend between $10,000 to $15,000 on a high-end two-bedroom apartment. Lastly, once the property is ready, we rent it out and manage everything for our customers. For each property, we publish the listing on multiple short-term rental platforms, such as Airbnb, VRBO, and Booking.com. Our revenue managers maximize revenue daily with dynamic pricing software. We rigorously screen out bad guests and monitor noise levels to prevent headaches to neighbors. Noise Aware, one of our strategic partners, provides the devices and does the monitoring for us. And we manage cleaning and maintenance. Each time cleaners go in, they have to check a 50-point cleaning checklist and send us pictures for quality control. For the last 2 years, every time we encountered an issue, we figured out a way to solve it efficiently. This playbook helps us enter new markets and scale faster. For instance, if a guest notifies us that the Wi-Fi stopped working, the communication staff will check their instructions, look for account information, and then call the internet provider to fix the issue immediately. The benefit to our customers is clear. This customer not only saved time and effort, but he also made almost twice as much income as he would have with a regular long-term rental. He achieved a cap rate of 9.6%, which is unheard of these days with long-term rentals, and a capital appreciation of 6.4% for a total return of 16% before leverage. I'll now pass it off to our CEO, Sebastian.
Thanks, Christina. And our customers love us because we do exactly what we say we do. Brendan here loves that we're data-driven and provide superior return. And Linda, she loves feeling like a professional investor rather than a landlord. And it's not just 2 customers. We've gotten a lot of traction over the last 2 years. We've onboarded 3 brokerages as partners. We've managed 50 properties, had a year 1 revenue of $200,000, and the company put me through business school. I'm also happy to announce that we've established a partnership with Airbnb, which will help us deliver even better results to our customers. Our strategy is twofold. We get property owners even before they buy the property. And since we use multiple platforms, we're never short of guests. And people rarely change property managers. Switching usually means missing out on a month's worth of revenue. And what if they mismanage the property? That cost could be astronomical. This combination of a unique customer entry point and high switching costs helps us get sustainable recurring revenues with high margins. To get more customers, we'll use account-based marketing, focusing first on accredited investors in Chicago. Since we already make beautiful reports and case studies, we can send these to potential customers through email and LinkedIn. Once they Hey, can you hear me?
Yeah, you're good to go, Sebastian. Sorry that you paused for Brendan there.
Yeah, something went wrong. Sorry about that. So once they see the returns we generate and show interest, our sales associates meet with them, and if they're not ready, we add them to an interest list. Meanwhile, we'll partner with registered investment advisors in the Chicago area, offering them commission for each property they get us. We validated this with 5 RIAs. They love how this helps them diversify their salaries away from the capital markets. After our first 200 customers, we'll expand to other cities while current customers reinvest their proceeds with us. We've already had 3 do this, and 1 more who wants to reinvest post-COVID. Our customers tend to live in markets that are not too good for short-term rentals, so our sales team will be in different locations than our properties. Putting it all together, this is how the annual cash flows from 1 property look like. Guests pay us approximately $7,500 and owners $10,000. As we go down the waterfall, we make a markup at each step. Guests pay us for hospitality services, which have a 30% margin, and our main source of revenue is our management fee, equal to 20% of bookings paid by guests on each stay, for a 35% margin. This management fee means that we get 20% of the property's cash flows without using our own balance sheet. These revenues are recurring and equal to 90% of our total revenues. Whenever customers invest with us, we also get a one-time fee of 1.5% of the asset value with a very high margin. All in, on average, we make $6,400 in profit per property each year, with a contribution margin of 36%. We conservatively estimate that our CAC is around $4,500 per customer. Since our LTV is roughly $30,000 per customer, we get an LTV to CAC of 6.8 times by year 2. Our customer acquisition strategy will get us 40 customers in year 1 and 2,000 by year 5. This translates to $50 million in revenue and $11 million in EBITDA. This will require substantial investment in customer acquisition, which will be mostly funded from reinvesting profits from operations and then from raising capital. By year 5, we expect to have properties in 8 different cities. And we will succeed. Right now, nobody else is offering truly turnkey short-term rental investments. The competition on the property management side is highly fragmented, with 70% of companies managing less than 20 properties. This is our team. Christina has over 7 years of experience in real estate investments. She recently worked with Brookfield, developing and executing their rental strategy for a portfolio of 10,000 properties. So she'll take care of our strategy as well. Matthias has 8 years of experience investing in real estate for family offices, and will take care of our investment service and our market selection. Jeremy is an accomplished engineer and a startup founder, and he's passionate about systems and process design, so he'll take care of our operations. And I have 4 years of experience in real estate and infrastructure, both in investment banking and private equity. I founded 3 successful startups, and I also worked as a product manager for Amazon. Our advisors bring decades of experience from their fields, which are marketing, real estate, securitization, and operations. We're asking for $600,000 to open up our first US market and to fund our explosive customer acquisition plan. The founders and close affiliates will invest up to $100,000 as well. Also, we welcome any customer leads you may have.
Thank you very much.
Thank you.
Time for questions.
Awesome.
We jump in.
Yeah, let's have the rest of the team come on screen and use the raise hand function to for questions. And Team Andes, whenever you're ready.
All right. Let's see. Perfect. Kathleen. Oh, and Jimmy, can you go to the appendix? Thank you. Thank you.
Hello, great presentation, and thanks for going first. So my question is, I'd love to hear about how your business is different from your closest competitor, Turnkey VR.
Yeah, for sure. I'll take that if you don't mind. So the biggest difference is that if you look at Turnkey VR, they're from the top down, from the very founders and advisors, they are operations guys, right? Like they come from the hotel industry, and that's where they excel at, and we recognize that. We excel in the investment side. We think ourselves as an investment company first and an operations company second. In fact, we started our operations side in a sense 2 years ago because we realized that it's very hard to find good operators. So this is needed for an investment. If you buy an investment, that's which our customers, that's how they think about about our product. They want to make sure that things are very consistent and work very well in time. And we tried Turnkey VR and we tried other providers. We have been trying them, actually. We've been doing our due diligence for 2 years now, and results were not that consistent. So we started by making sure that we can provide those consistent returns through operations, and that would enable us to provide better investments. But we think ourselves as an investment company first, and that's where we think we add the most value through our proprietary algorithm, through our experience advising institutional investors in real estate and infrastructure for the last many years before startup. Thank you. Lonnie.
Thank you. Very, very nice presentation. Quick question. Can you talk a bit more about the Airbnb relationship? Understanding there may be aspects of that you can't comment on, but what can you say about it?
For sure. Of course. Thank you very much. There are indeed a few things that we cannot talk because we're on the NDA, but basically the way it works is this. So Airbnb helps us optimize each listing to make sure that our customers and basically the properties are achieving as much revenue as they can. And that's measured as the percentile of revenue. So for each property we manage, we make sure that the revenues it generates, like the rent, it's on the 90th or above percentile. Airbnb has access to data that we don't, right? Like they know how other properties are doing better than we do. So they help us make sure that the copy, the pictures, like every metric from very similar to digital marketing, it's spot on and within range such that we can achieve that consistently. Before that partnership, we were consistently ranking in the 90th percentile and above, but now we can be very, very sure of this. And we're very proud of this because they don't do this with anybody. It's not that many companies that they partner with. So I think we see this as a recognition of our strong track record for the last 2 years and a very good sign for the future. But thank you very much.
Thank you.
Matt.
Yeah, hi. First of all, great presentation, and there's a huge built-up demand for this right now as people are trying to figure out how to get better yields. I've had a good experience or perspective into this space because our company SMS Assist powers the maintenance on the back end of a lot of the major players like Invitation Home. And in talking to those, the various SFR players, they're all talking about how the cap rates are plummeting right now in the markets, with Denver and Austin approaching 0 right now. Yeah. So they're not buying. So I'm curious, first of all, how you're getting your alpha, and especially in Austin, which a huge market, but right now it's being priced purely for appreciation. So how are you differentiating?
Absolutely, thank you. Christina, do you want to take that one?
Yeah, Matt, that's an excellent question. Yeah, I mean, can we actually go back to the presentation slide where we contrast our returns with that of others? Here we go. So, Matt, I think cap rates are typically calculated based on the returns of long-term rentals, right? So you think of your annual lease and your tenants pay for that rent, and then you take out your fees, and then there's your profit. With the short-term rentals, we can get almost twice the profit because you're taking short-term stays, which naturally you're going to charge a higher average daily rate, and even net of fees, you're getting twice the profit that you would from a long-term rental. So we see markets like Austin and Denver where the cap rates are approaching 0, but we can get returns far more because we're taking the same properties but using them for a different purpose. So we actually think of ourselves as competitively better suited for these really hot markets where everybody wants to buy a place, but they're not quite able to get the returns that they want through traditional means of real estate. So big market, very profitable, and we're very excited for the future. Thank you for the question.
Awesome. Mark.
Can you discuss regulatory risk, risk of change in tax scheme, being subject to hotel tax, et cetera?
Yeah, so there's yeah, that's a huge point. So I'm happy to discuss further in like offline. But in general, each market has different regulatory risks, right? So that's a big part of our market selection strategy. We learned the hard way in Toronto that selecting your market is extremely important, and one of the main things we filter for is precisely regulatory environment. So it's multiple steps, but we look for markets that have already a positive regulation in a sense, and also where the sentiment is good. Also, without discussing too much, that's another area where Airbnb is helping us. So pretty helpful. Thank you. Brent.
Hi, good morning. Thank you. Can you just click on the TAM buildup for us, please, and walk us through some of the assumptions in there?
Sure. Christina, do you want to talk about that one?
Sure, Brent, I'd be happy to take that. Jamin, can we actually go to the slide immediately after this? Because I think it's a little easier to see. So we know from various data providers like Statista, CBRE, and AirDNA that short-term rental revenues rather in the US are going to approach about $30 billion in the year 2025, right? And STR revenue includes all sorts of fees, right? The amount that guests pay for their stay, a bunch of other things, cleaning, maintenance, restocking, booking fees. And we as property managers get a cut of this, right? We get 20% of booking fees and then 100% of the other fees, such as maintenance, right? So out of that $30 billion that guests pay, property managers are going to get $14 billion. That's our TAM. And then by 2025, we expect to operate in 8 cities, right? And Sebastian walked through that during the presentation. And the average number of STR units in cities, at least in the top 20 cities, is about 7,000, with an average revenue of about 24,000 a year. So taking that, we get a SAM of about $1.3 billion. And then based on our customer acquisition plan, which is much more bottoms up, we project that we're going to get about $50 million. That's less than 5% of the local market, which we think is incredibly conservative. Hope that helps. We're happy to walk through that in even more detail offline if needed. Thank you for your question.
Awesome. Mar?
Hi, great presentation. I have a question about how are you guys acquiring units and who are you going after acquiring those units? Is it an individual? Have you thought about, buildings, even syndication? We'll talk about that.
Yeah, excellent. No, I mean, I could talk about this for hours. I love this stuff. We actually have a lot of experience in syndication deals, but currently the way we do it is one by one. We do one by one, and the owners, so our customers own the properties themselves. So we facilitate the whole process. Our next step, like year 2 onwards, is to warehouse the units, right? Like buy ourselves fast, like pick up the really good ones immediately, and like with strong cash offers, warehouse them and then sell them out. But that's very capital intensive. So instead of having that balance sheet committed right now, we'd rather invest that money in customer acquisition because it's very profitable for us. And then once we have a little bit more balance sheet freed up, then we're going to start doing this. And also one quick thing. Currently, it's very hard to get these properties because of COVID and this like weird world we're living in. But we expect, like, this is a long business for us. So we expect that post-COVID things kind of, and we're seeing it now actually, that things are returning to normalcy. Like it's getting a little bit easier to buy this property. So we see our biggest strength in our algorithm, in the way we buy, how we choose the properties, rather than how fast we buy them. But thanks for the question. Kevin.
Great presentation, guys. Thanks so much. My question is going to be around, so I'm an investor in a company called Evolve VRN out of Denver that's raised $120 million. As Caitlin alluded to, there's some really well-funded folks in this space. How do you think about this playing out, and what are the potential exit opportunities down the road for you guys?
For sure. I think we have a slide on this one, Jimmy, right?
Potential exit opportunities.
Yeah. So yeah, great question. Thank you. So yeah, we see this space as like hot at the moment, right? Like there's a lot of money in this, as you well know. It's highly acquisitive. There's a lot of movement going on lately. So we think that there are multiple ways to exit, both either strategic, it could be a Vacasa, for instance, or it could be maybe in the future an Evolve. It could also be a major company like, I don't know, like Expedia, Airbnb, VRBO. They've also tried to dabble a little bit in these things. And especially since we have the investment piece, which almost nobody else has this level of sophistication on this part of the equation. I think that makes us particularly interesting for potential strategics. Thank you very much. Let's see. Oh, sorry, I have to move this. Michael?
Hey guys, great presentation. In terms of your customer profile and who you'll service, can you talk a little bit about if you would anticipate you'd support customers who already have a property and only want your management services, or the reverse of customers who are just want your help purchasing property?
Of course. We've had, like, to be frank, currently our customer base is roughly 50-50. People that have done the acquisition start, and then basically just the property management side. Usually the customers that come only for property management come from our partners. So we have, like, for instance, partnerships with brokers, with accountants, with insurance providers, and they come to us with a property already, and usually they want to furnish it as well. Like, they start from that point onwards, and that's very good for us. That's extremely good because that makes it very quick for us. Having to buy, having to furnish, that adds basically kind of a month or 2 months of like a cycle in a sense. But if we can manage day one, that's pretty good because 90% of our revenues come from that. So that for us is a positive. It's just not where we're trying to learn and develop the most. Thank you. I hope that makes it clear, and happy to follow up offline as well. Let's see. So, well, I can't recall the name exactly, but Jay Shulkin.
I'll change that. It's John. Sorry about that. We happen to be investors in one of the companies on that list that you had in Sonder. And so my question for you, having spent a lot of time with them, is from a property management perspective, how well developed is your technology platform?
Yeah, thanks. So let's see. So I'll start this off a little bit. So we integrate many different providers mostly. So we use software that's already out there. Like we've shown Guesty before. We're not using Guesty, we're using different ones. And we're building more stuff there. We're currently actually building a machine learning algorithm to help us with communications, with using natural language processing, because basically like 80% of the messages for each property are the same, are very repeatable and easy to detect which one you should, they're automated. So we're working on that. But at this stage, and the way our company works, like the org structure in a sense, it's not, it's very driven by the property manager. Like we have a position called property manager, and they also work as an account manager. So like it's also a customer-facing position. So thus far, at the scale we've been working on, which is 50, I think our peak properties was like 56 or so. We haven't needed much more automation than basically setting up tickets for repairs and things like that, and also a lot for cleaning. Whenever we get a booking, we automatically assign cleaners to it, and that goes to our cleaning manager, and they get like a flurry of emails with instructions and reminders when to go, and they check in their app, and then that goes back to us, and we know that it's been cleaned. But more than that, we haven't really saw a need for more automation in operations. That's something that perhaps once we have 500 properties, we're going to see more of a need of. But most of our automation and technology is an investment side for now.
Great job, Sebastian. Great job, Team Andes. Thank you very much. Judges, if you could take a minute here. They just posted the score sheet in the chat again, if you'd like, or if you already have it. Please take a couple minutes to score Team Andes. And what we will do while you're doing that is we will get the next team ready, Team Annuity. So Annuity Risk, if you want to go ahead and turn your camera on. Okay, music entertainment. Charles, if you want to go ahead and put your slides up, go ahead and get that one set up. Okay. And Gaurav, as soon as we'll give another minute for the judges, then we'll get started. Okay, it looks like the judges are pretty much ready, so let's go ahead and change off the music.
So can you hear me?
And yeah, and one logistical component for the judges. When we flip between the screens, you may have had it go to full thing. If you could go in the upper right corner, you have view side by side with gallery. You'll be able to see all the judges and all the teams again for the judges. With that logistical component, Garv, are you ready?
Yep. Can you hear me?
Okay. Whenever you're ready.
Can you hear me?
Yes.
Okay, great. I'm ready.
If you're ready, go ahead and go.
Hello, everyone. My name is Gaurav, and I'm the CEO and founder of Annuity Risk. While indexed annuities are simple products, managing the risk of these annuities is incredibly challenging and a barrier to entry in this fast-growing industry. At Annuity Risk, we help solve this problem by providing best-in-class risk management solutions for indexed annuities. While traditional fixed annuities give a low but guaranteed interest rate, indexed annuities provide a higher but variable interest rate linked to an index such as the S&P 500. This variable rate is capped at around 5%, and this rate resets each year. And by regulation, the annuity company must hedge for each annuity policy it has sold. Because of persistent low interest rates, indexed annuities are now the most popular annuity product, with sales growing 15% year over year. Today, indexed annuities are available in more than 20 different designs. And as this product continues to evolve, risk management gets increasingly complex. Inside the indexed annuity, each year, about 2% of the account value is used to purchase a call option. And the remaining 98% account value is invested into an asset such as a corporate bond. Next year, again, the 2% will go into the call option. And the remaining 98% will stay in the corporate bond. And this 2%, 98% split is repeated year after year. The return from this call option creates growth in the policy account. And this buying of call option is called hedging. Now let us give you an idea of how hedging is done today. Every day, the annuity company sells hundreds of policies, and it keeps receiving policy data throughout the day. Around 1 p.m., the risk managers start the hedging process, which begins by gathering whatever policy data they have received up to the minute. Then they aggregate all these different policies into less than a dozen trades, and then execute the trades with the derivative dealers. They must complete this entire hedging before the equity market closes at 3 p.m. Central. As you can see, most firms don't even know the exact dollar amount that they need to hedge, so they just make a guess. And they also make crude approximations while condensing hundreds or thousands of policies into a few trades. And finally, to simplify things, they rely on something called static hedging, which means buying an exactly matching option that only dealers can supply. And dealers do charge a premium for these static hedges. Here, small annuity firms are not even able to hedge every day because dealers won't take interest in their small trades. And let's not forget that each of these annuity policies contain lifelong savings of millions of people. At Annuity Risk, we help solve all these problems and much more. As we get the policy data from different insurers, our proprietary engine correctly packages these policies into fewer aggregated policies. Then our matching engine surveys all the exchanges and the dealer market to match the aggregated policies to the best available hedges, both static and dynamic. The engine then sends a trade recommendation, which our traders use to purchase the derivative manually. We also periodically rebalance the portfolio to reduce the risk and lock in our gains. We estimate that we will be able to cut hedging expenses by up to 15% for most insurers, which translates to a 30% gain in profits. Here, it is important to know that we are hedging on behalf of the insurer. The insurer owns the derivative. We do not have our own balance sheet involved in this process. And while hedging efficiency is one big leap, it's not the only hurdle for risk managers. By combining our core expertise in derivative pricing with actual transaction data, we can provide highly accurate option prices that our clients will use to set rates on their policies. And GAAP now mandates that all the changes in the value of derivatives held by an insurer be passed directly onto the income statement. Using our cloud-based tool sets, our clients can run valuation and detailed risk reports on demand. And now that we have the policy data from our client, we can build valuable predictive models for that data. Our clients really want to know what features policyholders are utilizing so that they can create products that are both appealing to the customer and cheaper to hedge at the same time. Now let me invite Manik to talk about our progress.
Thank you, Gaurav. Our platform is live today and available for clients to use. We have built a lot of cutting-edge functionality for risk managers, including option pricing, P&L, scenario analysis, and we release new tools every week. Just in the last month, we have received a letter of intent from an insurer with $4.5 billion in AUM. The conversation with Advantage Capital started with a cold email outreach, and this further reinforces our value prop. We are also in advanced sales talk with a few other insurers, one of which is Principal Financial Group. Let us show you how we create value for a small insurer such as Sentinel Security Life, which sells $200 million in annuities in a single year. For them, expanding the product line is the main goal. We help them launch new annuity products quickly, and they grow faster organically. In addition, we add $3 to $5 million to the bottom line. For a large insurer like American Equity, which sells $4 billion in index annuity in a single year, operational efficiency is the main goal. With Annuity Risk, they lower their hedging cost, automate their processes using our toolset, and utilize their vast amount of policyholder data to innovate on product design. Today, about $800 billion of American household savings are in index annuities. Based on a net fee estimate of 10 basis points, the risk management services business is worth $800 million. Adjacent markets such as variable annuities have about $2.3 trillion in AUM based on a fee estimate of 7 basis points. The TAM of this adjacent market is well over $1.6 billion. Today, we are the only risk management solution provider focused entirely on the index annuity market. Milliman is a consulting firm whose focus is in variable annuity hedging, and currently, Milliman does not provide any cloud-based toolset. For option pricing, customers can use Bloomberg or Numerics. However, these toolsets are very generic, and unlike them, we are the only trading. We are actually trading in the marketplace, so we can provide the most accurate estimates of trade prices. For many other niche applications like policy or behavior analytics, we are the only provider of any toolset. Now, let me hand it over to Brian to talk about customer segmentation.
Thank you, Manik. Today, there are about 75 companies selling indexed annuities, and the market is very fragmented. So in the first 2 years of operation, we're going to focus on the small players. There are 40 small insurance companies, and their need for new product launches and inability to hedge effectively makes them our ideal customer right now. In fact, Advantage Capital, where our first letter of intent comes from, owns 2 small insurers. Thinking more broadly, we believe that we'd be able to expand the target market because there are more annuity sellers today who want to start selling indexed annuities but don't have the technology to do so. With our help, they'll be able to enter this market and combine our technology and their sales force to scale quickly. So far, we've been following a direct sales strategy, and we plan to continue to do so in the future. Additionally, we'll be marketing ourselves at all major industry conferences and engaging customers via white papers. Now, a small client sells about 15 million in annuities in a month, and we can make around 85,000 in monthly revenue from them. We spent around 280,000 to acquire one small customer, and the payback period is 10 months. Now, for a mid-sized client, we spend 420 as CAC, and we make around 200,000 a month from them, resulting in a payback of 5 months. And for a large client, we pay around 625,000 in CAC, and we make around 600,000 per month with a payback period of only 2 months. In our first 2 years, our focus during this time is squarely on technology development. In the next 2 years, we'll expand our capabilities to include variable annuity risk management. Many of our clients will be selling both indexed and variable annuities, so we can upsell variable annuity hedging to the same clients. By the end of 2026, we project to have about 38 million in annual revenue, some 35 billion in AUM, and an EBITDA margin of 42%. This projected market share would still be minuscule compared to the expected overall market size, meaning there'd be a lot of room for further growth. Now I'll hand it back to Gaurav to talk about the team and our ask.
Thank you, Brian. Here at Annuity Risk, we have assembled a strong team of technologists, quants, and actuaries. I'm an experienced quant, and in the past, I ran a proprietary trading desk making markets in equity and interest rate derivatives. I worked with the hedging team of 2 of the top 10 annuity sellers. Our advisor, Saugata, has worked at some of the largest insurers, including Lincoln, Hartford, Jackson, and Equitable. Sham is an engineering lead at Roku and a serial entrepreneur. Today, we're raising $1.25 million in the seed round. With this funding, within 1 year, we will solidify our cloud infrastructure and onboard 1 client in the next 6 months, and then 2 more clients in the first half of next year. And we aim to reach a monthly recurring revenue of $200K by June 2022. With that, we conclude our presentation and now open for Q&A.
Very good. Team Annuity Risk, let's go ahead and give us a second here to reset the clock and for the judges to get their hands up, and then we'll get started. Jim Dugan does have his hand up, so whenever you're ready to start.
Thank you. Nice presentation. I was an options trader, fixed income for years, and I really appreciated it. So if I'm an insurer and I'm looking at this, I have 2 questions for you. What about the OTC and the flex option market? I can utilize that. And I understand at the end of the day, they want to match. So there may be this tail risk, but you're basically evaluated services, right? To the companies, to these annuity index underwriters. And in that capacity, I have other options or alternatives, I should say. So can you speak to that as it relates to OTC or even flex options, on the exchanges? Separate question is, as an advisor, do you need a broker-dealer license? Are you providing investment advisory related work? And is that part of what you get from Advantage or one of your partners? Thanks.
So great question. And let me take that. So first about the broker-dealer relationship. So we are not taking any risk. We are not touching the derivatives. So we're trading purely on behalf of the client. So we will not need to have a broker-dealer set up on our side. Then the question about Flex. Yes, Flex provides an interesting avenue for simple point-to-point options on S&P. If you talk about another index like MSCI EAFE, barely anything trades on the call side, nothing trades on the put side. And half of all indexed annuities today are sold to smart beta indices, for which no options are available on any exchange whatsoever. So for these smart beta indices, typically companies are the insurance providers have very few avenues of getting options and so forth.
Fair enough. But then what about on the larger scale side for the over-the-counter? I mean, can't I just do an over-the-counter swaption if I find a larger broker that wants to kind of aggregate that? I mean, I'm just trying to understand how you scale. Really, the fundamental question becomes, I can see for the small insurers and underwriters, but upon scale, where does it go for you? And thank you for the other question or the answer. So you're not providing you're providing advisory work. You don't have balance sheet. I picked that up, but do you need investment advisory licenses or anything like that?
No, we do not. We are merely a trader for hire.
Okay.
So yeah, and yeah. And about the broker dealer.
OTC and scale.
Yeah. So one of our main advantages is that we are able to aggregate the hedge flow for many small clients and purchase a larger option for them. When we actually purchase the large option in the OTC market, we can then piecemeal to the smaller.
Okay. So you can do it in mass and then fractionalize it out to the other clients. That's
right.
So I'll definitely bring that out into the presentation. Thank you.
Right. Thank you. Cristobal, go ahead, please.
Hi. Thanks for the presentation. It was really good. So my question goes around client acquisition and the cycle for it. Like, how long does it take you to get a client? Because I noticed in the last slide, it seemed to be kind of slow, the take-up of clients, right? So how does that?
That's a great question. Let me have Manik answer that question for us, and let's go to slide number 24, please.
Thank you for the question. So there are two aspects to this. One is focus on sales and customer acquisition, and second is more broadly around marketing. On the sales side, we leverage our combined network to get introductions. We usually have introductory meetings, understand the pain points. So far, the customers have been very open for those conversations. We use this interview and publicly available data to prepare a pitch for the customer, and then understand what products they're selling and what challenges they might be facing. We then go up the hierarchy, pitch to the chief risk officer, who eventually brings in their entire team to build in buy-in for us. Based on that, we understand what exactly can we work with them. We create an SOW. At this point, we expect the top decision maker to focus on one section of our tool set and then sign a contract with us. On the marketing side, on the long-term focus, we focus on showcasing our capabilities at major trade conferences, publish white paper in collaboration with UChicago faculty, and send out periodic newsletter to existing and potential customers. Based on this, we have thought about our customer acquisition strategy and turnaround cycle, and we think that we are conservative in our estimates. Does that answer your question?
Yeah. Just one more question. So you said that client acquisition for the large clients was like $600,000. Was that correct?
Correct.
Why is it so expensive?
Another great question. Charles, let's go to slide number 33. So typically we expect to spend about 9 months chasing a large client, one salesperson, 2 technical folks. We spend some amount in software customizations and in travel and conference attendance and so forth. So that's about where it comes to. And a payback period is less than 2 months. So we're not that worried about spending all that money for a large client, and large client can become a reference account for us very quickly. And in fact, when we were initially modeling our business plan, we projected a large client to come in around 2024-25, but actually we were thrilled to receive interest from Principal, American Equity, and very recently we received interest from Guggenheim, which owns Delaware Life and Security Benefit. So it seems like the sales cycle should be shorter for us, or at least the first client acquisition could be much quicker.
Thank you.
Thank you. Go ahead, Koichiro.
Thank you. Great presentation. Could you talk about the competitive advantage a little bit more? Why those big platform players will not offer the service you are offering?
Great question. And Saugata will answer that question for us. And let's go back to slide number 11.
Thanks. That's a great question. So some of the competitive advantages that we have, so if you see, typically the insurance clients are very sticky customers. So we are expecting a lot of repeat and recurring business. On the competition side, we are uniquely positioned that we are entirely focused in the indexed annuity market. The pricing for our service is more aligned to the AUM rather than consulting dollars. For other competitors like Millennium, they provide this hedging service more as a value add to their consulting. And on top of it, we are providing the clients those cutting edge tools, web-based tools, and integrating policyholder behavior with hedging. So that sets us apart from the competitive standpoint. Does that answer your question?
Okay, thank you.
Great. Go ahead, Van.
Yes, would love to have an understanding of your product roadmap from the 25 conversations you've had to date.
So yeah, let me take that question. So right now we're focusing on indexed annuity market. In the next 2 years, we're going to build technology for both indexed and variable annuity hedging. And the reason is simply because many of our clients are selling both indexed and variable annuities. In fact, when we first spoke to Prudential, they asked us, hey, can you also hedge for variable annuities? Because there are synergies between these two markets. For variable annuities, you have to buy puts. For indexed annuity, you have to buy calls, and they sort of offset each other. And we were very much in agreement. the thing is, there's some amount of sophistication and extra technology buildup required, and if we get that done in the first year and a half, 2 years, we will be able to upsell to the same existing clients who are selling indexed annuities. And I think we feel very excited by that prospect. There's another product line called Index Universal Life, which is also has a hedging requirement, very similar to indexed annuities, and we can probably upsell to the same clients and grow our AUM. And then there are other value-added services. For example, a lot of our conversations indicated that clients are not hedging for interest rate risk. So when interest rates go up or down, all of a sudden the callable corporate bonds get called, and they have to reinvest the money at very low yields. Liability stays where it is at very high interest rates, and if we can hedge for that asset risk, we can also add value to our clients. So we feel very excited about it.
Okay, I guess any other questions? Looks like not, so thank you, good job. And judges, why don't you fill out the evaluation? There it is. And we will then line up StoryEasel. Next team slide should be StoryEasel.
Slide. Christopher, can we put up the next slide? Thank you. While the judges finish the scoring, if you want to go ahead and put up the slides.
Little bit ahead of schedule. Are they?
They're in the. I was told they were in the main room, but Sunita's not here, so we'll give it another minute. Let's go ahead and put a little music back up. Streaming.
Well, ahead of schedule is good.
They're on the way back. Okay, Stina, while the music's playing, let's go ahead and put up our slide. Right? We can see your slides, so that's great. And we'll let the rest of the team assemble, and then Niso, you're ready when we're ready?
Can you hear me?
Yes. Okay, so just give it a sec here. And it looks like we're set and ready. So whenever you're ready to go.
Hello, my name is Niso, and I'm the founder of StoryEasel, a digital memory and heritage preservation platform that empowers you to preserve your treasured memories. Imagine sitting around the Thanksgiving table with your family, grandma and grandpa talking about the good old days when they met, and your parents talking about a family memory you never knew existed. Now imagine that's all taken away from you. I'll never have those memories. A few years ago, I lost both my mom and my grandma, and with them, 213 years of precious family history. All I had left were memories in a shoebox, on my social media, and in my phone gallery. My kids will never know the fantastic person my mom was. If COVID-19's taught us anything, it's that tomorrow's not promised for anybody. I'd like to introduce Raina, who will take you through the exciting solution we developed.
It goes without saying that memories are made every day, whether that is a wedding, a graduation, the birth of a child, or even a family reunion. But unlike Niso's story, it doesn't just take death to miss out on capturing these memories. Memorializing them can be difficult. It takes time. And if your family is abroad, then there are language barriers, cultural barriers, and even geography. And also now we are inundated with so many digital storage options that we never get around to actually preserving our memories. Shockingly, we found that 33% of Americans cannot name all 4 of their grandparents. Simply put, the problem here is that the more fast-paced the world becomes, the harder it is to hold on to the legacies of those who came before us. And so we have created a solution. Meet StoryEasel, a digital storytelling platform that allows you to preserve your heritage and memories for generations to come. We have created an app that allows you to collaborate with your family members, organize data, and upload media from various different forms using meta tagging, preserve it permanently digitally, and share it with either your family or the world. And now I'm going to hand it over to Mike, who's going to walk through a demo of our product.
Thanks, Raina. So let's take a look at how StoryEasel actually works. We begin by capturing a story. Users can record audio directly into the app, or they can manually type it in. Here, we have a simple story about a user's grandfather and their family's favorite fruit. If you have any photos, you can load them in directly, or you can import them from other popular sites like Facebook and Google Drive. The result is a beautifully crafted story combining both the audio and images together. StoryEasel then automatically parses out key meta tags like dates, locations, and people, and uses them to recommend content from third-party providers, which can then be added to your story. Those same tags can then connect you with other users, which will help enrich your story even further. Finally, users can then take their stories and can export them into videos and slideshows, which can be shared with the world. So what makes us different? Well, we start with unique family metadata. Details about your family, cultures, tradition, won't be found in historical archives. They will be shared orally between family members, sometimes over the course of generations, and have unique identifiers that can be sourced to an original meta tag. Secondly, StoryEasel leverages integrations with sites like Facebook and Google Drive to import content and even create placeholders for potential stories. That, tied with nudges in the form of push notifications and email communications, will help guide the users to expand their story even further and create a bit of user stickiness. And then finally, our platform makes it easy for even the least creative user to turn their stories into slideshows, videos, scrapbooks, which can be emailed privately to other family members or uploaded to social media. So with those differentiators in mind, it's easy to see that the competitors provide only a fragmented variation of our product. From genealogy services to digital scrapbooking templates, none of the other market solutions capture traditions and culture of the user in a meaningful way. StoryEasel is the only metadata-driven solution capable of capturing those personal and interconnected moments that make up your life, and it does so in a collaborative and automated environment. And I'm going to pass it over to Steph, who will be covering our go-to-market strategy.
Thanks, Mike. Meet Anjali. She is her family's designated historian and considers genealogy research a big hobby of hers. She recently married her husband, Peter, and is looking forward to starting a family with him. She's always had a passion for Indian culture and listening to her Dottie tell family stories from their farm in southern India. And she wants to make sure she can pass these stories on to her own children. Right now, though, she's frustrated because her photos are scattered across different digital storage apps. And whenever she signs up for genealogy websites, they provide her with limited information on her Indian heritage. So she signs up for StoryEasel, where the question prompts and ease of use will save her hours of coordination time as she organizes her family story. Anjali bought our family plan where she is the champion user. She's invited 4 other family members to help build out her unique family easel of her Indian culture, as well as growing up in Houston. Her Dottie is having a great time uploading audio recordings and scanning in old family photos. And eventually she wants to be able to download her story and share it in a physical storybook with Peter and their future children. But for now, she's just having fun sharing her Dottie stories from India with her Twitter followers. We know that Anjali's challenges are almost universal. So many of us have struggled to preserve our family stories in their own unique way. And as we look at our market, we want to focus on North Americans with a sense of nostalgia and cultural attachment in key markets. Then we will expand it further into North America and then open up to other countries. As we enter the market, we will have a 3-pronged approach. First, we will partner with cultural organizations here in Chicago. Second, we will target key demographics through social media and SEO advertising. And last, we will partner with life milestone centers like birthing centers, wedding venues, as well as funeral homes. For 2021, we will be working in 3-month sprints where we will apply learnings from each phase to the next one. We will launch our MVP in September by conducting a pilot test with the local cultural center and targeted social media ads. Currently, we're looking at the National Indo-American Museum here in Chicago. We will then grow to 12,000 users by expanding here in Chicago. By the end of 2022, we want to expand to a second market via digital marketing campaign that will get us to 125,000 users by the end of 2022. And then by 2023, we want to grow to 220,000 US-based users. And now I'm going to pass it off to Nisa, who's going to talk about our traction and revenue model.
In the last few weeks, we've grown our user waitlist to 100+ people and raised 13,000 in the process. Starting off in early April, we validated and invalidated our early assumptions and then moved on to building our first prototype in May and securing our first 2 letters of intent. Today, we're in the build phase, and we have 1 provisional patent pending and 75+ beta users on the platform. In September of 2021, we hope to launch our MVP. We monetize in 3 key ways. Firstly is through freemium subscriptions from users. Secondly is through service fees from printing of storybooks and scrapbooks. And thirdly is through affiliate fees from our channel partners. Now, what would you give to have your memories live on for generations? Our free version has limitations around storage and functionality. Our second package and the paid versions are $10 and $20 respectively for the single user and the family packages. Our growth trajectory sees us growing to 1.2 million users and 123 million in revenue in 2026 at a 30% EBITDA. Now that we've told you the aching problem, the exciting and unique solution we've developed, shown you how the market's growing, and shown you how we'll make you money, lots of money, I'd like to introduce you to the team that's actually executing the strategy. I'm a 2-time founder. Our strategy lead, Raina, brings the media and data analytics experience to the team. Chinzo, our tech lead, is a software engineer, and Mike, our product lead, brings his enterprise software experience to the team. Manish, our lead storyteller and content creator, is a writer, producer, and director of several English and Hindi movies, including The Sky is Pink. And Steph, our marketing lead, brings the consumer experience and advertising experience to the team. We're currently recruiting for an AI developer. We're asking for $1 million, 34% of which will be used for marketing to drive us to 125,000 users by December of 2022 and 2 million in annual recurring revenue. I can't get back the 213 years of priceless, precious family history that we've lost, but you can. And we hope that you'll let us help you do that. Thank you, and we're open for questions.
Okay, Ben, give us a sec here to reset the clock. And you've got hands from judges, so whenever you're ready.
Mike Leahy, you want to go?
Yes, sure. This sounds very appealing to me, thinking of parents or grandparents that are getting older in age and have all these great stories that they tell you over and over again, and you're paranoid you're going to lose them. So how users may be anxious that they take a lot of time, record all this, and how does this information become available over the generations? You do all this great recording. What happens if you're acquired or the business is shut down? Or what happens if I wouldn't pay the monthly fee every single month? How do I know it's worth spending all the time to make the recordings if they may go away in the future?
Great question to kick us off, Mark. Mike, would you like to take that?
Yeah, so to start off with your second question, in the event that user had maybe a paid subscription and they go down to the free one, what really changes is the storage. So the actual stories themselves, so the text with all the meta tags, does not count towards your storage, and those would never be deleted. The limited storage on the freemium package is only, and actually for all of the packages, is only for the images and the audio. So we would follow a similar pattern of what the other cloud storage providers do, where they give you 30 days to pull your data off. And after 90 days, we would fully remove the images and audio from the system, but your stories would remain indefinitely.
Great. Thanks, Mike. Kevin, would you like to go?
Yeah, thanks, guys. Great presentation for those of us with aging parents or parents who've lost. This is very top of mind. So appreciate your idea here. My question is on two things. One, I've heard a lot about Artifact recently, which is an interview, kind of deep interview kind of thing. How do you think about them? And then how do you think about privacy and security here? Because sometimes that kind of older generation isn't always comfortable maybe sharing all these things if they're not confident that it'll be protected.
Great. So our understanding is that Artifact is a tech company. We are a storytelling and heritage preservation company that uses tech. And so our focus is helping people tell the story behind the story and keep that going for generations. And in terms of data privacy, that is top of mind, definitely. And how we think about it is having in place robust data privacy policies and controls in place. We know it's a very topical issue right now. And so we actually have on the team a data privacy attorney. And so that kind of informs how we go in terms of our data privacy strategies. Lonnie?
Can you go back to the revenue model and talk through the specifics just a bit more?
Absolutely, Mike.
Sneha, can we go to the 18-month revenue projections? So in particular, I have this broken down by quarter for the first 18 months. We are looking to acquire roughly 12,000 users by the end of Q4, and that increases approximately 2 to 3 times every quarter going forward. We've split the actual paid users into varying converted rates, which we've based off of benchmarks from other businesses. So we'd start off at roughly 10% of the users would be paid in the first quarter, and then 20% of those users would be paying by the end of 2022. Within that, we also have a la carte options. So for the freemium users who aren't paying anything, they'd be able to export stories and some of the other content, so that would bring in additional revenue even with their free accounts. So with that split out, like I said, at the end of 2024, we expect roughly 20% of those users to be on a subscription model. And we'd be bringing in roughly $1 to $1.25 for all the free users on average at that point per month.
Great, thanks, Mike. Ma?
Hi, Niso. Thank you for the presentation. I have a question regarding your value proposition and what you've learned from your user interviews. My understanding is Ancestry.com has had digital scrapbooking for years. I don't know how that business have done. Sounds like your innovation is on the collaborative side. And I'm curious if the users are willing to pay for an additional service. I mean, that does the scrapbooking aside from having their family trees on ancestry.com. So anyways, any learnings that you guys have done that would be helpful.
Thanks, Mark. Reina will love that question.
Sure. Sneha, can you go to the ancestry slide, please? So what we've seen with Ancestry, and we've done some analysis into this, is that we fundamentally differ in terms of our value proposition in terms of not being solely based on data-driven record keeping, and also allowing for additional flexibility when it comes to uploading media, not just photos and images, but also audio recordings. And we're trying to partner up and integrate with even like video call services and have that be an option to upload. And also there is a single user aspect to Ancestry.com when trying to build your family tree or even like create your own account. And we are playing much more on the collaborative side where you and your family members and friends can upload various forms of content and have that be an ongoing effort. And I think mostly what differentiates us is not only the experience that I just mentioned, but the fact that we aren't just project-based. We're not here to just make a tribute video or a scrapbook. We're trying to have ongoing engagement so that it's preserved over time. So generations down the line are able to access your precious audio recordings of your grandmother before it's too late.
Thanks, Reina. In addition, when we spoke to the former CEO of Ancestry, we did find out that this is actually a white space that we're playing in. And what we do is kind of bring together the big boulders of information that Ancestry churns. Guy, would you like to ask your question?
Yeah, thanks, Niso. So I guess I kind of have the same question with respect to Google Photos and partner sharing and all that, and likewise with what Apple does. Because it feels like, between those and Ancestry, you've got a pretty good coverage of this general pain point, but would like your perspective with respect to the big behemoths. Thanks.
Great. Reina?
Sure. Yes, we see competition being in the form of Google Drive and storage companies as well. Sneha, can we go to the competitive landscape? Good, perfect. So we've identified groups within social networking, same with like Facebook, Instagram, in terms of keeping those photos on a digital platform, as well as genealogy and data storage, like you mentioned. And while there are options for people to even have physical photo albums and keep that in a spot, or even like digitally on, Google Drive, it seems that they're inundated with just that, so many different preservation tools in terms of just data storage. And also there is very little flexibility in terms of how you collaborate using these data storage sites. And also with Facebook, we can go to the Facebook slide, Sneha, if that works. We also, have looked into Facebook being, the status quo of how people are currently uploading images. And it is a larger company, same with Google Drive. And that mission has pivoted tremendously given how much Facebook and Google Drive have changed. So our sole purpose and mission is to tell the family story in an ongoing fashion. And we want to offer that level of flexibility and compatibility with other apps as well. So we see ourselves, separate from these entities, which offer like a fragmented aspect of our service. And we really want to focus on the story and capturing people's lives rather than, having a data dump of storage options.
Thanks, Reina.
Great. Matt, would you like to ask your question?
Sure. First of all, a great presentation, and one that our family has looked into, kinds of different solutions here at the end of the day. And I think with the aging population, it'll just increase. But a question I have is, it sounds like one of your key differentiators is that instead of having one person archiving like the Ancestry model, and we have someone in our family that does that, this is more of a family participation model, a platform, a social platform. But what I've noticed is that the families, getting people to actually engage and take the time to upload videos and to engage and do all of that other stuff is really difficult, and you get very low engagement rates. We literally tried to do this for my daughter's graduation. Like everyone uploaded a video and like 2 people uploaded it. So how do you actually get user adoption, behavior change, and how are you streamlining that process? Because it's been very difficult to create a communal effort of contributing at the end of the day.
Absolutely. So you're right. We've, in speaking to 31 analogs that have been in this space, we came to the same conclusion. And so Sneha, could you turn to a behavior change slide, please? So we have a 5-step behavior change model that kind of helps the user through the process. And what we've done is we've embedded different functionalities within the app to kind of help the user along from the templates that we have to the integration and collaboration features. And what's different about our app is it's based on a pull effect versus a push effect. So we do the heavy lifting for the user and hold their hand and help them along. Thank you. Jake?
You're muted, Jake.
I tried my space bar and that one didn't work. I'm interested in almost a very similar question. I was interested in degree of effort and how that relates to the expectation of attracting 1.2 million folks to this platform in the next 5 years. And the 94 million market in North America, that's a very large share of the North American population to have that high a degree of interest. How do you substantiate those?
Great. Steph, would you like to take this one?
Oh, Steph, you're muted.
Sorry, I have a double mute. If we can go to the market research to date slide, that'd be great. Awesome. So we absolutely recognize that this is a large market. We've talked to so many different people. We've conducted 15 plus interviews of experts in the field, as well as over 300 interviews of potential customers. And we have found that this is, like I said, a universal issue that so many people and of various parts of life feel affected by. So we want to start small with that 12,000 users by the end of 2021. And we're really going to use this time to build a platform that allows any type of user, and we are hoping of any age. So we do expect from Gen Z all the way to Gen X to be able to use our platform and have ease of use. And so we want to really target people online and use very specific digital marketing campaigns in order to access this group. But we also have a virality coefficient of about 4 to 5, because as one champion user invites or signs up, they get to, if they buy the family plan, they can get to invite 4 other people, and so it spreads kind of like wildfire like that. Thank you.
Thanks, Jake. We don't have any more hands, and so we're happy to take second questions from other people.
No, you're out of time. So thank you very much, Niso and StoryEasel. And now judges, please remember to fill out your form for StoryEasel. And we're a little ahead of schedule. We will still take our break and come back at 10:17 Central sharp for the next 4 presentations. And I hope everybody enjoyed the first 3. They were terrific, and look forward to the next 9. So we'll see you back here at 10:17 sharp.
And Chris, you want to give us a 17-minute clock?
Oh, 19 minutes now.
Yeah, but by the time we'll get the other team started.
Okay, that's right. Good, good, good.
Thanks.
almost ready to get started. Christopher, can you turn the music off, please? And Nisha, why don't you get your slides ready to go? And we'll start up in a second. There we go. Good. Very good. So judges, turn on your cameras. Great. And before I let Aina go, I do want to say a few things about our judges. We didn't go into detail in the introductions, but our judges are awesome. And part of the awesomeness of the judges is 6 are former New Venture Challenge participants. 3 are very successful entrepreneurs, Matt Maloney, Caitlin Smith, and Jake Crampton. They've all created marvelous companies. And then we've got 3 venture capitalists, Ko Nakamura, Jay Das, and Brent Hill. So it is really just a pleasure. You know, you do it for 25 years and you have some success, and that success comes back. And I hope that happens with some of the teams this year. I should also mention about our judges, 2 of our judges were named to the Midas list of the top 100 venture capitalists in the world. And there are only 3 new ones named this year. 2 of them are our judges. Mar Hershenson of Pear VC, who is in there partially for DoorDash, and Ko Nakamura, who was in the New Venture Challenge, I think 3 times with Sozo Ventures, and his big investment was Coinbase. So congratulations to Mar and Ko, and welcome to all of our fantastic judges. And now we will move on to Aina, and Team Aina and Nisha, it is all yours.
Hi, I'm Nisha, co-founder of Aina. And at Aina, we can turn any room into your fitting room. Now more than ever, shoppers are relying on online channels to buy clothing, but online shopping can be a hassle. For one, there's no size standardization across clothing brands. Take a woman's size 8 dress, for instance. Here are all the different measurements of the same size dress for bust, waist, and hips from top clothing retailers. It's a complete mess. This leaves shoppers in a constant state of guessing for their size. It also results in a pile of returns. We surveyed over 700 shoppers, and 85% cited fit as their #1 reason for returns. This has led online return rates to be 4 times in-store rates. Additionally, we've talked to over 80 retailers, and they too worry about returns. That have cost the industry over $309 billion in lost sales in 2019 alone. Not only do returns falsely inflate sales, but it comes back to the retailers as a shipping cost, and that's only a small piece of all the costs that the retailers bear here. Retailers also struggle to attract new customers and keep shoppers engaged with their brand. I've seen these struggles firsthand while working as a buyer at Macy's and when I started my own e-commerce clothing line. Knowing that both shoppers and retailers are in need of a solution, we're excited to introduce you to Aina. Aina is a virtual fitting room plugin for a retailer's website. In the SaaS platform that we sell to retailers, we use augmented reality technology, where shoppers can see the item of clothing directly on their body in real time. And here's the kicker. All you need is your phone or laptop with the camera. Here, let me show you. In our mobile app, shoppers start off by creating an Aina account. We take their complete body measurements with our technology, which requires no manual input by the shopper. They simply turn in a circle, and within a matter of seconds, we've captured their head-to-toe measurements, and they're free to shop. Once on the retailer's site, we've packaged our experience in a try-it-on button found on each product page with 2 options, a first-person view and a third-person view. Shown here is the 1P view, allowing the shopper to virtually try on any item of clothing, giving the shopper more confidence in their purchasing decisions. With this, Aina is providing the closest experience to shopping in stores, thus reducing return rates by up to 60% and also driving engagement, resulting in increased conversion of nearly 10%. These have equal and significant impacts on the retailer's bottom line. So why now? It's because it is the perfect time for Aina's solution in retail. First, the apparel online market is growing much faster than the in-store experience. Because of this, retailers are investing heavily in this channel. I just talked to an executive at Macy's, but a meeting with the CEO about digital investments, a conversation which he noted a year ago wouldn't have led to much action, but now has been taken with much more urgency as their online business becomes a larger piece of their pie. With recent pivotal innovations in virtual technology, augmented reality solutions are top investments in this space, especially with virtual fitting rooms, where we plan to see a 5x growth by 2027. So here's what's currently going on in the space. At the very least, there are size recommendation tools, which require manual inputs from the shopper who find the experience frankly a hassle. Then there are photo overlays of clothing onto the shopper's body, which just shows how the item of clothing will look, but doesn't tell you anything about how it will fit. And then there are avatar views, which feels all too gamified for the user. All of this has left inefficiencies in this space, but has given us insight for our solution. With Aina, we're building our technology around our shoppers' need for a more personalized and realistic experience. That is why we're building advanced technology with live try-on views. So Pradesh, why don't you tell us about the awesome tech that we're building?
Thanks, Nisha. Having spent 6 years in the computer vision industry, I can certainly attest for a fact that virtual fitting room with live view was not possible to develop at a public scale until the end of 2020. Something changed in the last 8 months. AI made some recent breakthroughs in sparse regressed SMPL, as well as devices and cameras such as the LiDAR scanner that made it possible for freeform body analysis to be born. The Aina team not only leveraged this particular piece, but also built a patent pending on two incredibly unique and differentiated factors. The first one being its freeform body measurement, and the second one being garment rendering. Let's talk more about our measurement technology. Aina can measure you no matter where you stand or sit in front of the camera. This is something that is truly novel and has not been built into any other measurement technology to date. This has been tested with over 150 users and is about a 97% accurate. After taking your measurement, Aina puts together your mesh, vertices, and joints to create your personalized body profile to take things into account, such as your motion and how you behave in front of the camera. With all this, we are delighted to introduce you to our garment rendering technology, which is Aina's second component. Aina dynamically puts together all your joints and vertices together and creates a clothing in its distributed system and overlays it on top of you, which we call as a transfixing effect. In the last few months, we've iterated on several differentiated proprietary factors that have led to this innovation. And we take pride in being one of the world's finest garment-based body tracking systems. So what's next? Aina not only interacts with the end user, but also allows the user to interact with the apparel as if it were real. How cool is that? Lastly, we want the retailers to have a simple process. So we take the onus of converting all their tech packs into Aina-friendly garments and holograms, creating the wrinkling and texture effect that you see right here. We can do so at about 5,000 garments in an hour using a single VM. While we build our core technology, our strategic partners are helping us with financing, marketing, as well as growth and user traction, including the large ones. For example, we got accepted into the NVIDIA's deep learning incubator. Shazia, why don't you tell more about what our retailers have to say?
Thanks, Pradesh. Meet Seek Refuge, Aina's first customer. I'm the founder. I joined Team Aina after they approached me as a potential customer because I found the opportunity and team so compelling. The new Aina integration on Seek Refuge has resulted in customers spending 3 times longer on the website, and we anticipate it'll increase conversions and reduce returns. We've also worked with other beta partners to validate the technology. Over 150 shoppers have interacted with Aina through various brands. 92% said Aina helped them choose a size, with 85% converting to buyers. With such strong early indicators, we've had great responses from the retailers we've reached out to. We have ongoing conversations with companies like Levi's and Gap, have upcoming demos with Macy's, Poshmark, and Profound, and have 2 partners ready to integrate as soon as our beta is finished. And these retailers are excited. Our industry connections in the space give us access to execs who are thirsty for this tech and willing to listen because they know us. Macy's is ready to integrate as soon as we've got reference accounts. Poshmark finds Aina much more useful than our competitors and is pumped for our upcoming demo. And Profound already sees the potential for Aina to increase their conversions. Tess, why don't you tell them how we'll do this?
Thanks, Shazia. With my experience leading product strategy efforts for IBM Watson, I'm familiar with the agile nature of taking complex tech products to market. Our technology and our business sales cycle revolve around the constant iteration and tech enhancements. As our technology gets better, we can target larger customers with more complex silhouettes. We're currently in our pilot stage, focusing on the tech validation and retailer integration experience with Seek Refuge. We're tracking metrics such as click-through rates, conversion, and returns, as well as getting feedback on the customer journey to help enhance our product. By this Thanksgiving, we'll be able to onboard a few small retailers who are already in our pipeline as our reference accounts. Here, we're focusing on e-commerce brands that are selling basic wear because this is where our technology is most advanced and where we'll be most effective for our customer. At this point, we'll also begin our sales cycle with some larger retailers, attending industry conferences and leveraging contacts in our own networks. So by this time next year, our goal is to onboard our first large retailer. At this point in our technology's evolution, we plan to offer more complex silhouettes, such as occasion wear and denim, to help attract these larger customers. We'll also be building in our retailer integration dashboard and a Shopify app. To scale Aina in the coming years, we'll leverage the virality and FOMO of this very exciting and highly sticky technology, as well as PR and proactive marketing efforts as we target more large retailers. Now, obviously, it's a long way out, but we have considered opportunities for acquisition. In fact, Walmart announced last week their acquisition of our competitor Zeekit, and Amazon has made some acquisitions in this space as well. This leaves us confident that we are in the right place at the right time. So as we think about our pricing solution, we have a simple SaaS revenue model. We're charging our customers a monthly subscription fee based on their monthly active users. Shown here are the annual amounts. Our long-term goal is to target large and extra large customers, such as Madewell or Macy's, where their ROI can reach 35x as we help them to lower their returns and increase their sales. There are thousands of these retailers out there, which have a combined TAM of over $10 billion. In order to acquire an extra large retailer, we'll spend about $95,000 in customer acquisition costs, which includes marketing and sales efforts, as well as $83,000 on technical onboarding related expenses. Charging a monthly fee of $125,000 leaves us with about a month and a half payback period per customer. Once a customer is onboarded, our expenses are primarily made up of application hosting expenses, R&D, as well as the cost of our engineers and employees, which leaves Aina with a 31% profit margin. By strategically targeting large and extra large retailers, by 2025, we'll have onboarded 200 retailers and hit $43 million in revenue with an EBITDA margin of 28%. So how are we going to do this? Our team is super passionate about Aina. All 4 of us are excited to continue working on this beyond the MVC. We have 4 fantastic advisors with expertise spanning retail and deep tech. And given that this is an innovative space, we need a highly specialized tech team. We have domain experts in computer vision, AR, VR, and graphics. Together, we're raising $1.3 million to launch Aina and onboard our first large retailer in the next 12 months. We're also seeking additional retailer contacts. Thank you so much, and we're excited to take your questions.
Great job, Team Aina. Give us a sec here to reset the clock. Hang on one sec. The clock needs to get 13 minutes. There we go. And whenever you're ready, Team Aina.
Thank you. Laura, I think I saw your hand first.
Hi there, thanks. Really great presentation. I think, this definitely is a customer problem to solve, or a consumer problem to solve, and I think a merchant problem to definitely solve, only accelerated by the pandemic. My question is around your target customer. I hear you clearly saying you want to go up and to the right to enterprise customers like Macy's and large retailers. I get why, makes sense. But one of the big post-pandemic themes that at least we've been seeing is the rise of Facebook Live platforms or other live platforms, where a lot of clothing boutique and SMB players are really starting to scale in a maybe more of a niche mass way, but they're doing a ton of commerce business. And we know that social platforms especially are really investing in this space. And you mentioned Shopify as an integration, and Shopify is still much more mid-tier SMB. So take me through your rationale again for why larger retailers, and take me through how you're thinking about perhaps looking at more of the SMB boutique clothing retailers as perhaps helping the virality of your product.
Yeah, thanks. Nisha, do you want to take that one?
Yeah, so we're really excited to partner with our large retail partners, and we have talked to retail partners of all different sizes. The retail partner relationship is definitely for initial customer adoption, and we definitely understand that larger retailers have strong partnerships with their direct brands. And so we think targeting these larger retailers will help capture not only their larger retail market, but also the smaller channels as well. But we do understand that the smaller D2C players are starting to grow, especially with the shoppers' loyalty and brand base. And that's something that we definitely want to get into and continue, especially with our Shopify plugin integration, so we can tap into that social sharing as well.
Thanks. Mar, I see your hand up.
Yeah, can you address what you think the critical elements of your competitive moat are, and in specific talk about your principal claims in your patent and how that matches up against the rest of that landscape from an IP perspective?
Yeah, absolutely. I think that's kind of two questions. If we want to start with the competitive advantage, Nisha, and then we can pass it over to Pritesh to talk about our IP.
Yeah, absolutely.
That's slide 43.
Thank you. So in terms of our competitive advantage, we feel very strongly about them. For one, it's the perfect time for Aina's solution in the retail space. Not only is e-commerce becoming a larger piece of the pie and continually growing, leadership at retail companies are starting to focus here and invest here. And from a tech standpoint, the base technology of Aina was only made possible in 2020. And now we're building out our own portfolio of IP that will protect our tech and continue to grow. We've also made a lot of strong retail relationships with key players in the industry and at the right decision-making levels based on both mine and Shazia's networks. And we've stood out in the space amongst our competitors when we've talked to retailers because of our product differentiators that are providing more personalized and realistic experiences with live try-on views, input-free measurement technology, the ability to show the shopper the accuracy of fit down to a size level, and being able to show them that in real time. And lastly, once we've onboarded a retailer, the switching costs to move to a different platform are high. And so retailers will be more willing to stay with us and our suite of tools in the long run. Pritesh, if you want to take the tech and our patent side of it.
Yeah, of course. Slide 58 can help a little bit on that. But our IP portfolio has gotten like 4 different, very unique and innovative components that no one else is doing, and we've built so far. So basically taking in spatial depth as well as garment-based body tracking as you interact with the camera and as you interact with the apparel, creating those textures is something that we do uniquely. On top of that, action to interactivity engine, the software that we've developed behind, is something that is very unique to Aina. For example, you move this t-shirt, it moves up. That's something that we've developed, and that is something that is protectable. We also do freeform body measurements, as I demonstrated before. So given that we've already done so far, we are also building more IP in terms of we're doing designs as well as we are doing prior art searches. That is what will differentiate us, and we are working towards building our IP portfolio, if that helps.
Thank you. Mara Hershenson.
Hi, I have a question regarding the ROI to retailers. I think I don't know how, I think you said you were targeting around $1 million in ARR. I don't know per garment, how much do conversions increase? How much do, returns reduce? And what is the cost per garment per retailer? If you could talk about the ROI, that would be helpful. I don't know if you've run experiments to measure the impact of your solution.
Yeah, Nisha, if you want to take that, and ROI is on page 50.
Yep, absolutely. So when we're looking at the different structure breakdown, we're really looking at a value proposition of being able to reduce return rates by 30% and increase sales conversion by 3%. And this is comparable to other competitors in this space. So as you can see from an extra large retailer, they'll be able to save, say, $24 million in return, but on the other side, also save $30 million in sales. And because at a SKU level, it's very much driven by how much traffic comes to that specific SKU. So we've been looking at it more on a MAU level, and this is something that we're definitely going to continue to track during our beta phase as well.
Thank you.
Thanks. Jay?
Oh, sorry. Yeah. Sorry, I was on mute. Couple of questions. First of all, on the back end, how do you guys plan to get all the garments and everything sized up? Because you focused on the user and the customer, but like if you go to Macy's or one of the big retailers, they have millions of SKUs, right? So that's one question. And the second one, why were companies like TrueFit and Bold Labs not successful? Because they've been around and providing the same kind of concept for a while.
Yeah, let's start with the first one, Pritesh, and then we can take the question about TrueFit.
Sure. Let's go to slide 40 to get help on this one, to visually interpret this. So basically, retailers have tech packs. These are images of front and back silhouettes on how they look. From that point onwards, Aina has the technology to take those images and convert it into holograms, as I demonstrated, and create those wrinkles. So we pre-learn different types of t-shirts and garments, and we know how to process them. So once they put in the tech packs, and once we get the security certificates exchanged, We have a runner that processes all of that garments and stores it into compatible JPEG and other formats that we can really utilize and transfer. And then from step 2 to step 3, we reconstruct those garments into something that we can use on our cloud processors and blob services. Once they move in from the blob services, it's like really very inexpensive to host them on the Aina platform into an embed iframe that retailers can utilize on their website or on their mobile technology.
So you can use like existing technology to kind of size the garments, like the pictures that they're taking already.
Right.
Okay. Okay.
Yeah, and metadata. But for the second part of it, I mean, I'd like to, for Nisha to talk more about the, base.
Yeah, so given the VFR technology that's out there in the space right now, specifically, let's say for TrueFit, they actually, one of their first customers were Macy's. And when we talked to them, they integrated back in 2012, and they just had a conversation, and they said that they haven't seen any return rate reduction or sales lift because of it. And it's very manual, a lot of customer friction here and trust. And so they're actually looking for a solution outside of this. And that's how we were able to develop a relationship. So there hasn't become a widespread VFR technology out there yet. And that's where we're trying to position Aina right now.
Okay, thanks.
Thank you. Caitlin?
Absolutely. So first of all, really impressive, super cool. I am probably part of the absolute problem for these retailers, and that it's very difficult to find things in my size, and every size is different. So you should see what my returns piles look like. But that brings me to the challenge or question that I have for you guys, which is, can you charge retailers more? I imagine they are paying a crazy amount of money for these free returns, and this is only going to increase. And so a technology like this could enable them to get rid of a lot of stores, which also cost them a lot of money. So you don't have to answer it right now, but just to probe on that.
Yeah, thanks, Caitlin. That's fantastic feedback, and definitely something we're going to be tracking as we kind of go through our beta test to see if we can track some of these metrics, but certainly hope that we'll be able to charge more. Thank you. Brent, I see your hand.
Yes, this is not my sweet spot or the right language, but I'll try to ask it. Can you layer or accessorize the cross sellers and add necklaces and cardigans and shoes and other things to increase the average order value as well?
Yeah, Brent, that's a great question. That was great. No, that's definitely something we're thinking about. We have, a long-term pipeline of some really exciting things that we want to add, some gamification as well as, additional kind of social media aspects. And so I think that definitely plays into it and is part of our long-term strategy.
Yeah, and to add to what Tess said, there are analogs, including Warby Parker for glasses and, Adidas for shoes, which already exist out there. So that technology is already proven. We want to prove the apparel space, which hasn't been so far. So definitely possible for us to do.
Thanks. Koichiro, I'm sorry if I mispronounced your name.
Hi, thank you. It was a great presentation, and congratulations on the success. My question is, why you are going for the retail side? I mean, considering the onboarding process of your technology, big fashion brand, fashion maker is more easier to implement your technology, such as H&M and fast retailing. Why you don't start those segments? Because they are ready to implement your technology, more infrastructure side. So if you want to, I can connect to the Muji fast retailing directly.
That would be fantastic. Nisha, do you want to take the rest of that?
Yeah, no, that's fantastic. And I think we would love, to eventually partner with a lot of the larger fast fashion retailers. And right now, with the technology that we have, we're perfecting on the basics in denim wear, and eventually we'll get to a point where we can keep up with the fast fashion. But a brand like Muji would be also very perfect for us, and it's part of our targeted retailer list for sure.
Thank you. Linnea?
Hi guys, great presentation. We've spent a lot of time looking at AR and 3D imaging solutions, both in furniture, in cosmetics, so one, curious as to what lessons you've learned, because it has been a long road for those technologies. We actually have an investment in eyewear, virtual eyewear try-on, and the adoption curve is a lot slower than everybody imagined. It's very hopeful, very needed. And then the other thing that we've seen is in the kind of furniture and 3D imaging sector, a lot of the large retailers, and you mentioned this in your kind of potential monetization slide, have gone to either developing or creating their own solutions. And so I'm just curious, kind of lessons learned, and then how you think about the competitive landscape in the context of what some of these large retailers might look to bring in themselves or develop themselves.
Yeah, Nisha, do you want to take that?
Yeah, so I think for the first question, the lessons that we've learned are, especially coming off this pandemic, retailers are very much focused in this channel, and customers are getting more used to using technology in their everyday lives. And we use the successes of the Warby Parkers and Wayfarers with furniture and even makeup to translate to apparel. It's just we're trying to create an experience that is frictionless for both the shopper and retailer to use in their experience. And then in terms of your second question, Tess, do you want to take that one?
Yeah, sorry. What was the second question?
Oh yeah, no, the second question was, we saw, at least in furniture, you know, like the Wayfarers and Williams-Sonoma's doing a lot of their own kind of 3D imaging for their customers. And so what are you seeing for either some of the large retailers, or as Koichi mentioned, you know, some of the fast fashion brands? Are they doing this themselves?
Yeah, actually, sorry. For the large retailers, they're very interested in this kind of technology. And I think for the retailers that we've talked to, they would prefer to integrate our technology and then build kind of around it versus build it entirely in-house. And so we've seen a lot of traction from large retailers to use kind of a third-party tech company like ourselves into their structure.
Great job, Nisha. Great job, Team Aina. Thank you very much. Sorry we couldn't get to all the judges' questions, but judges, if you could take a minute now and fill out the form. It's good. It's just posted to the chat for you. If you could fill out the form for Team Aina, and while you're doing that, we'll be getting our next team up, which is Team deetz. Don, if you want to go ahead and share while the judges are filling out the forms. Okay, looks like we've got Team deetz assembled. Let's go ahead and get the clock set. Donald, while the clock's getting reset, are you ready to go?
Yep, can you hear me?
Yeah, we can hear you perfect. So whenever you're ready, we're ready to go with Team deetz.
Hi, everyone. I'm Donald Garino, and I head up growth at deetz. deetz is a two-sided mobile marketplace connecting consumers to local businesses. We are addressing a massive problem for both people and small businesses in small and mid-sized cities. Right now, there's no good way for you to discover new businesses and stay connected with what's happening at the businesses you love. And on the flip side, businesses don't have a good way to promote themselves to a new audience. At the same time, there's a growing shop local movement. Mobile searches for near me information are growing triple digits, but people can't find the information they're looking for. And here's an example of what I mean. A deetz user outside of Des Moines recently sent this to us. She popped open Google, searched for happy hours near me, just looking for somewhere to get a decent martini, and discovered she was in luck. Just 2 miles away, there's a Napa Auto Parts. Having lived in smaller cities most of my life, I can tell you this isn't an isolated case. So how do we fix it? Well, at deetz, we help you find what's happening around town right now. We've got current information on all of your favorite local businesses because information on deetz expires within 24 hours. And how do we make that work? Well, for small businesses, what we found is if we make it easy for them to share information, they're happy to do it. And so we simply tapped into existing user behavior and built a convenient system that takes them less than 30 seconds to complete each morning. The business receives a phone call or text. They respond with what they want to highlight. It's transcribed with a fun caption. And then a few minutes later, it's on the app. And here's what the app actually looks like in our first city of Cedar Rapids, Iowa. So we've got an interactive map that has information on local happenings. And you can either explore it using a map view, or if you prefer, you can use filters in a feed view to quickly get to the information you're looking for, like where there's open patios, the best live music, or just a happy hour. There's a chat component that's localized to your city, and it's 100% user-generated content. And then lastly, we've got a perks page where local businesses provide experiences and teasers, like for example, a free round of mini golf or a margarita to further enhance your connection with their business. deetz is a live product, and we've been working on building this business since September of last year. We wrapped up the Techstars Accelerator this past December, and since entering the NVC, we've expanded from 1 city to 4 cities. We've grown our active users from 1,100 to 2,400 and increased the number of businesses on board by more than 3x. And here's how we acquire users. So using a recent example of our launch in Mount Vernon, Iowa, we piggybacked onto an event called Chalk the Walk, where hundreds of artists converge on this small town to draw chalk murals on Main Street. And at that event, we've got visibility in the retail storefronts, and we've got in-app rewards like wine slushies or a free ice cream scoop at local businesses, as well as being the technology partner for the event to replace paper maps with the deetz app, modernizing the event a little bit. After the initial launch event, we used paid social to target people with a bias for shopping local. What this looks like in Cedar Rapids, for example, there's 2 Facebook groups with a combined 28,000 people, or just over 10% of the population, geared towards shopping local. And after that, we not only continue to use those prior 2 channels, but we start to see more referrals through in-app rewards. And I wanted to share a quote from one of our users that I think really highlights the impact that we're having, as well as motivates us every day to get up and solve this problem. So Amy shared, "My daughter has autism and is an unbelievably picky eater. We almost never get to go out to eat. The other week, I was scrolling through deetz and I saw Cafe St. Pio was doing a grilled cheese special. I didn't even know they did grilled cheese, so we decided to check it out. My daughter not only tried it, but finished her entire meal. I can't thank you guys enough." And afterwards, Amy was even kind enough to post about her experience on Facebook. And she's not alone. There's plenty more stories like that. On the left-hand side of this slide, you can see a map of Cedar Rapids, and each dot here represents a different unique user opening the app on a single day. And people are creating real impact. An exciting statistic that we see is for every 100 users on deetz, approximately $1,500 is spent at local businesses found through the deetz app every single week. And that's why businesses love deetz, because they see actual results instead of getting buried by algorithms. On deetz, businesses are able to reach a highly engaged audience that's looking for something to do or someplace to go every time they open the app. So we've seen great results with businesses, but we figured out pretty early on that building relationships on a business by business basis was going to be really time consuming. And so we looked for an aggregation point and found a great partner in Chambers of Commerce. They're a trusted third party for local businesses, and they're even willing to purchase deetz in the first year to support their member businesses. And why are they interested in deetz? Well, they are desperate to help their businesses, particularly coming out of COVID. And right now, there just aren't any tools to do that. And with deetz, a chamber can advocate for a majority of their businesses every single day with minimal effort. To highlight this, when we branched out of Cedar Rapids into 3 other small cities, we did so after being purchased by the local chambers. And then a few weeks ago, we were asked to speak at the Mid-America Chamber Executive Conference in Sioux Falls, South Dakota, specifically around shop local initiatives using technology. During that conference, we were aggressively pursued by 27 chambers of commerce from all around the Midwest, all looking to bring deetz to their community and representing about 350,000 in demand, all from one conference that cost us less than $1,500 to attend. Which brings me to our expansion plans. Our goal is to perfect deetz in small and mid-sized cities that are the most underserved by existing technology, and then eventually branch into broader MSAs. We want to spend 2021 capturing the rest of Iowa and launching in the college town of Iowa City. In 2022, we'll further expand in the Midwest and run a pilot in Austin, Texas. That's going to be an important data point for how we scale outside of the Midwest. 2023, 2024, and finally in 2025, we will have captured the entire Midwest plus Texas and Arizona. Our revenue model is super simple. In the first year, our chamber partners pay an annual fee according to the schedule you can see on the left. In year 2 and onward, deetz takes that relationship with local businesses and converts them to paying customers at $49 a month. And here's what the economics look like for a single city. The 2 points I want to get across here are 1, we're profitable in any given city starting in the 3rd year, and 2, that our contribution margins from a given city are about 55%. In almost 9 months of operation, we've generated just over $60,000 of revenue, and in 5 years, we expect to hit 37 million. At that point, we project having over 6 million active users, 46,000 businesses, and company net margins of 20%. Here's the full-time team that's working on deetz today. Rahul is the founder and CEO. His background is in software engineering and product management at Microsoft and Amazon. Grace leads our marketing and user acquisition efforts, and her previous experience is around influencers, content marketing, and SEO. I'm responsible for business development and finance. So previously, I worked in commercial real estate with retail and hospitality. Rahul and I have known each other for almost 7 years and took deetz through Techstars together this past December. Importantly, all of us either grew up or currently live in the small and mid-sized cities that we're targeting. Joining us for the NVC as well is Maria Reinig and Satya Shedegar. Our ask is 1.1 million to continue to fuel our product development and expansion. With that additional 1.1 million, we plan to own Iowa and Nebraska, run our Austin, Texas pilot, and increase our week 12 retention to 18%. At deetz, we are a real business that's been in operation for almost a year. We're solving a significant problem in small and mid-sized cities, and we've got the right team and go-to-market to reinvent how people engage with their communities. And if that gets you excited, we'd love to have you join the deetz fam. And with that, we'll open it up for Q&A.
Okay, great. Thank you very much, Team deetz. Give us a sec here to reset the clock. And whenever you are ready to go, Team deetz. Whenever you're ready, Dan.
Hey, Mark, are you guys able to hear me?
Yes,
we can hear you, Rahul.
I'm not able to see any hand raises. Okay, there we go. All right, finally it's happening. First, we'll have Mar. Go for it.
Hi, thank you for the presentation. I'd like to ask you both about user acquisition and about retention. So if you could talk about what channels you guys are using, what % of the traffic is paid or organic on your acquisition. And second, once you get a user, what percentage of them stick around after 30, 60 days?
No, definitely. Thanks for the question. Grace, do you want to talk about the user acquisition, please?
Yeah, would you go to the user acquisition slide? So here I can talk a little bit about the channels that we use to acquire a new user, and that's through paid, owned, and earned. So we start with all of our paid socials. We do different types of events with pre-existing events, large and small, in all of the cities that we're in, especially for launch. We work with micro influencers, and most excitingly, and really new with some of our most recent launches, we've been working with some hospitality partnerships with the Hyatt, My Place, Marriott, and some independent B&Bs and Airbnbs. And then Raul, I can throw it back to you more on retention.
Yeah, definitely. So our quick retention numbers are week 1 retention is at 40 to 45%, and week 2 retention is at 25%. And our long-term 3-month retention is at 15%. Next question, Jake.
Very nice presentation. I'm interested in understanding a little bit about scalability. What's involved in going market for market? What it takes you 3 years to be able to break even?
Definitely. So in terms of, I'll speak on behalf of scalable technology, and Donald, if you could jump on the financials of that. So for us to go from market to market, it's predominantly just marketing expenses at this point, because our technology that we use to get that near real-time information is fully scalable, because we use automation every step of the way, from transcribing that phone call or text message, putting a catchy caption, summarizing it using machine learning models, and building a pin on the deetz app right away. So that part is fully scalable. In fact, we recently just launched our Instagram crawler that crawls all the social medias of active businesses and makes a pin out of that on the deetz app as well. So it brings an additional near real-time information for us. So it's for us to go launch into a new market. The techs exist. It's the marketing expense that would really be the catalyst. And Donald, would you like to take that?
Yeah, I can expand on that a little bit too. So as Rahul mentioned, there's a lot of user acquisition costs. Additionally, we have the chamber pricing in year 1, which we fully recognize is really just subsidizing our launch costs. Really, until we start to charge businesses directly, beginning in year 2, that's where we really see profitability come in.
Thank you.
Thank you.
Next, Laura.
Hi, guys. Thank you very much for the presentation. I actually went to the University of Iowa, so the notion of winning Iowa is, I guess, at least conjuring nostalgia for me. So I appreciate it. I also think, the underserved nature of small town America, intuitively and instinctively makes a lot of sense to me. But I saw your submission in one of my early judging rounds. The initial reaction I had was, wow, you're going up against some mighty competitors who know how to do the X near me really well, i.e. Google. And so the question I want to ask to you is, what really gives you the right to win? Is it just being in small town America and kind of culturally connecting, or are there other real modable aspects to what you're building that does give you that right to win?
Definitely, Laura. Hey, go Hawkeyes. I guess that's what, I'm a Cyclone, so.
All right, well, that's cool.
Satya, could you go to the consumer perspective slide, please? Another one, there we go. So Laura, like the biggest thing with small to mid-sized cities is, okay, so that's our major differentiator, right? Like we focus on small to mid-sized cities because right now there are over 250 million people living there, but all these existing big players that we have in play focus mostly on Chicago's, LA's, and New York's of the country. So there's a totally underserved market, like you mentioned, and in that market, what our major competition is people's existing behavior, because no one in Cedar Rapids is thinking like, hey, let me get on Yelp to make a dinner plan or something like that. And the location-based information that we use with Google, like Donald mentioned earlier in the slide, it's not bringing in relevant information. So with deetz, since everything expires in 24 hours and we're not a review-based system where it's saying like, hey, Jimmy went there last week and this is what he thought about the burger, we're more on the side of like, we go to the owner and ask them, what are you doing that day that you want the world to know? And we surface that near real-time information. So this really helps us present local relevant information in a market where the existing consumer behaviors are flyers, posters, and radio ads, and Google. And next question, I'll have Mark. Mark Leavitt, please.
Thanks, guys. Nice presentation. I have a question in terms of the types of retailers or businesses you see most concentrations, because coming from the restaurant space, it seems like a lot of what people are going to be looking for are restaurant reservations, but maybe in smaller markets that's less dramatic. I wonder if there's an opportunity for you to basically get a bounty from a resi or an open table for steering traffic their way. And the other part of that, having been an investor in resi, is do you think there's a way for you to get data on who you're sending to these various retail establishments as well? Because certainly that's where a big chunk of the value will come from, if you can figure out how to crack that piece of it.
No, definitely, Mark, you're spot on with that. Like there are tons of partnership possibilities like that. We've explored one with delivery.com where they were like, anytime someone sees an awesome food, they can hit deliver now, and we try to take a cut out of that. And definitely a partnership with Resi would be very good, because that's something people have been asking, like, hey, I like that and I want to just book the table right away. But the other question you asked, are we able to understand who are we sending to these small businesses? We're able to do that because one, through their phone number and their phone. And we're able to not only understand if they are a new customer to that business, who are they bringing with them, and are they coming back? And if so, the second time that they come back, are they bringing new types of people? And with that, combined with the average expense that people spend at these businesses, we can truly break it down to like, deetz brought in $300 in the last 2 days for your business, out of which 5 of them are new customers. Next question, Matt McCall.
Yeah, hi. So first of all, a huge pain point here. I've bathed in this space a couple of times between Foursquare and Factual and some other plays. And one of the big issues has been, so one, if you can crack the nut, there's a huge opportunity here. But getting the small businesses to update the information, especially if you have expiring every 24 hours, they'll engage, what I've seen is that they'll engage as long as they're getting traffic from you. So it's all a volume game, right? But you have a catch-22. So I guess the first question I have right now is, how do you get comfortable that you're going to have the businesses continually engaging and updating, and also that you'll have critical mass? So that's the first one. And the second one is just, is there truly the curse of the good enough? Most people Google, go to Yelp, have kind of a ton of options, but it's usually Yelp, and you can cut it 100 ways to Sunday, including special foods for autistic kids. And so I'm just wondering if the curse of the good enough, how you really get comfortable that on the customer side.
No, definitely great question there. Satya, could you go to the daily deetz statistics slide, please? So this is what we are currently seeing. So since we launched the daily deetz system of sending automated text messages, we've onboarded 140 businesses, and we've seen businesses share 3 times per week on an average. And a lot of these businesses are closed Monday and Tuesday. So on the 5 days that they're open, they share with us at least 3 times out of those 5 days. Sorry, I just got a message. So having said that, one thing we've noticed, you're spot on with that, like businesses keep using us because they see that it's driving them foot traffic from like little to like very little effort, because it's either like texting deetz in that 5 seconds, or the average cost of like getting someone to manage your social media right now is up to $1,000 a month. So businesses see the ton of ROI that they get from merely texting us and actually seeing foot traffic generate out of that.
How many customers, by the way, of the 140 on a given week do they get, each of those stores?
So that would depend on which bucket we slice it at. If it's a restaurant, we see a lot more than like, say, a boutique. A boutique might see like 4 to 5 customers a week, that like any given week. Also like depends on the seasonality of the week, if the weather is playing well. So we drive a lot of folks in terms of priority order, restaurants, happy hour places, and then like comes other like events and retail places.
And Rahul, if you'd like to, I'm happy to jump in as well on kind of the return that some of these businesses are seeing.
Go for it.
Satya, if you wouldn't mind going to that slide, and I'll just hit it very quickly because I know we have a few hands up. So we've got a couple of different types of business on here, and from talking with the businesses that we have on the platform, at our pricing, as a restaurant, they effectively need to hit 3 table meals. There's a boutique, 3 customer visits to get to that point. We're constantly sourcing feedback from these businesses because we want to make sure we're generating value as well. And so you can see down below just a couple of recent results. We're generating foot traffic well above what they would need on a monthly basis to justify the cost.
Thank you, Donald. Next, we'll go with Cristobal, please.
Hi, it's great presentation. Thank you. My question regards around your expansion plan. I think it all makes sense until you hit Austin, right? It doesn't seem to be part of small town America. Why Austin? Are there any other towns in Texas or elsewhere that you could try?
So yeah, sorry, great question. So the reason we're picking Austin is because we understand that, like, at least from the market that we're operating in, the weather plays a major role in terms of how people interact. And when the weather is warm and sunny, people are just like exploding on the app. And then when it gets rainy and gloomy, not so much. So we wanted to like try a staple city like Austin, or like a warmer place on that side, where there's a lot of velocity of information, but also good weather to like be a catalyst for that. So that's the reason we're trying to pilot it out. How does it work in a big city like Austin, and just learn from that while we're focusing on Midwest in the next 4 to 5 years.
Okay, thanks.
Yeah, thank you. And next we have Linnea.
Oh, hi, Linnea. Thanks so much. So we've seen actually, I mean, this is striking a very kind of hot theme right now. And so I know Redpoint just backed a company called Nearby, started by April Underwood. So just curious, I know you touched on starting in these very much more regional as opposed to metropolis markets. What other competitive differentiators, and how are you looking at the land grab, given there's a good amount of funding going into the shop local theme?
No, definitely. That's a great question. Satya, could you go to the competitor matrix, please? So if I'm understanding your question right, like you're asking, hey, how do we differentiate ourselves, and how do we hope to like get more of this market share in the small?
Yeah, I think it's, you know, the big guys, you know, they're very broad. So I understand that differentiation. But there's been a number of startups, you know, just over the past year that have received funding. So do you see yourselves as having a very differentiated strategy or technology that helps you know, create a moat?
Definitely. So our biggest moat right now is the daily deetz system that's like fully automated, that helps us scale pretty quickly in all of these markets. And that coupled with the expiring content, which is a really good novel way to address this problem, because it takes out a lot of noise out of the existing methods. So with these two, that really helps us stand out and like create a moat where our whole business model is around expiring content and feeding that through proprietary automation that we do.
Great job. Thank you very much, Donald, Rahul, and Team Deetz. We did leave one question. Sorry, we couldn't get to all the questions here. Judges, if you could take a minute and please fill out the feedback form. It is going to be, it has just popped up in the chat for you. So if we could go ahead and do that. And if we could go ahead and start getting, let's put up the intro slide for Team Ping while the judges are filling out the form. Team Ping, if you want to go ahead and get your cameras turned on, and go ahead and turn down the music. Very drastic. All right. Looks like Team Ping is here and ready to go. Sean, are you guys
Yeah.
ready? All right.
Absolutely.
Whenever you're ready, go ahead and go.
Hi, everyone. My name is Sean, founder of Ping, a wearable tech company that is centered on the safety, wellness, and social connection for our elders. America is facing a huge aging problem. By 2030, demand largely outweighs supply for caregiving. It's a big problem, and it's only getting worse in the future. The number of caregivers drops to less than half in 30 years, which begs the question, how can technology increase productivity for caregiving? At Ping, we help solve this by making caregiving more efficient. Our custom hardware is specifically designed for elders. The device is LTE enabled and is ready to use out of the box. Their families and caregivers can use our software to program and stay connected. We're B2B SaaS-based, and we sell to senior living and home care companies. We offer free hardware, and initial contract is 1 year. Since ideation in October, we developed the MVP in 4 months and filed our provisional patent on an automatic fall detection algorithm. Today, we have sold over 300 units and acquired 9 B2B customers. Given what we learned, we found the success formula of combining safety, wellness, and social connection into our differentiation. For safety, we incorporated automatic fall detection, a help button, and GPS tracking for dementia patients. If the person remains sedentary for too long, the family and caregivers will also be notified. Regarding wellness, Ping monitors heart rate, activity, and sleep. And we added temperature and blood oxygen to be more COVID relevant. The elderly can be reminded to take meds, drink water, and make doctor's appointments. The daily check-ins ensure these actions are taken. There are also mood check-ins to keep families up to date on the mental states of their elders. The last pillar is family connection, which is meant to engage the family and encourage the elderly. For instance, the children can be notified on positive behavior like walking 2,000 steps and send a kudos to mom. We've added walkie-talkie and check-ins for the family caregivers to make sure that they're managing stress okay. With that, I will hand it off to Kat to discuss our competitors.
Thanks, Sean. A number of businesses are competing within the wearable space. However, Ping is well positioned in the market. For example, competitors such as emergency alert systems can help elders who cannot signal for help. Yet compared to the market leader, Life Alert, most seniors we've talked to don't like wearing a plastic box. It makes them feel old and reveals nothing about their health. Ping, however, differentiates itself by providing automated alerts for fall detection and real-time connectivity of vitals. And compared to consumer wearables in the market, such as Apple, their feature-rich design and small buttons can be overwhelming to seniors. Ping differentiates itself through its simple senior-centric design and niche market strategy. And when compared against other elderly smartwatches, most competitors pursue a B2C business model with high marketing and distribution costs. Ping, however, provides a competitive price and follows a B2B approach where acquisition costs are reduced and retention is increased. Now, why are there so many competitors within this space? Because the senior care market is huge, and with the aging of baby boomers set to increase senior spending from $740 billion to $1 trillion by 2026, Ping is well positioned to take advantage of this growth. Currently, senior spending is $180 billion in home care and senior living centers, of which $3 billion is spent on monitoring devices. Ping plans to address this market through a B2B distribution model by selling our software as a service and using the hardware to increase revenues for our B2B customers. I will let Will speak to our initial target market.
Thank you, Kat. Our B2B approach is hyper-focused on 2 segments, home care and senior living. Because Ping offers line of sight to family members and caregivers during unmonitored time, it's an ideal solution for seniors who want to maintain independence or those who wish to age in place. Since these segments are both private pay, families can afford this service. By not targeting through Medicare, we further differentiate ourselves from our competitors in the RPM space. We plan to target the top accounts in these segments in our initial rollout. We'll go to market by piloting a single location per account. From there, we'll move up through the corporate office for multi-facility implementation. Our 4-pillared approach begins by using our comprehensive targeting list, including all key decision makers. Starting locally will enable us to build relationships with facilities affiliated with larger chains. We'll assemble an experienced sales team of direct sales reps and distributors, each with a strong Rolodex and deep experience in senior living. And finally, we'll leverage business groups to get face time with key industry players. We began implementing this strategy in February, cold calling 20 businesses and landing our first customer. Sean then joined the Illinois Continuity of Care, a business group consisting of 700 executives in our target markets, resulting in our next 5 customers. This recipe has become part of our secret sauce. Joining industry-specific groups gets us face time with decision makers, and our hit rate on requests for meeting has been 50%. One of these meetings led us to Katie, who's the GM and owner of Comfort Keepers in Elmhurst. Katie told us that by offering a superior product at a lower price, replacing her emergency response system with Ping would be a no-brainer. And now that we're getting phenomenal interest from our customers, we've expanded our sales force with 4 distributors to help take our secret sauce and scale it to the next level. They brought in the 3 most recent deals and were so excited about Ping that they gave us a free 2-page ad in Seniors Blue Book, a $10,000 value and a reach of 100,000 people. Utilizing distributors and our current sales outreach, we're in active discussions with 6 more companies, and we have 5 prospects on the horizon. And now I'll pass it to Adnan and financials.
Thanks, Will. The way that we make money is very simple. We charge the senior living or home care centers $29 per end user per month for an initial term of 1 year. That's it. We do not charge our customers for the hardware. And the reason why is because we wanted to remove as many barriers to adoption as possible. Many of our customers have expressed a heightened level of excitement upon learning that we plan to provide the hardware for free, which has helped us to drive sales early on and is early evidence that our pricing strategy is working. On the cost side, the cost of the hardware is $35, which means we'll be able to recoup this cost per user after about 5 weeks. Also worth noting that we are hardware agnostic and that our IP lies within our software. We also pay $13 in total per user per month for Verizon and AWS for fees to operate our product. After factoring these costs, we make $157 of annual gross profit per unit, which translates to a gross margin of 45%. On a per facility basis, our average annual gross profit is almost $13,000. This brings me to our 5-year financial projections. In order to determine how many facilities we can convert to paying customers, we took both a bottoms-up and a top-down view and looked at the number of full-time dedicated sales staff we plan to have and considered how many sales they could close each month of the year based on our recent experience. We plan to hire 2 full-time sales employees in the 4th quarter of this year. And after their requisite training, we think they'll each be able to close 2 customers a month on average beginning in 2022. We have also recently partnered with 4 key distributors who have strong relationships with many of our target customers. These distributors are paid on a purely commission basis, which significantly reduces our fixed costs. Between our hired sales staff and our distributor partners, we believe we'll be able to close 96 facilities in 2022, and then double that number each year for 5 years by adding additional sales reps and by benefiting from network effects. If we're able to meet our customer capture goals, we project we'll earn revenue of $1.3 million in 2022. And with the benefit of recurring revenue because of our SaaS model, we project this number will jump to $60 million by 2026 with an EBITDA margin of 18%. And now I'll pass it over to Nikki.
Thanks, Adnan. We have a strong, experienced team. Sean is an engineer and 2-time founder, most recently of a wearables company. Tihu is our program manager in China that coordinates our manufacturing. Isaac has 8 years of experience in healthcare analytics and over 80 citations in academic journals. Will has a decade of experience in customer-facing roles in the wellness and fitness industry. And Adnan is a CPA that supports clients in the manufacturing and tech industries at Deloitte. Our NVC team supplements our management team, providing functional knowledge in operations, product, marketing, and software. And we've chosen advisors that are the best in their fields. Bob from AARP provides us introductions to home care and senior living organizations. Peter from Facebook is an expert in the legality of data privacy and helps us ensure that our customer data is secure. Adam sold his wearables company Rhythmio to Nike, and Steve is an MD and prominent healthcare investor and entrepreneur. We are asking for $1.2 million to bring Ping to the next level. This money up-levels our MVP and enables us to create our customer support ecosystem of 4 employees, which will allow us to win contracts with 5 national franchises, each with more than 100 locations. Now, I'll pass it back to Sean to tell you more about what this funding means to him personally.
Thanks, Nikki. The idea of Ping struck me as I was looking for a solution to check on my grandparents who live in Beijing. The company is named after my grandma Ping, which means safety and peace in Chinese. Our goal is to keep our beloved elders safe, well, and socially connected. We invite you to join our mission. Thank you for your time.
Great job, Ping Ping. Let's give us a minute here to reset this clock to 13 minutes. You've got questions, so whenever you're ready to start.
Excellent. Hi, Guy. Good morning.
Hey, good morning. Thank you. Nice work. I'm curious, what level of engagement beyond just emergency alerts do you think is necessary to achieve, the type of ROI that your B2B partners are going to want?
That's a great question, Guy. Thank you. The first pillar we mentioned is safety, which is what emergency alert falls under. The second part is wellness, ensuring that our elders are healthy. And the third piece is coming from an angle of combating social loneliness and isolation, being able to convert that data into families so that they're able to see that our elders are taking positive life actions and be able to get the family involved.
Yeah, that feels like a very high level answer to a question that was looking for details. Do you want the elder to have 6 different interactions with a wearable every day? And the reason why I'm asking is you can do emergency alerts right now with something that, either never needs to be recharged or is recharged very, very rarely. I believe in your case, you're going to need to recharge fairly often. And there's a cost and an effort to that for the staff at these places. And so there needs to be something more than just, these nice words.
Absolutely. From a technology standpoint, because it has a lot of our smarts embedded, it would be able to detect low on battery and have the vibration on the person's wrist, reminding them, as well as notifying the staff in the buildings. Mark, good morning.
Hey, good morning. Yeah, we've been in the space, broadly speaking, for software for home care. And one comment and one question. What comment is, you may want to consider trial in places that have single payer, to actually get tangible ROI data in terms of how you're improving actual health outcomes. We were surprised how relatively easy it was in places like Singapore, Canada, even in the UK, to get certain things going. And then secondly, getting back to this ROI question, your positioning, I'm not hearing a cost reduction argument, and these are low margin businesses that you're targeting, right? And so is this really about you're going to help them market better and acquire more customers? And if so, how do you qualify and who do you focus on to make sure you can make that pitch early on most effectively?
That's a great question. Thank you, Mark. I would love to invite my teammate Will to address success metrics.
Yeah, Isaac, if you could pull up the success metrics slide on slide 67. So Mark, you mentioned labor reduction costs, and that is something that we'd hope to accomplish using Ping, making rounds and things like that a little bit easier. We also have a way for them to increase their profits. So we charge $28.99 per user per month. Should the facility want to charge an additional $50, they can make an actual tangible financial profit from partnering with Ping. You'll also see that we can, for home care, increasing billable care hours a couple of different ways, using data evidence to show that somebody might need a couple additional hours, to your point, using the watch as evidence for that. And then also incentivizing for additional care. So let's say there's a threshold for Ping to be provided to the consumer for free, given our partnership with the specific home care agency. They would up-level their number of hours that they're taking, and they would get Ping as a result, a value add to them and more hours billed for the home care agency.
Okay, that assumes they're a private care agency, right?
Correct.
Absolutely.
Correct. Our initial strategy is targeting all private payer.
Yeah.
Thank you again for the question, Mark. And just to provide an example for using data evidence, for example, if the caregiver is at home for 4 hours in the day, but the rest of the hours using data, we can show that the elderly person isn't moving around much. Then that's hard evidence to show to the family that perhaps there needs to be more caregiving hours. The second part is incentivize for care. GrandPad, for example, is a prime successful company that's valued at 80 million. And one of their current strategies is to incentivize more hours in order to get a tool, a tablet that allows better family connection.
Thank you.
No problem. Hi, Mar. Good morning.
Hi, I have a question. I'm sure you've received this question before, but do you really need your own hardware? And especially at the beginning, could you run a pilot that would get you some form of initial data on the, on the outcomes of using this system early on? So, I would say buy a few, concentrate on the software, send some Apple Watches, and see what the impact is in some of these facilities to the previous question. I'm mentioning this because I have an older dad and he's been using the Apple phone, and it's great. You can adjust it so it's for older people. So that's a question.
Excellent. Thank you, Mar. In terms of partnering with an existing hardware provider like Apple, we're a startup, and our train of thought is to come up with the easiest MVP as soon as possible to test out our theory. Partnering with Apple would be a much lengthy process in that case. I myself come from an engineering and hardware background and have good supply chain connections in China. Because of that, we're able to have quite a bit of control on the design of our product. And I would also love to invite our teammate Catherine to speak a little bit more about the rest of hardware providers and competition.
I wasn't saying to partner with Apple. It's like just, you can build a software only first and test it with some existing hardware before you decide to build your own hardware. That's what I was saying.
Jake, hi.
Hi there. Wondering if you could comment on sort of market behavior now within the senior care arena. What share of senior care facilities are providing this as a value-added service today? Are you trying to create a new market, or are you trying to supplant other players?
That's a great question, Jake. Currently, with the two segments that we're going after, first is senior living, and the second one is home care. About 70% of these companies currently provide something like a personal emergency response system, Life Alert, for example. Our idea is that instead of providing safety only, we have the wellness piece and also social connection, which is a far more superior product. At the same time, our price is lower, allowing them to make higher margins.
Great.
I have a Dan.
Yeah, guys. So I've had conversations in this market for some time now. And one of the things I'm kind of curious about when it comes to what you guys are building is the level of integrations that you are expecting to have, like EMRs or any other types of like technologies that these senior living facilities, for example, may have or may not have.
I would love to invite my teammate Will to elaborate a little bit on the customer experience side as far as programming and connecting with other types of services. But really quick is that this is completely programmable so that families, local EMTs, for example, and also call centers, which we plan to eventually outsource, could be notified when the help button is pushed or when the automatic fall detection is triggered. Will, would you mind elaborate a little bit more?
Yeah, Van, so just so I understand your question, you're talking about integration with other products?
Integrations with other health record technologies that these facilities might use, or other types of like platforms they may be using or experimenting with right now.
Yeah, so as far as integration with other tech platforms,
in terms of EMR, Van, that you mentioned, I apologize that I kind of misunderstood. the private pay market that we're going after is specifically non-medical. So home care is different than home health, which does care about EMR. We're more consumer facing in terms of the clients that our customers take care of. So in terms of integration, Isaac, would you mind talking about an optional dashboard which allows the facility and home care to be able to see their clients?
Sure. So this right here is a dashboard that we're making, and we provide to facilities if they need it. So this one collects information from a lot of residents that are within the home care facility and tries to aggregate them. So you can look at them on an individual basis, or you can look at them as an aggregate whole. And so this is one way that we're trying to help bring all these vitals information and then aggregate them in a place that's very close to the system that they're currently using.
And just add on to that, our data is going to be stored on Amazon AWS. So Kevin, would you mind elaborating a little bit on the flexibility that we have as far as where to integrate the data into?
Sure, thanks, Sean. So AWS is a large suite of apps that help facilitate exactly what we're trying to do. They have a lot of experience with other medical startups that have done not necessarily what we're doing, but have similar needs in terms of HIPAA compliance, as well as dealing with these biometrics that are going to be coming in and out of their system. So we've actually had a couple of talks with them about different services, their IoT core service, their AWS Greengrass. We have a lot of flexibility there on data storage with S3 buckets. They give us a lot of flexibility on how to implement this. And it's very comforting knowing they're going to be able to take care of the HIPAA compliance that we need to ensure we have for the privacy of our customers.
Thank you, Kevin. We'd love to get more hands up and answer all the questions that you may have.
Judges, any other questions before we wrap this one up? All right, thank you very much, Team Ping. Judges, if you could take a minute now and fill out the feedback form. It is in the chat. And while we're doing that, we'll go ahead and put up the announcement for the next team. Okay, it looks like the judges are pretty much ready. Let's go ahead and start. The Team SHEVOLVE wants to go ahead and turn your cameras on. And Dasha, if you want to go ahead and start to share your slides.
I got it.
Oh, there we go, Kyle. All right. Looks like all the judges are ready. And whenever you're ready, Dasha.
Great. So I know we're fast approaching lunchtime. So let's talk about nutrition. Hello, I'm Dasha Shore, registered dietitian and founder of SHEVOLVE. At SHEVOLVE, we make nutrition supplements more convenient and more enjoyable. Our flagship product, SHEVOLVE Daily Bites, is designed specifically to support women through midlife and beyond. So this image might be a very familiar sight to many of you. Some of you or your spouse, your partner, or someone you know has a drawer or a medicine cabinet just like this. And each of the dozen of women I interviewed certainly has one. So let's meet Melissa. Melissa is 49. She tries to take 7 of what she calls horse pills a day, and she absolutely despises her supplement routine. And this is simply because the products currently available on the market are not meeting Melissa's needs. The pills, capsules, and powders are stealing the joy away from self-care. The formats are inconvenient, have a ton of added sugar, and have questionable ingredients like palm oil and soy lecithin. We need to do better than that. So let me introduce you to SHEVOLVE. At SHEVOLVE, our solution is based on 3 simple principles: taste, convenience, and science-backed nutrition. Our first product, SHEVOLVE Daily Bites, delivers essential nutrients in one delicious and satisfying bite. The soft and chewy bites come in flavors like vanilla bean, orange cardamom, and lemon bar, and they look just like this. And they fit Melissa's routine perfectly, whether it's morning coffee, afternoon tea, or the happy hour with the girlfriends. So let me tell you a little bit more about what's in our bites. We start with a very simple foundation of whole foods like dates, almonds, honey, and lentils. Yes, lentils. We actually figured out how to make delicious lentil products that are tapping not only the nutritional profile of the lentils, but also create a product that meets the clean label expectations of the modern consumer. Then we'll leverage our nutrition and health science expertise to deliver just the right nutrients women need in amounts that are not currently present in multivitamin or gummy formulations. And each nutrient is carefully selected to meet Melissa's needs. And in case you're wondering, we're not regulated under the umbrella of drugs. We're regulated under the food as a nutrition supplement, and we will not require any FDA pre-approval to enter the market. And in fact, we've already sampled our product with 60 women and counting. Our pilot group has been great at providing feedback on everything from taste to texture to packaging design to our communication. And they're supercharged about SHEVOLVE and the opportunities that it provides for nutrition. So now I'll turn it over to Dr. J to tell you exactly how we're going to stand out in the supplement market.
Thank you, Dasha. Looking at the sea of sameness, we will be the first clean, food-based product in the supplement aisle. Let me dive into our competition. There's nothing like SHEVOLVE currently on the market. This is a small fraction of the players representing different formats, but as you can see, we are the only product in the entire industry that targets the age 45 and above population, is plant-based with whole foods as a foundation, is packaged to be consumed daily, and provides personalized supplemental care. Our subscription model will ensure women will not miss a day in their nutrition routine. We will use our differentiation from pills, gummies, beverages, and bars to win this audience that is looking for a tasty alternative to nutrition. With its flagship product targeting healthy aging, SHEVOLVE fills an enormous gap in the market. Less than 1% of innovation is aimed at older women adults, a group with acute wellness needs. And yet boomers and Gen X comprise over 40% of the US population and have distinct nutrition challenges. Our initial consumer demographic is 50 million women strong. SHEVOLVE is at the intersection of 2 large and rapidly growing markets, nutrition supplements and snacks. The markets are $80 billion in total and growing 8% annually. More specifically, there are 50 million women above the age of 45 that take at least one supplement daily and spend $110 annually. Our flagship product alone has a market value of $5 billion. Now I'm going to turn it over to Kylie for our go-to-market strategy.
Thanks, Jay. So our pilot program gave us valuable information about our customers' purchasing behavior. We also got confirmation that the taste, convenience, and essential nutrients are the 3 benefits that women associate with our product. We layered that information with consumer insights to construct our go-to-market strategy. Our marketing content focuses on communicating these attributes. We chose our marketing channels knowing that women look to their doctors and their friends for recommendations. In the next 6 months, we need to acquire 326 customers. In order to do that, we'll be working on education and relationships with health professionals and investing in consumer marketing. On the consumer marketing side, we already have active branded social media and recently started testing paid posts. We've launched paid digital marketing with Google Ads. Our website is carefully written to optimize for SEO. We have a handful of influencers we're working with to launch our affiliate marketing program, and we're continuously sampling with our pilot program. We'll begin sampling at retail locations, starting with Chicago Health Foods in early 2021. And in addition to in-store sampling, we'll have pop-ups at boutique fitness studios and coffee shops. We'll also be sampling with health professionals through our pop-up events, where we invite our SHEVOLVE network to enjoy a special event, such as our plant-based cooking class in October and our cocktail class in March. Over the next 18 months, we'll host 4 branded events, culminating with the SHEVOLVE Wellness Summit. These events will help us build brand awareness and buy-in in the medical community. We already have 2 members who are health professionals themselves. Dasha is a dietitian, Jay is a medical doctor. They're leveraging their networks to secure ambassadors like Dr. Reddy, an integrative physician and a SHEVOLVE ambassador. These ambassadors will help us to distribute samples to patients, co-create content, and serve as a voice for SHEVOLVE in media. Dasha also has 5 years of experience in public relations and health professional outreach, which will help SHEVOLVE build brand awareness quickly. In October, we'll continue to build relationships at the #1 nutrition professionals conference, FNCE, and in December, we'll be partnering with the top nutrition trade publication to tell the SHEVOLVE story. Our go-to-market is a hybrid of e-commerce and retail. We're starting with a subscription-based e-commerce model because we can stay closer to our customers and have more opportunity to refine our brand. While we're selling exclusively direct-to-consumer in the first year, we'll be focusing on driving brand awareness and continuing to gather feedback from each customer. By the time we launch on Amazon, we'll have gathered ample testimonials and reviews, and we'll have an active customer base, which is crucial for a successful launch. Although e-commerce is a huge and growing channel for supplements, it was up 20% year over year last year, we also need to be in retail, which is still where the majority of supplements are purchased. Next year, we'll enter retail through an initial test with Chicago Health Foods, a store that loves to feature local brands and encourages sampling. Later in the year, we'll start in our first locations at Whole Foods and Walgreens, both of which have specific programs to feature local emerging brands. Based on interviews, most women buy supplements either online, at Whole Foods, their pharmacy, or a combination of the 3. Now I'll turn it over to Dasha to talk about future plans for SHEVOLVE.
Thank you so much, Kylie. Once we enter the market with our first initial product for midlife and beyond, we'll be moving quickly to continue to iterate and innovate. And in fact, we already have 3 more products in the pipeline. Product number 2 will be Midlife Restore. From our interviews, we found out that women in that age group need help sleeping. With product that is targeting PM occasions, we'll be continuing to target this vulnerable and much needed demographic. Then we'll be expanding to other underserved areas and the moments where women are transitioning in their life. And so next 2 phases of womanhood is actually for women trying to conceive in a prenatal formula, and of course, a postnatal formula, expanding our platform further. And we already have an amazing team to bring this vision to life. I have 12 years of experience in the food industry, ranging from innovation, communications, and consumer insights. I'm joined by Siva, who has 17 years of experience in the industry as a very talented food scientist at CPG companies like PepsiCo and Nestle, and also over on the ingredient side. And we're joined by a medical doctor, branding, marketing, and finance experts. But that's not it. We will already build a broad bench of science experts that are supporting us from regulatory, nutrition communications, and of course, sports nutrition sites, so we can continue to conduct research and invest in product innovation. And we have strategic advisors supporting us on the innovation, marketing, communications, legal, and manufacturing fronts. Looking at some of the numbers for SHEVOLVE Daily Bites, this is year 2023, where we're available across 3 different channels, our e-commerce, Amazon, and entering retail. And as you can see, we have healthy margins, and they will continue to improve as we reach scale. So looking over the next 5 years, we'll be investing heavily in marketing and branding, breaking even later in year 3, so 2023, and reaching over $60 million in revenue by year 2025. But we cannot bring this amazing vision to life without you. We're looking for $1.7 million in investment. The majority of the funds will be allocated towards marketing and sales work, and of course, supporting our manufacturing and operating costs. And in case you're wondering, we have bright future. Looking at some of the comparable exits, we're seeing interest in this space, both from the pharma and also from the food industry. exemplified by a recent acquisition of NBTY by Nestle. So with that, we are here to help women thrive, and we thrive on feedback. So I would love to open it up to questions.
Great timing. Thank you very much. Let's get the clock reset while you get some hands up in the air. So we're ready to go with the clock whenever you are, Dasha.
Guy?
Yeah, thank you. And very interesting. And I can appreciate the problem you're solving with my wife, who consumes a number of things that seem like they could all go into one. The question I had is, you're pitching this as not in a bad way, in a good way, I think, as scientific and medical. And yet you're talking about distributing through Amazon and Whole Foods, which feels like it undermines that a bit versus being really more either direct to consumer or potentially through a healthcare channel. So just tell me more about that.
Yeah, that's a great question, Guy. So there are two parts to this. First, we need to attract consumers with our taste and convenience. So that's why we're starting with the direct to consumer e-commerce, very heavily branding and communications. But in this space, in that sea of sameness, we have to bring credibility to the table, because as you will see in the next couple of years, we will have the same tendencies in the space as we've seen in the food industry, where consumers started to lose trust in the product. So that combination of taste, convenience, and attractiveness of the brand combined with the credibility is very important to us. I'll turn it over to Dr. J very briefly to talk about why health professionals too, and why we're taking that
And sorry, just one thing to pick on there. Like focusing on taste first, it doesn't seem to be approaching the problem you're solving. Like, I get it needs to not taste like total shit, but
yeah,
you're not just a snack for people to consume, in which case you need to taste really good. It feels like that's slightly disconnected with the problem you're solving.
Yeah, Jay, do you have anything to add on that?
Yeah, so I think it's important that you are right that a lot of this is guided by health professionals. 90% of people do get a lot of their nutrition information from healthcare professionals and find it to be reliable. However, a lot of the spending comes from the consumer side. So we have to straddle those markets just a touch. And that's why we have a robust health influencers plan in addition to the digital marketing side.
Yeah, and Guy, if this is not answering your question as well, we'll connect offline after, and we'll be happy to chat. Yeah, Caitlin?
Hi there. Great presentation and really interesting product concept. I look forward to trying it. I think I saw them come in. My question is around the rollout timing. Why wouldn't you go faster with retail sales and Amazon?
Absolutely. Kylie?
Yeah, so the reason that we're taking the time before launching on Amazon is we want to focus the next year on really building brand awareness. When we launch on Amazon, they've taken away the ability to respond to reviews, and we want to be really mindful of having a built up customer base and testimonials before we go there. And so we'll be spending the next year prepping for that launch so that we can really hit the ground running.
And we've also seen that there's not really a right or wrong way to enter the market. With the rate the e-commerce and the supplement space has been growing, we are going to harvest that momentum and tap into that trend first, and then enter retail with a very solid product that consumers are ready to buy off the shelves.
I think you can do it faster.
We might be moving faster once we prove the product, but thank you for that feedback, Caitlin. Linnea?
Hi team, thanks. For some reason, I thought you had snuck into my house and taken a picture of my drawer, which has all my supplements in it. So it looks very familiar, which I think is, it helps define the problem, but also defines, I think, what will be one of your biggest challenges is that I get served on Instagram about 20 different supplements a day, either addressed at postmenopausal women, women over the age of 50. I'm also an investor in a company called Ritual, which has attempted to solve this in a pill form as opposed to an edible form. And so when I look at your competitive landscape, it seems very light relative to all the other supplements out there. And so I'd love to just see, and we can follow up on this, kind of how you really, I'd love to see you kind of differentiate more so you can rise above that Instagram, social media noise level for supplements, because it feels like everybody and their brother has a supplement. I also would suggest, back to Caitlin's point, that a lot of these retailers have accelerators. So I don't know if you've been involved in any or looking to get involved, but sometimes that can really help. Target would be difficult because I think they back Ollie, but there's a lot of good retail accelerators that look for brands like yourself.
Yeah, Linnea, thank you so much for your great advice and feedback. And yes, we're looking into accelerators after we complete Polsky Accelerator this summer. Kylie, if you could pull up the slide onto converging trends, 29, please. So one thing that I wanted to mention is that we are not just the easier to take supplement. We're actually tapping into another macro trend, which is the functional food and functional nutrition. But what will really set us apart in our format is that we're replacing multiple pills and multiple products that just can't deliver the same nutrition because of their surface area and the way they're manufactured. And so this is a truly unique formulation in the sense that you don't have to take your ritual multivitamin that is missing magnesium and calcium and take their calcium and magnesium formula on top. So that angle of eliminating the clutter, eliminating unnecessary supplements, plus delivering on that snack-like experience is where we are differentiating. But thank you for pointing that out. Lonnie?
Thank you. Can you speak to your current manufacturing and supply chain and how you'll go about scaling that with your success? And in addition, I was looking at your products on your website and did not notice the ingredients being listed. Are you using any organic sweeteners or artificial sweeteners, since taste is really important to what you're doing?
Yeah, Siva, can you please take that?
Sure. Lonnie, to address your first question regarding how we are set up to scale up from a manufacturing and supply chain standpoint, we have with my 17 years of experience in industry, have a lot of connections from various ingredient suppliers and have lined up potential suppliers to our core ingredients and primarily the nutrition mineral combination that we want to use, because it is going to be specific formulation to the target demographics we are going to address. And then also we have lined up manufacturing partnerships and some are in conversations from going from a pilot scale to a commercial scale. And then also we are in conversations as well as set up some arrangements for warehousing and distribution as we get this concept going. So, and on your second part regarding taste, the sweetener we are going to rely on is honey, which is a natural, and a lot of people prefer honey. So that is going to be the sweetening element in order for us to bring a little bit sweetness to this product platform.
Thank you, Siva. Jake?
Hi, very great presentation, and I do recognize the drawer also. Very compelling way to start. Question a little bit about customer segmentation. I definitely get it in the 45 plus, but demographically, where are you on pricing? How are you trying to differentiate and attract? What's sort of that element of the value prop?
Yeah, absolutely. So let's start with the demographic. 45 plus is the general umbrella, but we define these customers as health seekers. These are the women that are already going online and they're Googling something like vitamins for women 40 plus, vitamins for menopause, vitamins for healthy aging. Mm-hmm. So one, they're already engaged in health seeking behavior. Two, from the behavioral standpoint, this is a consumer who is already very ritualistic in their behaviors. They have their morning coffee, their afternoon tea. They go to Starbucks and Dunkin' Donuts to pick up those products, and they're actively seeking better for you formulations. So we've segmented the market that way. And then looking at the current behaviors, if we could look at the cost comparisons, Kylie, we can start with what Melissa is already taking. That's slide 31. So this is what our customer on average would take through dozens and dozens of interviews. We've heard this is the set, the multivitamin, magnesium, calcium, and then there is a hair, skin, and nail formulation. And that conservatively adds up to $64 a month. If we go to the next slide, Similarly, some of the popular recommendations and personalization formulas like Care Off are in the ballpark of 40 to 70 after the discounts, with some of the ingredients that might not be as well recognized like Radiola. And lastly, the next slide, we look at $45 a month for SHEVOLVE, but with the $1.50 a day, we're actually replacing that sweet treat that goes with the coffee or tea and the formulas that you're seeing on the left that are rarely delivered as part of one single product. So we're very competitively priced, yet we're delivering on that premium formulation. This is definitely a more affluent, health-seeking consumer.
Thank you very much. Well thought out.
Of course. Thank you. All right. Well, with that, I think we've covered all of the questions. We really appreciate you listening in and chatting about SHEVOLVE, and we would love to answer any additional questions offline as well.
Okay. Well, thank you, Dasha. Thank you, Team SHEVOLVE. And that brings us near the end of the morning. Before we go off to lunch, I want to introduce our dean, the Dean of Chicago booth, Madhav Rajan. And Madhav has been a huge supporter of entrepreneurship at Booth. He's also been a phenomenal dean of Booth. I think he's the best dean of any top business school, or maybe any business school. And so, Madhav, tell us what you'd like to tell us.
Hey everyone, can you see me now?
Yeah.
Thanks, Steve. Good afternoon to everyone. That was a super interesting presentation. I'm thrilled to be here today, thrilled to join you for the 25th anniversary of the New Venture Challenge Finals. And it's great that so many of you could join us virtually on this exciting day. I want to just give some thanks first. Of course, I want to thank Michael Polsky, Ed Kaplan for their longtime support of the Polsky Center and the New Venture Challenge. Also wanted to recognize Ratan Khosa for the gift that he gave to endow the first place prize for the NVC, which allows us to continue to attract top entrepreneurial talent to the school. And also wanted to thank those many of you Booth alumni who watched today's NVC presentations from all over the world. This truly is a special day, and we're thrilled to celebrate it with you. Of course, none of this would be possible without Ellen Rudnick and Steve Kaplan, who jointly created the center, the Polsky Center, launched it out of Chicago Booth now more than 20 years ago. They're responsible for launching the entrepreneurship curriculum, which is sort of an amazing collection of classes, great faculty, both on the tenure line and from outside who come in and teach this. Many of the Polsky Center's capstone programs, the experiential learning programs in entrepreneurship, private equity, venture capital, and ETA, it's just astonishing how much this curriculum has grown, and we owe a lot to Steve for that, and to Ellen. Also wanted to thank Steve, Ellen, and Mark Tebby for their efforts in teaching the New Venture Challenge class. Wanted to thank Starr Marcello, Waverly Deutsch, and Rob Gertner for teaching the college, global, and social NVC tracks as well. Finally, wanted to recognize Associate Vice President Jay Strankler, who's the head of Polsky, and Dan Sachs, who joined last year as the Executive Director for Polsky here at Booth. They've been fantastic, great leaders. And of course, want to thank the amazing Polsky staff for all their hard work through a very, very challenging year to make all of this happen. So my congratulations again, just to everybody at Polsky for this great milestone. So if I could just step back and say a little bit about NVC itself, the Ed Kaplan New Venture Challenge. This has undergone an amazing evolution. If you go back to its birth in 1996 to what it is today, which is just an incredibly successful startup launch program. So through its history, NVC has graduated nearly 370 startup companies still in operation today that have gone on to raise more than 1.2 billion in funding and more than 8.5 billion in exits. And this, of course, includes many, many household names, GrubHub, Braintree, Venmo, and Simple Mills among them. So the resources and support of Polsky and the participation in NVC has drawn huge interest from across the university. And the program continues to expand in scale and scope. NVC, of course, is now a global program, operates on 3 continents, and it's expanded from its origin. So we now have the John Edwardson Social New Venture Challenge, the College New Venture Challenge, and the Global New Venture Challenge, which supports our students in Chicago, London, and Hong Kong. And most recently, a couple of years ago, we added the Alumni New Venture Challenge. And finally, we have expanded the booth curriculum across campus. So one of the key things that many of you know I've been trying to do is to connect the booth more to the campus. But I think Polsky was sort of well ahead of its time in doing that. And we've continued to take the curriculum developed here at Booth, expanded it across campus. And our goal is to be the content provider for all things entrepreneurship and innovation across the university. So today we're working to teach faculty and scientists interested in commercializing their innovations to understand the fundamentals of entrepreneurship. So if I go back again to thinking about Chicago Booth, our mission, and I've said this often, is the same, right? We do the same couple of things we've always wanted to do. We want to create knowledge that has enduring impact, and we want to influence and educate current and future leaders. And in supporting this mission, it's crucial that we support the broader set of aspirations that today's students have compared to those 20 years ago. And our students have voted with their feet. As many of you might know, entrepreneurship is now the most popular concentration at Chicago Booth. And it continues to be incredibly popular, not just with the full-time students, but even if you speak to students in our executive MBA programs, more and more sort of taking on an entrepreneurship track is what they want to do. And that's why they choose to come to Booth. NVC, of course, has been a huge draw and a huge part of that. The New Venture Challenge is now recognized as the top-ranked university accelerator program in the US for launching startups, continues to support and also show the strength of entrepreneurship at Chicago Booth. So just wanted to say to all the alumni across the world watching, thank you for your support and for staying connected with the school. And thank you again for being here today at this very, very special day to celebrate the New Venture Challenge as we celebrate a quarter century of startup success. Steve?
Great. Thank you, Madhav. And now, everyone, it's time for lunch. We're going to reconvene at 12:55. We'll hear from Starr, Marcello, and then we will see 5 more teams this afternoon who are going to be, I think, every bit as good as the 7 you've already seen. So thanks again for being here this morning, and I'll look forward to seeing everyone back here at 12:55. Enjoy lunch.
And Chris, do we have music that goes with this?
Okay, why don't we turn off the music, Christopher, and get ready to go? Christopher, you there? There we go. Excellent. Good. Well, welcome back, everybody, from lunch. And we have another 5 great teams to go. But before we do, we're going to hear a few words from Starr Marcello. And Starr was the head of the Polsky Center at Booth for quite some time. And then she got promoted to be deputy dean for all of our MBAs. But she still runs the College New Venture Challenge, and I think has a warm spot for the in her heart for the New Venture Challenge. So Starr, take it away.
Thank you, Steve. And it's a pleasure to be here with all of you. And like you, I'm very excited for what the afternoon holds for us. And, you know, as Steve said, I am about a year into my new position in the dean's office, but prior to this served as executive director at Polsky. And over my 15 years at Polsky Center, had the honor of seeing hundreds, I think, of companies go through the various tracks of the NVC, including, of course, the traditional track we're watching today. Many of those founders have become good friends. So I know you're not tuning in today, though, to hear me talk. So I'm going to keep my remarks very short because, like all of you, I am here to see these pitches. So first, let me echo thanks to the NVC community, the sponsors, judges, Steve Kaplan, Mark Tebby, the fabulous coaches, the amazing Polsky Center team, and many more. Second, I need to say a few words to my MBA students, those who are presenting today and those who are watching on the live stream. Congratulations on getting to this point in the New Venture Challenge, but also this point in our academic year. You've been managing through an exceptionally challenging time. So many of us have had loved ones impacted by COVID over the past year and change, and you've dealt with this stress alongside pursuing your degree, and then for some of you, with building an entrepreneurial venture. That is not easy. So now we're in the last week of the academic year, and it's a natural time for reflection. So I want to share some reflections with you. And don't worry, Steve and Mark, I am going to keep it short. Why does the New Venture Challenge matter? What is it about? This platform the NVC provides matters a ton. It can be the driving force, the momentum, transforming startup ideas into reality. With everything that is happening in the world right now, this could have been a really natural time for our entrepreneurial students to take an easier path. This might have meant pursuing a traditional job or internship, or frankly, just managing within the status quo. But our students today who are presenting are not doing this. They are not accepting the status quo. They're pursuing a vision, they're solving a problem, creating value, identifying opportunities for change for the better, and leveraging all the things they're learning at Booth: finance, marketing, accounting, operations, economics, leadership, to build real businesses. And given everything the world has gone through this past year, I am thrilled that our entrepreneurial students remain dedicated to creating and building and dreaming and executing, and I'm so proud of the work that you're doing. So obviously, I'm a big champion of our founders, and I'm incredibly biased based on my years of work at the school. But I want to acknowledge that for a lot of people, including perhaps people on the live stream right now, entrepreneurship might not be the first thing you think of when you think of Chicago Booth. We've got a great reputation in other areas like finance and economics and a few Nobel Prizes. But entrepreneurship should be up there too. Look at the track record of this program over the past 25 years and the game-changing businesses and founders who've been through it. Look at the judges today who are involved. Read their bios. It's amazing. Look at the portfolio of NVC companies that's up on the website for Polsky Center. Listen to the new NVC podcast that the school created this year. The stories are truly incredible. And as Dean Rajan said earlier, entrepreneurship has become part of the integral fabric of the school and the student experience. As a concentration, entrepreneurship has been one of the top 5 concentrations at Booth for 20 years, since 2001. And it's been the most popular concentration since 2014. Why is this? First, whether our students decide to pursue a new venture during school or not, they share a desire to create impact. And our entrepreneurship classes and programs empower them to harness that desire, discover what they're capable of, and prove to themselves they can have a positive influence on the world. This gained confidence, the understanding of how to actualize an idea into a viable business, is something that benefits our students going into any career, traditional or entrepreneurial. Second, programs like New Venture Challenge and what we're all seeing today with the final pitches teach students how to be convincing, how to anticipate objections, how to use data and evidence to back up their claims, and importantly, how to understand why something may not succeed. It's a different kind of general management training. That's particularly important right now, when innovative thinking and having a growth mindset are critical not only for your success as an individual, but for bringing about meaningful change in a challenging world. So I'm just going to close with another thank you to the numerous University of Chicago alumni and friends of the university who've stepped up to support the NVC students, serving not only as judges, but as mentors, investors, sometimes customers, and just lending a friendly ear. NVC is truly a massive program, and it just gets better with age as our community grows. Whether you're an alum or you're not an alum, if you are watching today, you're part of our booth community and you're part of the network supporting our founders. And I thank you for that. I can't wait to see what the teams have in store for us this afternoon. No doubt a life-changing idea or two. So without further ado, let's continue with the presentations. Good luck, everyone.
Thank you very much, Starr. And I promise we will have a great afternoon. So with that, let's go ahead and put up do we have an introduction slide for the live stream we want to play? No? Okay, good. Then let's go ahead and get ready for our first team. Our first team this afternoon is going to be Phlaxis. So Josette, why don't we go ahead and get our cameras turned on, and let's go ahead and get our slides up. All right, we want to expand it to full screen for it. Nope, we can see your slides. There we go.
Okay.
There we go, Josette. All right. And so looks like we're ready. And Josette, are you ready too?
Yes.
Okay. So let's go ahead and move forward and introduce Team Phlaxis. Whenever you're ready, Josette.
All right. Hi, I'm Josette, and life is really hard, but food is really good. But what if food is what makes your life hard? 32 million Americans spend every meal worrying that the next bite might send them to the hospital, and every 3 minutes, one patient's fear comes true. Of these patients, 1.1 million are just children with peanut allergies that 80% of them will never outgrow. $25 billion are spent annually managing kids' food allergies, but the cost is a lot more than economic. Kids are bullied and feel alienated, and parents are prone to stress-induced ailments. The quality of life is reduced for not just the patient, but their whole community. No cure exists. We're changing that. We are Phlaxis, a research stage startup developing an inverse vaccine to cure peanut and other food allergies. Our work is based on the research of our CEO, Dr. Jeff Hubble, who has 75 existing patents in the medical space. So what is an inverse vaccine? Here, we're showing you a traditional vaccine. Upon injection, it triggers a primary response in the immune system such that upon re-exposure to the virus, the body can rapidly mount an immune response based on the memory of the first response. Now, in an inverse vaccine, the initial injection and response is the exact same. But upon re-exposure, instead of triggering a bigger reaction, it suppresses the harmful reaction to the harmless food allergen. The inverse vaccine is already undergoing clinical trials under Jeff's other startup, Anokion, which treats celiac disease and multiple sclerosis. Anokion is in clinical trials, meaning that the technology has been deemed safe enough for experimental human use. At Phlaxis, we decided to take this new and promising technology and apply it to food allergies. The inverse vaccine can be used to both prevent food allergies before they develop and treat existing food allergies. However, we've decided to food on curing existing food allergies for several reasons. Food allergies develop at a pretty young age, and going the preventive route would mean that we have to perform trials on young, healthy children. Additionally, patients are more willing to pay to solve a problem that already exists than to prevent one that may or may not develop. Our technology begins at a nominal value that increases with each scientific breakthrough we make. The first breakthrough is evidence that we can prevent food allergies before they develop. The second is evidence that we can treat allergies that have already developed. And the third is evidence that it's safe for human use. Because Enochion uses the exact same platform technology, any safety data from their human clinical trial can count double for Phlaxis. Currently, we're here. We have evidence that the inverse vaccine can prevent allergies before they develop, and we have preliminary evidence that it can treat food allergies that already exist. Here's our model. We gave mice 5 instances of sensitization to a food allergen and then 2 injections of our inverse vaccine before a food challenge, similar to how allergies are usually diagnosed. Here we have our results. This graph measures allergic reactions as a drop in core body temperature. You can see that the mice who were treated with our inverse vaccine in the green experienced very stable core body temperatures, while the mice with only the milk allergen on the right had a severe drop or severe allergic reaction. In these graphs, we're measuring negative cellular responses. You can see that across the board, mice treated with the inverse vaccine measured very low negative cellular responses, while mice with just the placebo had very high responses. Our technology is a platform technology, meaning that it's highly flexible and customizable between allergens. If you have an inverse vaccine for a peanut allergy, you can simply change the peanut allergen with a milk allergen to get an inverse vaccine for a milk allergy, and so on. We hope to offer flexibility in administration. We already know that we can offer subcutaneous administration, like an injection, and we are also hoping to provide sublingual administration, which lets us bypass the adverse gastrointestinal effects that most of our competitors who are taken orally face. Because our protection is lasting, it only requires 1 to 2 doses, kind of like the COVID vaccine that most of you probably have. This means that the treatment is a cure, not an ongoing burden that the patient has to do their entire life. Now I'll turn it to Hikaru to discuss the business side of our company.
Thank you, Joseph. I will talk about why Phlaxis is appealing as business. Among 6.6 million peanut allergy patients, we first aim at 1.1 million kids. We also estimate the target price at $7,000, considering that Aimmune, the main competitor already in the market, costs more than $10,000. So our market would be $7.7 billion. After expanding our target into adults, this can be even higher. Here is the market potential of our product. Among 1.1 million kids, we estimate 13% would choose our product, creating $1.0 billion in revenue for the first year. 13% is because 40% of them would choose FDA-approved treatment, and a third of them would choose our product among them. Increasing market penetration makes a CAGR of 10% until the year 5, and then our revenue would be stable until the patent expires. We use 75% gross margin, typical in the pharma industry. This is only for peanut allergy, so application to other allergens such as tree nuts further increase our revenue as a whole. Aimmune and DBV are main competitors. As for Aimmune, durability and efficacy are not perfect because patients have to take them every day and still need to avoid peanuts. So it only alleviates condition rather than cure disease. Regarding DBV, their application was rejected by FDA due to concerns over efficacy. So they had to conduct a new trial. Phlaxis is the only one solution that can cure peanut allergy with only a few doctor visits. This shows FDA approval process. We are in preclinical phase using laboratory mice, then moving on to human trial. Because we don't expect any revenue, our cash flow will be in negative, but this can quickly turn to be positive after the market entry. Here is our timeline. We expect moving on to human trial by 2025. Typically, barrier to enter into human trial is very high because safety must be proved. But we have a great advantage. The same technology is already in human trial by Annuity. We will also research on application into prevention and peanuts and treatment of other allergens such as tree nuts.
Because we're in the research stage, our team is a small group of 4 dedicated members who are mostly focused on the scientific side of operations. Our CEO, Dr. Jeff Hubble, is a biomaterials and immune engineering expert with 75 patents and 5 startups. Our Chief Technology Officer, Shijie Cao, is an expert in bioengineering and pharmaceutical sciences with over 20 publications. Our Chief Business Officer, Hikaru Uhara, is an MBA student with experience in management consulting and pharmaceuticals. I'm the Chief Design Officer. I'm an undergraduate student with experience in marketing, finance, and graphic design. Jeff's startup, Enochion, has already raised $78 million for the same platform technology in treating celiac disease and multiple sclerosis. Now he's ready to do it again for food allergies.
As a biotech startup, we will seek collaboration, acquisition, or IPO during or before phase 2. Regarding team, we are now small, but we will recruit business talents and build board of directors and advisory board before phase 2, before clinical trial. Peanut allergy treatment company is always appealing to investors. Aimmune was acquired by Nestle Health Science last year with a $2.6 billion investment. DBV got more than $140 million via IPO during phase 2. Immunomic Therapeutic, another allergic treatment company, agreed on worldwide license with Astellas Pharma with $300 million upfront payment, even though the company is still in phase 1.
We've currently secured $100,000 and are waiting to hear back from several other grants. Our ask is $2 million for ongoing studies in chemistry, manufacturing and controls, and production. In summary, our inverse vaccine technology is already undergoing clinical trials under Enochion. We plan to apply the inverse vaccine to a huge market of urgent and unmet need in food allergies. And because it's a platform technology, there's no limit to the expansion we can make between allergens. Thank you, and we're happy to take any questions now.
Great job, Josette and Team Phlaxis. Let's go ahead and have the rest of the team join you while we reset the clock. And with that, you have questions, so whenever you're ready.
Right. Cindy, go ahead.
Yeah, that was a great presentation. It's a very clear plan. I just would like a little elaboration on the proof of concept coming up. You talked about the initial proof of concept for your therapeutic as a treatment, and saying there's additional data that you're expecting to see in Q3. Could you just elaborate on that? And also just talk a little bit about the safety trial, which is testing the platform and another indication going on at Enochion, where you are with that.
Yeah, so I'll direct that first question to the trajectory of our research to Shijie Cao, and then our Enochion question to Jeff. Shijie, go ahead.
Hi, yeah, thanks for the question. Yeah, so we currently conduct some very preliminary studies on the therapeutic context, which we prove that first, it is safe on those mice that already have the food allergies. So our treatment compared to the free or unmodified antigens is safe to those mice which did not induce any anaphylactic responses on the mice, while the mice treated with the free antigen did experience the anaphylactic responses. And in the cellular level that we conducted on the mice, we observed that the mice have reduced T cell responses or suppressed those Th2 T cell responses that are related to the food allergy on those mice. And now we are just waiting for more data to demonstrate that we can reverse the food allergies by cure them and kind of completely remove, eliminate the anaphylactic responses when the mice got actual food challenge. So that's the next step we are doing in our mouse models.
Thank you. I can address the question on other clinical activities. So Enochion, another company that I started, is in phase 1 clinical studies with the technology platform, not the drug substance, but the technology platform in celiac disease therapeutic and multiple sclerosis therapeutic. So the learnings from that will be beneficial to the extent that those learnings are made public. The main benefit to the value proposition of Phlaxis is that when Enochion proves the platform is safe and effective in one indication, it reduces the risk that it won't be safe and effective in the food allergy indication. So that's the way that the Enochion understandings will be beneficial to the Phlaxis story.
Great, thank you.
Thank you. Mark, go ahead.
This would be awesome if it works for people with allergies. I'm just curious, it sounds like it's a novel approach using, in this case, an inverse vaccine. Have other companies in relatively recent history tried using this approach or vaccines for food allergies? And if so, I'm presuming they didn't make it out. What were their stumbling blocks?
Yeah, so I'll give a preliminary answer on this, and then maybe Jeff will want to expand on this. But this inverse vaccine technology is patented under Jeff, and we're the only ones to use it for food allergies. There's a very similar technology. The only place where this has been used outside of Phlaxis or Enochion is for diabetes, and that's separate. Jeff, would you like to expand on where this technology came from, origin?
Yeah, I can just answer with regard to inverse vaccines in general. So they're very new. There are no approved inverse vaccines. Takeda acquired one other form of an inverse vaccine in celiac disease about a year and a half ago. That's the full extent to which it's been developed. Actually, in clinical studies, Hikaru mentioned the Astellas study, ongoing study, that's in phase 2 with a DNA inverse vaccine. That's really as close as it comes. So the playing field is really pretty open for us to come in and take a dominant position.
Thank you. Cristobal, go ahead.
Thanks. So super interesting what you're doing. I just have a couple of questions. One is, how much money would it take for you to get past phase 3? And the other one is, in one of the competitors you mentioned, they seem to have had some revenue coming in when they had the global rights for the drug. Is that something you also think could happen to you?
So will you clarify on that second question, please? Sorry.
Yeah, there's I think for the one in the bottom, I don't remember the name of the drug. You say that during phase 2, they had their rights, global distribution rights, acquired by someone for 300 million. Is that something that could also happen to you, or is that something particular?
Okay, I see. Yeah, so we are also seeking acquisition or licensing. Hikaru, do you want to go through funding for phase 3 and also our goal as how to launch our product?
Okay, so Joseph, can you go to page 41? Okay, yes. So phase 1 is estimated to cost around $25 million. For the phase 2, that can cost more, somewhere between $30 to $60 million. And phase 3, this really depends on the size of clinical trial. That potentially this can cost me around $40 to $80 million. So in total, kind of $200 million. So and that is what it takes to get the FDA approval. And so also in terms of global license agreement, yes, of course. So we are first aiming at FDA approval process. This is in the United States. But usually during phase 2, pharmaceutical companies or biotech companies goes to see other markets like in Europe or in Japan. Then we of course had to do the separate clinical trial. So we will seek that opportunity usually after phase 2, and then these phases, we will find a collaboration who can work with other countries than US for the potential expansion. Jeff, do you have anything to add?
Only that, as to the question of revenues, that companies like this achieve revenue, really achieve liquidity well before phase 3. So usually post phase 1 with a demonstrative immunological proof of concept, or in phase 2 with a demonstrative immunological proof of concept, but not even necessarily with statistical efficacy. So we think that what happens in phase 3 is probably way down the road in a post-acquisition for us.
Thank you. Lonnie, go ahead.
Yes, thank you. And Jeff, thank you for clarifying a few points there. One of those being how the Enochion programs relate to this and give you general support and confidence, but actually the specific data doesn't necessarily apply, which leads to my question. When will you actually have the construct that would be declared the clinical candidate to enter the IND enabling studies?
Yeah,
we have that construct now. That construct is in preclinical evaluation, but we believe that the construct that we have in preclinical studies is the exact same molecule atom by atom as would be developed as the development candidate. It needs more mouse validation before we give it the denomination of a development candidate, but I think that the actual molecule is already there. And you're absolutely right that we have to do safety studies for this molecule, for this development candidate, independent. The Enochion story simply reduces our risk, but we still need to do all the work.
And will the company be utilizing some of the same contract organizations that Enochion is using? For instance, importantly, the CMC, who the
Absolutely.
CDMO will be?
Yeah, absolutely. So certain CMCs that I happen to know, have developed quite some domain knowledge and expertise with this class of molecules. So what it costs for them to do it a second time is considerably different from the time it takes for them to do it the first time. There's quite some efficiency there.
And finally, can you comment on an additional competitive situation, which could be an anti-IgE antibody in this space?
It's a good question. The anti-IgE antibodies like Xolair are showing some efficacy in food allergy. That's chronic treatment. So one is chronically treated with an anti-IgE like Xolair, and we're talking about something that could be curative. Not a one and done, but a 2 or 3 doses and done therapy. So we do believe that even with Xolair on the market, that there's plenty of room for a competition for a curative intervention.
Thank you.
Thank you. Mara, go ahead.
Hi, I'm wondering if you guys could tell us a little bit more about the license you have. It seems like there is a platform technology and some has been licensed to Enochion, some to you. Is it just for peanut for all food allergies? And if you could expand on that, it'd be great.
Yeah, the technology is licensed under Jeff. Jeff, do you want to go ahead and explain?
Sure, yeah. We have availability of the rights to all allergy. So we wouldn't even need to limit it at food allergy, but all allergy, not just an antigen specific, a type of food, but for all food allergy.
Thank you. Matt, go ahead.
Hey guys, sounds really interesting. But if you have the license for all allergies and your tag is food allergy solved, I mean, it feels like a $7 billion addressable market's way too low. Is that just the US or just children in the US? Wouldn't this be a global solution, or why isn't that TAM like significantly higher?
Yeah, Hikaru, go ahead.
Yes, so could you go to page 32? Yes, so this potential market is only for the United States and only for peanuts. So if expanding into other countries or expanding into other allergens such as tree nuts or shellfish, this can be even much higher. But at this moment, we are focusing on peanuts. So we wanted to show the estimated market for peanut allergy in the United States.
And the reason we wanted to show it like this is because each drug will be approved one at a time. So one food allergy at a time. And so we didn't want to overstep.
So what's the time frame on that addressable market? And then what's the total addressable market in like a 10-year time frame if you have all the IP?
Hikaru, do you want to go back to the timeline?
Yes, so could you go to? Yeah, yes, so this is a very long-term span. But patent lasts more than 10 years. So even though this takes a lot of time, this can be profitable after that.
Jim, go ahead, please.
I'm sorry.
Yeah, I think we're out of time.
We're out of time. Thank you. Sorry about that, Jim.
Hey, congrats on the Hero Medicine Award. Congratulations, Jeff.
Right. By the way, it's fair to say that the market isn't peanuts.
Right. That was very good. So thank you very much, Team Phlaxis. Judges, if we could go ahead and have you fill out evaluations. And while you're doing that, let's go ahead and put up the slide for the introduction to the next team. Okay, it looks like the judges are pretty much done with the feedback. Let's go and let's reset the clock for 10 minutes. Vina, if you're ready to share the slides, we're ready whenever you want to share them.
Sounds good.
There we go. And Whitney, are you ready?
Yeah, sounds good.
All right. Whenever you're ready, we're ready for you.
Great. Hey, everyone. And thank you for spending the day with us. I'm Whitney, and I'm the founder of Resette. And I have a quick stat to start us off. The average woman spends over $225,000 on beauty over the course of her lifetime. This means that she could take that money and pay full college tuition at an Ivy League school. But here's the kicker. What's worse is that she isn't even using 90% of the products. We surveyed over 1,200 women and talked one-on-one to 50. And here are some of their cabinets. So many products that they told us they just aren't using. The number one goal that they look for when shopping for beauty is to minimize steps. The beauty industry is telling us to wear more, but we want to wear less and benefit more. For skincare, women are using multiple serums, moisturizer, and sunscreen, and then they put on their makeup foundation. And this multi-step process is exactly what our customers told us that they're struggling with. And they're sick of spending time and money on a routine that they have trouble adopting. We take all of these steps and replace it with one multi-benefiting makeup product that has active levels of skincare. We're Resette, and we created a new category we call skinwear. We're the first to custom blend makeup and skincare into one easy step. And now Anna will walk through how it works.
Whitney. We're launching Reset with a direct-to-consumer subscription business model, solely through our website, reset.co. D2C gives us complete control over the end-to-end customer experience, from our customer acquisition efforts all the way through the checkout process and post-purchase relationship. The first step on our site is our skin quiz, where we match customers to their skincare formula. I've leveraged my computer science master's and web development background to build out our website and custom matching process. The quiz identifies their skincare concerns and cosmetic goals, which feeds our recommendation engine. And here you can see one of our customers, Kinsey, has found her custom formula and can set up a monthly subscription. We're continually iterating on both the website and our matching process to ensure we're providing a seamless, accurate, and simple user experience. And now that we've seen what Kinsey sees, I'll pass it over to Vina to talk about Kinsey's formula and the entire formulation process.
Reset's first product is Skinwear, a clean makeup product with dermatologist-approved skincare ingredients at active levels, meaning at concentrations high enough to penetrate the skin and effectively deliver benefit. We are launching with multiple SKUs to address different skin goals across an inclusive shade range. For example, to address Kinsey's skin goals, our recommendation engine selected a skinwear product for her that includes bisabolol to combat inflammation, niacinamide to increase dermocollagen, and hyaluronic acid for moisture, in addition to SPF 50 and pigment. We work with the contract manufacturer to bring skinwear to market. Our formula has already been tested for shelf life and stability, has FDA approval for the sunscreen in the product, and is produced at a facility that adheres to current good manufacturing practices to ensure quality control. I have been able to leverage my chemical engineering background throughout the formulation process and have been speaking weekly with our supplier to establish a strong relationship. To help us finalize our product, we have been working with a group of over 50 people for our first beta cohort. We intentionally recruited outside of our personal and professional networks to ensure that we would receive real and meaningful data. And our beta cohort directly represents our diverse target customer, spanning a wide range of skin tones, ages, ethnicities, identities, and geographies and climates as shown on the map. Our beta has provided comprehensive feedback weekly surrounding our user experience, brand messaging, and our skinwear product formula, feel, and packaging to inform our launch. These folks are quickly becoming our early brand advocates, and one member even described that our product is perfect for everyday wear. We're in the final stages of our beta this week and are ready to place our launch order. Now, Cicely is going to dive into our customer.
Thanks, Vina. In the $20 billion beauty industry, we focus in on our target customer representing a $215 million beachhead market. Kinsey is one of our first customers. She, 1, buys beauty products online for convenience, 2, is trending towards wearing less makeup coming out of COVID and would rather have fewer products that benefit more, and 3, likes to try new products, but is a light researcher. She doesn't visit a dermatologist and would rather get a quick recommendation from someone she follows and trusts on social or from a friend. Finally, our younger customer is discerning. They want transparency in the ingredient profile, and clean formulas are now table stakes. Our team has already built a waitlist of over 1,200 customers who are just like Kinsey. We met these customers through private Facebook communities that we're a part of. These posts here are examples of our target customers seeking a recommendation for a product like skinwear to simplify their routine. This is because beauty brands are telling them to add more to look their best. More makeup, more skincare, more steps. This leaves our customers feeling frustrated and excluded. They want to take back ownership of their beauty rituals, and they want a brand that supports that. They're shredding traditional beauty standards and expectations and are only keeping what truly benefits them physically and emotionally. Current competitors are not speaking to this need, and it would be antithetical to their brands to do so. We speak our customers' language like no one else. We leverage this knowledge to determine our brand and product positioning. While current competitors have added cleaner ingredients to their makeup products, Reset dials it up to active levels of effective skincare ingredients right in a single makeup product for a true makeup skincare hybrid. We also deliver on our promise of one step by differentiating on personalization. This has been largely untapped in makeup, and when utilized in skincare has proven highly beneficial to the customer. On the business side, personalization creates a defensible moat and barriers to entry for replication.
Thanks, Cicely. And here's a team that's ready to launch Reset. I have 10 years of experience in consumer marketing, and I built a direct-to-consumer e-commerce business to $2.5 million in ARR in its first 18 months. And I have industry expertise from working at personalized skincare startup Curology. Veena, my co-founder and our COO, has experience assembling supply chains for early stage consumer startups. Previously, she was a chemical engineer supporting daily manufacturing plant ops and led regulatory compliance. Alana, Anna, and Cicely support us with their deep experience in finance, tech, and strategy. In addition, we're advised by beauty industry experts from the likes of Estee Lauder, as well as a dermatologist who reviews our product formulation. So let's zoom into a few tactics of our intentional brand launch. Alongside our first beta customers, we start to gain momentum pre-launch by continuing to build our waitlist community through digital gamification. And with a $600,000 year one brand and marketing budget, we reach our targeted audience through awareness and trust building PR like Refinery 29 best of lists and through whitelisting creators, as well as lower funnel, social, and search. I know how to do this because I did it both at Red Bull and when I launched D2C startups. And I can utilize both my press contacts as well as my micro influencer network. And here's the traction we've already gained to validate our customer acquisition strategy. During our MVP, we got proof of product market fit through paid social and search. We found there's substantial search volume of our customers' problems and our message is resonating. We know our customers so well that they're watching our video ad, this one right here, longer, and they're more engaged to click through. We beat beauty industry benchmarks, meaning we pay less and our customers click through more. And our unit economics are strong. Our price of $39.50 is based on the willingness to pay from both our survey and our beta cohort, and it's priced competitively against direct competition. Our cost of goods and our customer acquisition cost here are actuals. And with our large target audience size that's available to us on paid channels, our customer acquisition is scalable. We get to an LTV over CAC of 4.17, modeled on a retention rate that's been checked against private beauty and personalized skincare comparables. And now I'll hand it over to Alana to talk about where we're going.
Thanks, Whitney. We are excited to grow Resette, and we're confident we can do so profitably. We expect top-line revenue to grow from $1 million in year one to over $118 million in year 6. This is with us capturing less than 1% of our addressable market as we build both our customer base and deepen our relationships with our existing customers by adding product line extensions such as a spot concealer with active level of skincare ingredients. We expect to earn a profit as early as year 3 as we realize the benefits of scale and expand distribution channels beyond direct to consumer. Long term, we see great potential for an exit with one of the top 7 beauty conglomerates at a revenue multiple of 4 to 8 based on recent market transactions. And we've made great progress on execution. We ran an MVP in January and finished our beta this week. In addition to building our website, product, and growing our waiting list, we've secured an attorney team with Ballard Starr. And we won first place in their nationwide pitch competition, awarding us over $16,000 in services. Most importantly, Veena and Whitney are committed to the business full-time upon graduation and have committed $40,000 in capital to jumpstart Resette. Now we're ready to place our first purchase order to launch Resette this October. This is where we'd like you to get involved. We are raising a $750,000 pre-seed to get our first 10,000 customers with over $1 million in revenue. This pre-seed round will give us 12 months of runway to dedicate towards marketing, product development, and operations. We hope you'll join us to build Resette because we believe women should never again put something on their skin that isn't benefiting them. Thank you so much for your time this afternoon. We're now open for questions.
Perfect timing, Team Reset. Let's give them in here to reset the clock. And you have questions, so whenever you're ready.
Great, thanks so much. Kaylin.
Hi there, great presentation. And I completely relate to the problem because that's what my cabinet looks like and my routine looks like. So nailed the problem. My question is how are you able to combine all of those things? Are all of those things still as effective when they're combined? Or do they have to be done in each step? Is there a reason why there are steps?
Thank you so much for your question. Veena, I'm gonna let you take this one.
Yeah, absolutely. So we work with dermatologists who review all of our product formulas to make sure that our 3 key product attributes are being met in our formulation. And that is active skincare with pigment and SPF. So it's really important that, we agree with you. We want to make sure that our product is both effective and that we're keeping in mind things like contraindications so that we ensure that we're providing for effective product.
And our chemist as well goes through stability testing to ensure that they stay at those active levels and do not degrade over time. Thank you. Linnea?
Hi there. Great presentation. And like Caitlin, my drawer looks like that. So one of the things that I question is, are you too much of a tweener? So there's definitely a lot of new brands coming up that deal with pigmented skin, women of color. There's some powerhouse, active ingredient skincare lines, and then also cosmetic lines. So I wonder just how you think about that in terms of how you kind of create your lane here. And then I would also love for you to comment on kind of marketing branding, because we've seen lesser ingredients get more attention through branding, influencers, et cetera. And so I'd love your thoughts on that as well.
Great, thanks so much, Linnea, for your question. So to start off, from a positioning perspective, at the end of the day, we are where our customer is and have spoken to many women and have already found that over 1,200, have joined our wait list because of their interest in this. At the end of the day, we are a fundamentally different message that we're going out to this target customer with. That is saying that you can wear less and still benefit more. And we've seen that message already resonates through our MVP, where we've been able to test that message on Facebook and Instagram and social channels. And so that is first and foremost how we set our positioning, is really being hyper-focused on the consumer and speaking their language. Additionally, great points in terms of marketing to the customer. A couple of the things that we'll utilize additionally for that is my experience. I do have 10 years of consumer marketing experience and have been able to get early stage D2C companies to some of those first thousands of customers through things like you mentioned, like micro influencers. I do want to note our customer isn't following big celebrity endorsers or skinfluencers that maybe a L'Oreal would be paying quite a bit in order to utilize for brand marketing. Our customers following smaller micro influencers or co-creators that they trust versus like some of those big name brands that are also higher ticket. But happy to follow up with even more about our marketing strategy later on.
Great, thank you.
Yeah, Cristobal?
So I'm pretty ignorant on this subject, right? Because my question is, what stops other cosmetic brands like Estee Lauder or L'Oreal doing the same thing? Would they be cannibalizing their own market, or what would they do?
Yeah, thank you for the question. So first of all, it would be antithetical to their brand to do so, because they already are coming out with a brand that's saying, put on 10 steps, wear as many products, add to your cart size. And so it really doesn't speak to how their brand currently speaks. As well, we found that personalization is somewhat difficult to replicate. So as an analog, Curology, when they came onto the market, it took 3 to 4 years for the next competitor to come on, because you're not just taking a product off the shelf and then reverse engineering it. Personalization adds that additional layer of barriers to entry. And then finally, could we go to, Vina, to slide 48? Mm-hmm. Yeah, so we found that the big 7 conglomerates are really acquisitive actually in this space, especially when it's a D2C or e-commerce play. Their bread and butter is retail. And so we find that anytime that someone is coming on the market with a good D2C play or an e-commerce play, that they tend to be acquisitive, adding those brands to their portfolio versus competing directly and taking on that supply chain risk. Thank you. Mar?
Hi, how are you? I'd like to know a little bit more about your unit economics. I saw on the deck that you're assuming some subscription to this product, and I'm curious what percentage of folks would actually subscribe to a product like this, based perhaps on your experience before. I know that Curology has a service, so it's more, amenable to subscription. And then on your CAC, $30 seems really low. But I also read on your document that you're comparing it to industry. So I'm curious, what assumptions are going into that.
Yeah, of course. So if we could go to slide 46. So we based our retention model specifically on private skincare and makeup analogs. And so this is the retention waterfall that they would be going through in order to get to our total LTV. One thing that we know about our customer is that they do like convenience. They're already shopping for beauty online. And so anything that adds convenience to them, would be supportive. And so that's the assumptions that's baked into retention. In terms of the CAC, that CAC is our actual. So our paid CAC is 37 with a blended CAC of around 29.85, I believe is the exact number. And so that is based on the actuals that we tested in the market by going out and spending customer acquisition and seeing how that would flow through from a click-through and conversion rate to our final product. And we have checked that against as well some private skincare makeup comparables. So it's in line with what we see in the market. And we do expect that CAC to grow as we continue to acquire new customers year over year. And it looks like you had a follow-up.
Yeah, that's my question. I mean, in my experience, initial CAC needs to be low because you can be very targeted, but as soon as you start increasing your number of customers, it goes up. And like I said, I think 30 is low at scale. So that was my observation, but maybe I have this wrong.
No, completely. And we do have it modeled in our full plan to go up as we scale. Thank you. Michael?
Hey, great presentation. It'd be great to understand a little bit more about kind of as you continue to scale and roll out more products, what does the R&D budget for your business look like over the next 3 to 5 years?
Great question. Let me pull that up. And we do significantly invest in R&D as we go forward. Could you go to slide 47 for me, please? I believe we have it on this one. So we have it bucketed here. So it's not specifically, I don't have the exact number in here, but it does fall within our ops budget. And we do expect to invest in R&D more heavily. I can get you that exact number after this presentation. I'm sorry, I don't have it right in front of me right now, but we do expect to invest in R&D specifically in certain years as we're looking to product line extensions or increasing SKU permutations. Van?
Actually, you touched upon the question I had. Your focus or your investment in your product line, as well as your pricing strategy right now, is essentially reducing steps and you're not having as many components. How are you thinking about balancing that?
Yeah, I'm glad you brought that up. So with our pricing, we surveyed over 1,200 women and looked at, what is their willingness to pay for this product, especially because it is reducing steps. And so therefore they're paying less whenever you think about all of the steps or the products that they instead would be paying for. So we looked at that willingness to pay as well as tested it with our beta cohort who we have weekly conversations with. And so it was a combination of that. So in addition to looking at what are the competitors priced out on the market and how can we be in line with that set, our customer purchases at the masstige belt of beauty. And so we wanted to make sure that we were also in line with that. But our customer is getting a cost savings from the fact that they don't have to go additionally buy skincare active serums as well as SPF separately from this product. Thank you.
Yeah, and in terms of our investment in our product line, upon the completion of this fundraising effort, we'll be immediately initializing our custom development process.
Great, thanks.
Do we have any other questions from the judges? It's a quiet judging group today. Not a lot of Oh, here we go.
Oh, perfect. Jay.
Yeah, my question was, I was looking at your financial models, like why is that growth? Like, the market is, if you go after it, it's quite huge, right? And you guys have seems like a great go-to-market strategy. Why are you guys projecting growth, which is, I would think that, what we have seen in some of these D2C companies growing like, 2x, 3x year over year. Is that just that you're trying to be capital efficient and not raising any money, or what was the thinking behind it?
Thank you for the question. Yes, we projected growth based on, we threw in some assumptions from some comparable analogs for our growth strategy. And so we really wanted to be intentional with looking at analogs that were early stage, specifically in the beauty market. Of course, there is the opportunity to scale faster if needed and grow faster as needed throughout the process. And we do look at, we turn a profit in year 3 after taking about 2.75 million. So anything additional beyond that would be purely towards scaling the business, and we could ramp up really fast at that point. Thank you. Jake. Sorry, Jake, I'm having trouble hearing you.
related question on your relatively modest ask of $750,000 to try to get the boulder moving on getting awareness for a new offering. That seems very light.
Thanks for that feedback. Yes, so we have modeled out a budget for customer acquisition, and the majority of this ask is going towards that budget to get us that 12 months of runway to really prove like we can gain customers, we can get our first 10,000 customers. At that point, we'd immediately go out and raise additional funds, but was really cognizant with how we built out the budget for that, having done that in the past for some early stage, but definitely appreciate that feedback and something that we'll consider. Thank you. Caitlin?
Yeah, so I think mine would be kind of similar of, I think there's opportunity for the top line to be higher too, and to go after it faster. As I think about it, I think the barriers to entry, I'm curious about how high the barriers to entry are of someone else being able to do this. And so because of that, I would try to seize the market a lot faster.
That's great feedback. Definitely something that we can take into consideration. We do believe some of the barriers to entry are around personalization, as I mentioned before, as well as really around brand. At the end of the day, we're speaking to this emotional friction that our customer is having. And so we want to make sure that we're capturing that and can definitely consider growing top line a lot faster. Laura.
You're on mute, Laura.
Yeah, the click didn't click.
No worries.
Great presentation, thank you. I mean, I have a lot of experience in the beauty category, much more with big enterprise global beauty brands. But I would like to echo that thought about trying to move faster. And the other thing that I'd like to just make a comment on is you've got a really great name, Resette. You know, post-pandemic, there's a lot that's going to be reset. Not sure your branding actually enables people to immediately see it's reset versus other pronunciations. So I'd push you a little bit on that. But even more substantially, I think that, you know, as you do more consumer research and you get more real time in the wild feedback from consumers, you may find that women are more apt to go back to their routines. And it's actually women who are in the younger demographic age range who are truly saying, hey, this last year, I completely changed my world upside down. And I'm not sure you've dug in enough, maybe you have, to really understand if you've got your target demographic right. So more than a comment than a question, but thank you again, nice presentation.
Thank you, Laura. And yes, the younger demographic is someone that is specifically within our target consumer, but it looks like we're out of time. So would be happy to follow up further on that later on. Thank you.
Thank you very much, Team Reset. Judges, if we could have you go ahead and fill out the score sheet. It's in the chat for you. And we will be putting up the introduction for the next team. But before we do that, we do tell our teams all the time to not be conservative. And it's been interesting. Several teams have been told that they're a little conservative in their numbers, and that's a great lesson for all of the teams. So let's go ahead and put up a next presentation introduction while the judges are doing their scoring. Looks like our judges are finishing scoring. Great. Let's go ahead and let our next team, Team PainNavigator, in. And as they're coming in, and Alonda, whenever you're ready, we can go ahead and show the slides. Okay, we can see your slides. They look great. And Kelly, and you and the team ready?
Yep, give me just one moment.
No problem.
All right, there we go.
Okay. All right. Next, we have Team PainNavigator. Whenever you're ready, Kelly.
Awesome. Thanks, Professor Tebby. Hi, everyone. We're PainNavigator, a holistic mobile app for chronic pain. I'm CEO Kelly McKay, and I'm joined here today by our Head of Business Development, Austin Bostock. And we're here to tell you about how we're making holistic pain management accessible and becoming the first prescription digital therapeutic for chronic pain. The problem we're solving is chronic pain, which is any pain that lasts longer than 3 months. Today, 126 million Americans struggle with chronic pain, and that number has continued to increase year after year. The current solutions for chronic pain are costly, temporary, and extremely addictive, as we all know with the opioid epidemic. Over 200 people die every single day from opioid-related drug overdoses. And the healthcare system's siloed, multi-doctor approach is increasing costs of care for these chronic pain patients. Today, a patient with chronic pain starts at their primary care physician, but after that, they're not being connected to the resources they need to treat all aspects of their chronic pain. So they bounce around in this vicious cycle of repeat hospital visits, doctor visits, surgery, and so on. This siloed treatment approach is costing $30,000 more per patient over 2 years. It's clear that the healthcare system needs a better approach for chronic pain. And that's why the CDC recommends what's known as the biopsychosocial approach for chronic pain. We deploy that interdisciplinary solution in our mobile app, so it's accessible for all. Our modules include exercise therapy, wellness strategies, medical education, and yoga. We just launched our 1-week trial on May 10th and already have over 100 active users using PainNavigator to self-manage their chronic pain. Our founders are experts in this biopsychosocial approach. They've been implementing it for years at their interdisciplinary practice. And they even went as far as to develop a 6-week outpatient rehabilitation program known as ProCamp that focused on the physical and emotional well-being of chronic pain patients in order to improve their functionality. ProCamp was a huge success. Notably, they saw a 52% reduction in pain and a 47% reduction in risk of opioid misuse of their patients. The only problem with ProCamp was that it was inaccessible. It required hours of on-site time during the work week, which just isn't feasible for many Americans. But the content and the structure were rated extremely high and serve as the foundation for PainNavigator. Our evidence-based approach leads us down the path of seeking FDA clearance as a prescription digital therapeutic. Our founders have enlisted this all-star team in order to bring PainNavigator to life. One of our founders is Dr. Ankur Dave, who is a double board certified pain management physician and anesthesiologist and current medical director of pain management at Amita Health, which is part of the Ascension Health System. Our other co-founder is Dr. Konstantinos Kostas, who is a fellowship-trained clinical health psychologist and current clinical director of health psychology at Amita Health. I'm CEO with previous digital health startup experience and a personal connection to the opioid epidemic. Our CTO is Priya Shah. She has over 10 years of product management experience and is also a full stack web developer. Austin Bostock is our head of business development. He's a current advisory manager at Pareto Intelligence with a proven track record in selling to healthcare. We also have 2 content experts and 2 business experts on our NVC team to round us out. I'll now pass it over to Austin to take us through our market overview and our financials.
Thanks, Kelly. Chronic pain costs over $635 billion per year in the United States, a combination of both the incremental healthcare costs directly from treating or managing the pain, as well as the lost wages and time away from work. Based on our research, PainNavigator can address about 240 billion of this total. This includes 150 billion of those healthcare costs from moderate levels of chronic pain, joint pain, and arthritis, as well as the lost productivity from those same patients. PainNavigator's end users will be patients with chronic pain, as Kelly mentioned, but who's going to pay for access to PainNavigator? Our targets are going to be ACOs and health insurance plans across the United States. Partnering with ACOs and insurance organizations provides a direct route to a much larger user base than our direct-to-consumer competitors. This market is also where we plan to leverage our team's clinical expertise and connections within the healthcare industry. Over the next 18 months, we plan to launch multiple clinical trials in this space to quickly gather the efficacy data needed to expand in the insurance market and to continue to prove what we've learned from the ProCamp in-person study. We're currently in conversations with the national health plan, Ascension, through Aina Health, which is a Chicago-based ACO, and we have a green light for a clinical trial beginning later this year. Some other industries and consumers that we've evaluated include employer groups, workers' compensation, as well as managed care. PainNavigator is going to be offered on a monthly subscription basis at $12.99 per user per month. And again, this will be paid for by the health insurance organizations. For example, a health plan with 30,000 enrollees, we can expect roughly 120,000 for recurring monthly revenue. So we've demonstrated the overall size of the market, but let's break down the cost of the traditional approach to a health insurer. A physician like our founders may recommend this treatment plan over the span of several months or a year, including physical therapy, a couple injections, psychotherapy, x-rays, MRIs, frequent check-ins, you get the picture. Integrating PainNavigator into this treatment plan can significantly reduce the cost of care, with a real cost savings on avoiding just a few or even just one of these common procedures. For this patient example, our hypothesis is that PainNavigator can reduce 3 physical therapy sessions, 1 injection, an MRI, some office visits, and psychological treatments sessions for almost $3,500 savings in just 6 months with the app. In addition to these cost savings, PainNavigator meets the patient where they are at in a more efficient, convenient, and less invasive treatment compared to these traditional approaches. Truly a solution for both the patient and the physician managing the chronic pain. We reduce pain, we save money, and we improve the convenience of the care. We know that providers are going to be a crucial piece of our marketing strategy and the rollout plan with PainNavigator. Through our market research and while setting up these initial clinical trials, we have seen firsthand how influential providers are in the decision-making process. From recommending a product or solution to insurance companies as a covered service, to prescribing and recommending to the patients themselves. In addition to these decision makers at the health plans, part of our primary market strategy is going to be targeted on the ground with the physician and physician assistants, those who are actually going to be prescribing the app. This isn't just in person at the physician's office either. We'll cover national conferences as well as quarterly physician council meetings, one of which our co-founder, Ankur Dave, came from just last week, where our founders learn from new technologies from other physicians and their colleagues. Once partnered with an insurance organization, we'll provide a comprehensive set of materials that allow a physician to start prescribing PainNavigator immediately. Over the next 18 months, we're going to be focused on FDA clearance, as Kelly mentioned, and other clinical trials, leading to revenue growth beginning in 2023. And we're expecting to grow to over 260,000 average monthly users by 2025. This timeline is also syncs up with the unique benefit cycle of the insurance industry. Many healthcare benefits are set months or even up to a year in advance, aligning with our anticipated FDA clearance and the conclusion of our initial clinical trials. We're excited to have the green light for a clinical trial with Aina Health here in Chicago starting later this year. And beginning in 2022, we'll leverage the success of clinical trials to start targeting and onboarding. Our target is 12 insurance organizations in 2023. I'll now pass it back to Kelly to walk us through a little bit more of PainNavigator's differentiation.
Thank you, Austin. The digital health app space is extremely exciting right now and receiving a lot of investment, especially as patients with chronic pain continue to increase. We're differentiated from our competitors in that we're the only full interdisciplinary approach that's also seeking clearance from the FDA as a prescription digital therapeutic. Our evidence-based program leads us to focus on providers prescribing our app to patients so they have a non-opioid solution that also serves as a patient's one-stop shop for chronic pain management. We're laser focused on the next 18 months of growth to meet our deadline of FDA clearance and full product launch by January 2023. We're here today with over 100 active members, and we'll spend the next couple months building out the rest of our product and content in time for that initial clinical trial that Austin mentioned. We'll then start our FDA clinical trials with a focus on our ability to reduce pain, improve function, and reduce opioid use. We're here today asking for $1.3 million to fuel that next 18 months of growth in order to build out our initial product, kick off our sales and marketing, and get that FDA clearance. Thank you so much for the time. We're PainNavigator. We're making holistic chronic pain management accessible. We'll now open it up for your questions.
Great job, PainNavigator. Thank you very much. Let's get him back here. Give us a second to reset the clock. All right, looks like you got questions. So whenever you're ready, Kelly.
Thanks so much. Mar?
Hi, Kelly. I read on your business plan that you did a trial starting in May with 100 people. If you could elaborate a little bit more on what you've learned on that trial, how sticky it is. I know you're trying to digitize this plan that took place in person, and if you've learned what happens when you digitize it, that would be helpful.
Perfect. Great question. Thanks, Mar. Dr. Dave, I'll have you speak to the results of our one-week trial.
That's a great question, Mar. We're going to head over to our MVP results slide. The MVP was invaluable in the lessons that we learned. The key points were, it's not enough to just have great content. It has to look and feel good too. Most of the users stated that the content was useful. We had a 98% positive feedback, but the suggestions were more geared toward graphic design, production, UX, UI, even though the users knew that this was a trial. So it's something that really pushes us forward for a fully functional app. 70% users used a mobile device, and most prefer to go at their own pace. This means that we will need a fully functional app with push notifications to optimize compliance and more robust data tracking, as Squarespace was a little limited there. We also know that there's potential in going through the healthcare team. So we started this trial with a social media campaign because we were trying to finalize our agreements with Amita and Shirley Ryan. During that time, we got about 34 members. Since then, which was about a week and a half, we more than doubled our membership once we started being able to go direct to providers, specifically doctors and physical therapists. So it does validate our hypothesis that going to the healthcare team is the way to go.
Cindy?
Yeah, thank you. I think it's a great approach, and I just want to know more about it. So how many patients have you actually treated, either directly, in the initial studies that were done a few years ago, in addition to the one you just mentioned right now? And are there any statistics around that in terms of, you quote the efficacy? I just wondered if these were statistically significant data or not.
Great question. Thank you. I'll break that one up. Dr. Costas, do you want to speak to your background and the efficacy you saw with ProCamp? And then Dr. Dave, I'll have you just highlight the efficacy of the one-week trial.
Yeah, absolutely. Thank you so much. So the efficacy from ProCamp was a 52% reduction of pain within 3 months, 47% reduction in opioid misuse, 40% reduction in pain disability, and a 60% reduction in depression scores. And those mirrored actually the national studies on interdisciplinary pain management programs.
I'm sorry to interrupt, but how many did you actually treat in your program?
Yeah, thank you. So I'm sorry. Yeah, so ProCamp was based on a model that was validated on over 3,000 patients in Dr. Davi and my clinic. Between September of 17 and January of 19, we graduated 3 rounds of 15 patients through ProCamp. When we saw the results and took into account the obstacles that got in the way of our expanding ProCamp, we immediately focused our efforts on developing PainNavigator.
So it's 45, if I did the math right?
A total of 15.
Just 15 in one camp?
Yes.
Okay, thanks.
And I'll just say with the one-week trial, we also saw a 52% reduction in pain, as well as a 20% increase in function.
And just a quick follow-up, because you're going to want to do clinical trials, which I think is the right approach. How many patients are you going to need to enroll there? And where would you go for the partnering physicians and so forth to get that many patients as efficiently as possible?
Absolutely. So we've actually started conversations, partnership conversations with Amita Health and also with Shirley Ryan as recent as this morning in order to get patients for our future clinical trials. We see we're doing an initial proof of concept trial with Amita that will have a lower count as it's just a proof of concept around 50 to 70. And then as we look at the precedent set in the space with other prescription digital therapeutics, we'll look for a randomized control trial in like the 200 or 300 count.
Right. Do you have particular practices, physician practices you want to go to? I mean, it seemed like Amita Health might be particularly targeting holistic approaches, which other physician practices might not.
Right. Great question. Dr. Dave, do you want to speak to that?
Yeah, so Amita's broken down into the employed medical group as well as the CIN, which is their clinically integrated network. We're approaching both because they do have different practice styles. We've also, approached University of Chicago, and we are approaching individual private practices as well, both on the primary care side as well as the pain management and the physical therapy side. So those three aspects.
Okay, thank you.
Thank you. Van?
Yeah, so I'd love to understand, why do you think some of your competitors have decided to go with a different go-to-market approach than you?
It's a great question and something that we're very familiar with. So the direct-to-consumer or direct-to-employer route is certainly easier. You don't have to go through the clinical trials and prove your success. However, it's so important to us because we're an evidence-based program that we want to go through those levels of clinical trials in order to prove our digitization of the approach and in order to be able to treat chronic pain patients and actually can be essentially a medical device. So our competitors have gone that way, just it's an easier way to market, but currently the employer market is actually getting saturated. They're stating that wellness managers are very overwhelmed with all of the digital health apps. So we believe in the timing now of going this different approach that's a little bit harder, but will allow us to see greater results and actually treat patients. Thank you. Lonnie?
So is this considered a class 2 medical device?
Alonda, our head of regulation, can answer that.
Sure. So this actually is not considered a class 2 medical device. This would fall under the categorization of a software as a medical device, as well as that prescription digital therapeutic that Kelly mentioned. And this is classified as a class 1 or category 1 under the software devices, which means it's very low risk, it's non-invasive, so it falls under that class.
Yeah, you'll be doing an extensive clinical trial program, it sounds like. Can you talk to the timeline for that and the overall budget for the clinical trial, and then what the FDA review timeline is once you submit results?
Absolutely. I'll kick this off. Alonda, if we can go to the analogs in prescription digital therapeutics, and then Alonda, you can speak to the FDA specific timeline. So there's a number of prescription digital therapeutics, either just entering the market or just have. And so they're really setting the precedent for this FDA clearance at around 16 to 18 months. So you can see here with some of the other prescription digital therapeutics in adjacent industries like IBS, they had 16-month trial, 18-month trial, and so forth. So that's what we'll expect and be planning for, which puts us around the January 2023 timeline. And Alonda, if you want to just go to your FDA process slide. Perfect.
Sure. So with the FDA process, it's kind of two-pronged. We'll first do a pre-submission meeting with the FDA, which takes about 75 to 90 days to get underway, and that will give us more information and more guidance from the FDA in terms of our submission. After the pre-submission meeting, we will submit an application as a de novo classification device, and that process can take up to 150 days, maybe a little bit more depending on extended timelines if needed.
I appreciate the thorough answer. Thank you.
Thank you. Jim Dugan?
Great job focusing on OUD. We have several companies in the area like Regroup and iPill and Pursue Care. And so I'm thinking about the holistic nature and stripping out all of the monthly visits. You know, I saw that on the slide with your 50% cost reduction in the six, for the 1 year. And so much of the integration with the psych treatment. So I wanted to know, do you have to take out all of them? What if it's once a quarter, or is that necessary for approval of being a digital therapeutic? And depending on that answer, could you, what do you think the results may be, or conjecture, or have you tried if it's a reduction in the psych treatments versus complete removal?
Absolutely. Great question. So that was just an example of the cost savings. We see our product as an adjacent to still a healthcare treatment plan. So we're not reducing all of them, but we are proving that for insurance companies and ACOs, what they really care about is the cost savings. And we're proving that we'll be able to reduce that because we include all of especially the psych treatments in our app. And the big differentiator here is many patients aren't getting the psych treatment in person that they need from their healthcare team. So that's why we're in the cost savings, we're replacing that because they may not have gotten that otherwise.
So for the modeling, you took it all out, but from an efficacy and an improvement, there may be some, not monthly, but quarterly per se is what you're saying. But it's not, but your dependency for digital therapeutic and that approval is not necessary, not required then to not include psych treatments, correct?
Absolutely. That's just for cost savings. That's right. Thank you. Koichiro?
Thank you. Great presentation. My question is, could you explain about your sales channel strategy and especially the relationship with the insurance? The reason I'm asking this is FDA approval medical treatment. Can they sell, if you use the insurance, can they sell those kind of product with their license?
Great, thank you. I'll pass that to Austin.
Yeah, thanks, Kelly. So we are specifically planning to work with the insurance organizations through the FDA. And the reason is we want it to be a prescription. We want it to be, prescribed by the provider, not something that the provider just recommends. Through our discussions in setting up clinical trials, we've heard consistently, and our two founders are our primary researcher as well, that physicians don't want to prescribe or put their name behind something that isn't FDA approved. And so FDA approval, and as Kelly mentioned earlier, we believe in this. We think that it is, it's clinically backed. We want to prove it through FDA so that we can partner with insurance organizations, and this can be backed by the healthcare system.
Let me clarify. Your sales channel is a physician or doctor, not insurance company. Who is recommending the product or service to the customer is not insurance.
Sure thing. The provider is, we think of the provider as a partner in this, as our channel of getting it through the distribution. They will also be in the conversation with our insurance organizations, because we've also heard that physicians are usually the ones that are in the room to the CMO of an insurance organization saying this should be in our stack of benefits. So it's a full, end-to-end partnership of, we need the insurance company to back it as well as the individual providers. The other thing is, the money is at the insurance organizations as well. Provider practices are a low margin business, and we are, specifically reducing the cost of care, which is burdened by the health insurance.
Thank you. And just to be mindful of time, Jai would take your question.
Sure. I think, thanks, great presentation. And we have been looking at this space. But, Hinge Health is kind of the elephant in the room, right? They raised like 400 or 405 million, probably going to raise or more. How do you compete with them, right? Because they have gone to all the self-insured employers, and they are going to all the national plans. So how do you get around them?
Absolutely. When we're intimately aware of Hinge Health, we differentiate ourselves in that people can get started right away with PainNavigator. So there's no wearable that they have to wait for. Also, Hinge Health is focusing on the physical aspects only, and our founders know intimately that pain management works best when you're able to focus on all the aspects of the chronic pain. So the health aspect, mental health aspects, pain management as well. So we believe that we're differentiated in that way. And we're also focused on different market entries. So we think that we'll be able to succeed in similarly being covered by insurance, but entering through the healthcare system. Thank you so much.
Thanks.
Great job, Team Navigator. We are out of time. So judges, if we could take a minute here and go ahead and complete your evaluation forms, Evaluation forms are in the chat. And as soon as we're done with these evaluation forms, we will be taking a 15-minute break. We will start promptly at 2:35. So if you guys can come back around 2:33 or so to make sure we're all settled for it. We will then be presenting our final two teams of this year's MVC, and then starts the arduous task of deliberating and figuring out the order for today's MVC. As we promised you, a very diverse group of teams, as you've seen. So with that, we will be taking a break for the next 15 minutes, and we will see everyone. Well, we'll reset the clock from 34. There we go. We will be taking a 15-minute break here, and we will see everyone just a few minutes before 2:35. Thank you very much.
Hey, Christopher, you can turn the music off. And we thank you. And Almendra and Leo, you can get set up. We'll start at 2:35, but another couple minutes, but you can get your slides in there if you want. Almendra and Leo, there. There we go. Okay, good. I'll give it a couple minutes and then we will be ready to go and have our last two teams, ML Tech and Vetted. It was premature turning the music off, I guess.
Okay, hello everyone. Before I start, could I get a thumbs up if everyone could hear me and see the slides?
We can.
Perfect. All right.
And the slides are good.
All right, well, let's begin. So hello everyone.
Well, wait, hold on. I told people 2:35 and we want to stick to it because some of our judges are just in time judges.
Perfect.
Right, here come a couple, so. Okay.
I'll spin in Marcus and Leo.
Okay, it's all yours now. ML Tech.
Okay, hello everyone, and thank you for giving us the time to present today. I'm Matthew Capella, and I'm part of the ML Tech team. Today, we'll tell you a little bit more how ML Tech is focused on providing a big solution to the cryptocurrency market, along with our progress thus far and future business plans. So while demand for the crypto market is through the roof, there are a lot of big challenges on both sides of the market. On one side, we have the issues that institutional investors or big firms that want to bring their capital to the market face on a regular basis, most of which being one, there's complicated access to those specific crypto markets. Then if they actually do have access to those markets, they face the issues of having unproven strategy and limited access to the top researchers. And then if they happen to get all three of those items taken care of, they also have low transparency of their specific strategy's success. On the other side of the coin, we have our researchers or traders, and they face namely limited access to capital. Then if they are able to secure capital, they have difficulty in interfacing with the specific exchanges. And on top of that, they face high trading fees. Ultimately, and even once they get over all three of those hurdles, they also face diminishing trade execution speed. So as everyone can see, there are quite a bit of challenges, and this is where we come in. Leo, our CEO and founder, will go over how our platform will solve those issues and make it a more seamless and profitable trading experience.
Thank you, Matthew. So ML Tech solves these problems for both researchers and institutional investors. For researchers, we provide standardized market data, pre-built signals, as well as AI-driven signal selection and validation framework. On the screenshot below, you can see an example of our unified API that allows experienced researcher to easily develop a trading strategy. So without ML Tech, the researcher journey can take months, if possible at all. With ML Tech, the researcher can go from idea to profitable trading strategy in the matter of days. On the other hand, institutional investors can get access to our vetted marketplace where they can make an informed investment decision. And as they deploy money into trading strategies, they get access to the portfolio performance and reporting capabilities. Now, let me tell you how our business model works. So ML Tech connects experienced researchers to our platform so they can focus on ideas while we abstract away all the complexities of crypto trading. On the other hand, institutional investors come to our vetted marketplace and choose the strategies that fits their investment needs the most. Then the strategies are deployed in trading venues using the capital of institutional investors. As the strategies generate returns, institutional investors get paid. ML Tech gets performance-based compensation that we share with the researcher. Meantime, investors able to track the performance of the strategies, and this gives additional visibility for them. So this aligns incentives for all the participants in the system. Now let me tell you about what we achieved so far. So we started MLTech full-time in spring 2020 and went live with the platform in November. Since then, we achieved tick-to-trade latency of under 1 millisecond, which is extremely competitive for crypto markets. Now we have 10 researchers, 5 million of capital committed, and our delta neutral strategies generate 60% annualized returns. I'll pass it now to Chloe to talk about our positioning and how we will continue growing.
Thank you, Leo. As you can see from this graph, our position in the market is determined by the two-dimensional criteria: high frequency versus low frequency trading and traditional versus crypto markets. There are few crowdsourcing platforms in the low frequency trading space, such as Numerai and QuantConnect in traditional markets. There's also Tune in crypto markets with low frequency. It's important to note that there are significant barriers and expertise needed for companies to move from low frequency to high frequency trading, but not vice versa. On the upper left, we have WorldQuant, which is a big player that leverages their infrastructure in traditional markets in HFT space. They can certainly start moving heavily into crypto trading, given the increasing interest in the space. But we have a unique first mover advantage, given us being crypto native and an early entrant in the market. Next, I'm going to touch upon on our market position. According to a recent filing from Coinbase, a crypto exchange that went IPO in 2021, we're estimating about $2 trillion in the crypto market, 1.1 trillion in the Bitcoin market, and over 63,000 institutional investors as potential target groups, such as crypto funds of funds, family offices, proprietary trading firms, and institutional asset managers. Next, I'm going to pass on to Matthew to talk about our go-to-market strategy.
Thank you, Chloe. So with that market segmentation in mind, our go-to-market strategy consists of 3 phases. Phase 1, which is concluding this month, consisted mainly of direct marketing within our network. And phase 1 resulted in having 10 researchers onboarded who've had their strategies back-tested for success. And on the institutional investor side, we have 5 institutional investors with $5 million worth of capital committed to being deployed within the coming months. Phase 2, which begins the second half of this year, will mostly consist of account-based marketing and optimizing a referral program, which has already shown some positive gains. On top of that, on the researcher side, we'll be partnering with academia to have the top 30 researchers by the end of the year. On the institutional investor side, we are adding a business development rep who will specifically focus on those fund of funds and family offices that Chloe previously mentioned, with the goal of having 15 institutional investors and $25 million worth of capital. Finally, phase 3, which begins in 2022, consists of ramping up that marketing as well as sponsoring events to achieve 100 researchers and 25 institutional investors with $250 million worth of deployed capital. Now, with that in mind, I'll hand it off to Yaelin to discuss our unit economics.
Thank you, Matthew. MLTech revenue are generated from the return on AUM. 60% of the AUM return will go to investors, and 40% will be split between MLTech and researchers. Per 1 million of AUM, we generate $240,000 for investors, $160,000 for MLTech. $60,000 will be paid as commission to researchers, $34,000 will be paid as total operating cost. We will have $66,000 as EBITDA, which is about 41% of margin. Our revenue is mainly driven by capital deployed. By the end of 2025, we are target to raise about 1 billion AUM, which will generate 140 million revenue and 58 million of EBITDA. We have a strong team to make this happen. Our CEO and founder, Leo, led digital asset trading at Blue Fire Capital, where he managed a team and grew crypto trading volume significantly. Our CTO and tech co-founder, Marcus, focused on infrastructure development. He was responsible for exchange connectivity and algorithms designed at Consolidated Trading. Ying, who used to work at Quantopian as VP of Finance, she supports back office operation. AD is in charge of building researcher trading tool, and John Weinsma used to work in SIG, focused on developing trading infrastructure. Our MVC team give us additional and well-rounded experience around product management, business development, finance, and marketing. Additionally, we also have a strong subject matter expert team to support us with the growth. For example, Danielle McKinsey, who used to be a VP of growth at Quantopian, provide insights in the area of products. Gap Kane has more than 20 years marketing experience, will support us with go-to-market strategy. Now I'll pass to Leo to talk about our ask.
Thank you, team. So over the next year, we will scale our platform and bring more users. So to get us there, we are raising 1.2 million, out of which more than $500,000 was already secured. So as you can see from the presentation, at ML Tech, we have experienced team, great market opportunity, and with very detailed execution plan. So we invite you to join, we invite you for you to come and join us to help us build the future of financial markets. Now I'll open it up for Q&A.
Great, nice job. And here the questions come.
Yeah, Matt, you're first.
Great, looks like the two Coinbase investors have their hands up. A couple of questions. So 2 questions, I'll do the first right now, which is, if I got this correctly, in essence, this is a marketplace for managers between researcher managers and institutional investors. Is that right?
So it's individual researchers or team of researchers and institutional investors.
So, but the researchers are just providing research, or they actually are doing trading?
So researchers provide ideas and they can develop algorithmic trading strategy on our marketplace. Then ML Tech actually monitors the strategy and makes sure that the strategy perform well. So institutional investors partner with ML Tech for investment management. They don't interact with the researcher directly.
Gotcha. As I'm still a little fuzzy, but, and then the second is in terms of your fee cut, it looks like you have a 40% carry between you and the researcher, is that right?
So I'll pass this question to Inc to talk about our performance-based compensation.
Thank you, Leo. Thank you so much for the question. That's a great question. Just to make it clear, our fee currently is structured as performance only. So the fee is based on pure performance. There's no management fee associated to that as well. And then on top of the performance fee only structure, we also have a high watermark provision built into the agreement with the investors.
Just to clarify though, that's 40%, right?
Yes, that's correct.
Okay, that's really high. And then the second is, how are you getting institutional investors trusting these researchers, given the lack of track records? And you're also going to be competing with the Panteras and the Polychains. And if I think about your competitive set, maybe some of it is trying to find research to help with trading, but a lot of family offices or other folks that we know in the space are looking to outsource all of that at the end of the day, or have it completely in-house. So are you, how do you compete with people like Pantera, Polychain, et cetera, in terms of building brand and building trust with some of these pools of capital?
So actually, institutional investors trust us and not the researchers because we are the investment manager. So we are the ones who have track record of different strategies, and they trust us as institutional partner. In terms of your question about the carry, I just want to answer. So we provide investors 35% annualized returns after fees. So there's actually a lot of investors who are ready to pay 40% performance compensation for these type of strategies.
Okay, I'd love to find these guys. Anyway,
and then in terms of how the competition, how we are staying ahead of the competition, I'll pass it to Marcus to talk about our differentiation on slide 26.
Thank you, Leo. Yeah, so in terms of tech differentiation,
what we have built at MLTech is a platform that's highly scalable and purely cloud-based in terms of our research infrastructure. And we're combining that with a trading infrastructure that can be used in collocation with exchanges. This combination of tech actually is leveraged in a way that can create a network effect with both our researchers and institutional investors. The more people actually join our platform, the better it is. And this actually creates also customer stickiness because of our technology leveraged by researchers and capital allocators. Both enjoy different aspects of our platform. The researchers enjoy a highly simplified research process, while capital allocators actually enjoy very high returns.
Okay, Chair, go ahead.
Thank you. Interesting model. My question is, why you can do the high frequency segment, and why others can't do it?
Yeah, so I'll pass it again to my technical co-founder, Marcus, to talk about our technology advantages.
Thank you. So that's a great question. So just to clarify one thing, we're not the only ones doing it. We're aware of other companies actually doing HFT in cryptocurrencies. Now, what's interesting about the current space is that cryptocurrency markets are actually highly inefficient, and there's space for multiple competitors to actually do HFT. And we are currently running HFT strategies that are making money as we speak. So from an HFT perspective, we know that we're at least as fast, if not faster than the competition.
Yeah, and just to reiterate on this, so there are players that trade their own capital or hedge funds that have HFT technology. There is no not a company that actually provides this technology to researchers worldwide. So this offers us much more scalability because we can reach researchers, and there are a lot of talent out there, and we can reach them with our platform. So they can research ideas from their home, and then they can execute on our HFT infrastructure. Laura?
I'm wondering, I think it might help me if you could give me one or two examples of use cases for researchers who are on the platform. So the promise here is, hey, you can develop strategies faster, you can deploy, your decisions and, how you want to invest faster. Okay, get that, but can give me a few down-to-earth, real practical use cases.
Yeah, so let's go to slide 21 and talk about the platform a little bit. So we provide researchers Unify API. So they get access to our standardized market data, which they cannot have on their own because they don't have these capabilities. Then they can actually, can you go on the next slide? Then they can develop the trading strategy. So what's interesting here, each cryptocurrency exchange has different APIs. So the way to connect to exchange is different. And if you're an individual researcher, you need to develop this API yourself. So in our case, you can just change the exchange name here, and then you can trade on multiple different exchanges. We take away all the complexity of crypto trading, so researcher can focus on the idea. Jim?
First of all, nice job. So when I consider this, it's like the holistic approach of getting QR and empowering that, almost democratizing and bringing the unified API. So some QR quantitative research can crank it out, you back test it, and then you enable. And I think there's nobility in that. And frankly, it's impressive. But in terms of the scale of that, I mean, many of them are going to be working inside of Millennium or, UBS or Citadel. So you may have an issue there just for bringing them out. And frankly, even some of the back tests they work on could be a competitive threat, or you're going to get jeopardy. I mean, if Millennium were to hear about somebody just moonlighting on that. So I'm concerned about it. That's a statement. But having said that, I think it's a great approach. And I think what you're doing is towards that. You want to empower the QR, which is like the brains behind the street in crypto. If that's the case, though, why not just keep it in-house? I mean, why are you going to give up, forget the VIG, if you will, but why do you need the capital base at all? Why isn't it just prop trading strategy? And then I have a follow-up, but why not just do that? Why even,
Yeah, great question. I can tell that you come from trading experience and you invested in the past in financial markets. So let's go to slide 28. And I just want to tell a little bit about who our researchers are. So some of our researcher profiles, they're independent crypto traders.
Right.
So they actually don't work in the trading firms like Millennium, but they're, let's say, in China, or we have researchers in Europe. And what they do, they develop strategy on their own. And now they want to bring to the next level.
Yeah, fair enough. And just for the sake of time. So that's great. There's an empowerment. They're out there and they're not at the big houses. So if you do that and they do it well, why then do you need that outside capital base? Aside from the fact that the 40% cut is, no management fee, 40% cut. I mean, why not just build it in that capacity? Your traction sounds good. And then related, what was your standard deviation during the recent volatility we had? Like, how did you guys perform in the back tests across the stage?
Yeah, so great question. So for why we didn't set up hedge fund and why we believe that such a model much more effective, I'll pass it to Ing.
Ing,
you're muted.
Thank you. Sorry about that. Thanks for the question. We actually believe that we are able to scale up much faster by doing the structure we're doing right now. And we do think there are quite a lot of demands out there that can help us fastly scale up the AUM and then generate revenue for us. So for example, there are investors out there looking for different strategies that they can't easily locate, and we help them provide them a variety of different strategies. And
what do they provide other than a brand and access to capital? What do they provide for 60% of what they take? You have the QR, you guys have the brilliance of it, and you're doing the portfolio management.
Right, and then they provide the capital because we don't.
I know right. Okay, they provide the capital, but down the road you may want to internalize it. Lastly, 120 million on $1 billion. That's 12%. That's 40%. You take 40%, which was 120 million. So that's a 30% annualized return, right? 12 and 18 is 30. So if it's a 30% annualized return at projection, is that really sustainable? I mean, we're in a great time for it, but how do you feel about that? Very few firms have been able to sustain that long term.
Right. We actually have been trading for the past 12 months and generate that over 60% of annualized return. And we understand that this market has been growing so fast and there's a lot of uncertainties there, but also there's going to be lots of potentials and opportunities out there. So we think for financial projection purposes, 40% is a achievable and reasonable number.
Thank you.
And this is returns that a lot of HFT firms make even in traditional markets. So this is not an unreasonable assumption. And for the performance question, how we performed, I want to go to slide 44 and show you the performance of one of our strategies. So this strategy is delta neutral, means it doesn't depend on the price of Ethereum or Bitcoin. This particular strategy traded Ethereum, and you can see Ethereum market moved about 50% down in the past 1 month. And our strategy is on the path to achieve about 70% return with Sharpe ratio of more than 12. Jay, you go next.
Yeah, a lot of questions have been asked that I was going to ask, but I think my main question was, what is stopping these QR, if you're not going to be the hedge fund, what is stopping them, first of all, getting poached by Jump or Citadel or one of those trading firms when they see that they're doing really well? And second, they can go raise the capital themselves. They'll use your platform with 10, 20 million to prove their strategy and then go raise the capital. And what is stopping them?
Yeah, so there is definitely customer stickiness. So they get used to our API. We also provide them very good trading fees. So if they trade by themselves, they have to pay about 0.5% to enter and exit the market. With us, they only pay a couple basis points in trading fees. And then the other thing is that we give access for large capital, and actually not many trading firms would trust researcher, especially if the researcher is outside of the United States, they wouldn't trust with the money. So we provide the reputation of institutional partner for institutional investors. Michael?
Quick question. How do you guys position yourselves to capital providers? Are you offering them returns or are you offering them access?
Yeah, so that's a great question. So for institutional investors, we provide best strategies out there. Plus, we provide them access to this unique talent and unique strategies. So we see some strategies from researchers that are not available in kind of traditional markets. So this is what attracts institutional investors: best returns and diversification. Thank you, everyone.
Okay, thank you very much. Good job, ML Tech. And judges, fill out your form for ML Tech. And we'll take a little time to do that. And we will finish up with vetted. And vetted, why don't you can share your screen and get set up. I think that's Seamus and Maya. Very good. Okay, so we'll take a minute and then we'll start. I'm seeing people are ready. So let's get the clock start in place. Music off, clock in place. Time and Maya and team, all yours.
Hi, everyone. I'm Maya, the co-founder and CEO of Vetted. I'm a 3-time Israeli-American entrepreneur specializing in marketing, sales, and fundraising. Vetted is an annual membership that empowers pet parents to take control of their pet's health, guiding them through pet parenthood at home, on the go, and in the vet's office. Meet Shore, my little one. Like me, 20 million urban millennials consider their pets as their starter children. We want to preserve their health and happiness, but it's not that easy. After my first vet visit with Shore, the vet said, I'll see you in 6 weeks. And in the meantime, just use some common sense. Well, my common sense and I found ourselves Googling late into the night about something erupting from Shore's face. And we all know what happens when we Google cancer. 3 hours out of my day at the vet and another $200 later, turns out the bump was just a pimple, but I had no way to calm myself down. We have spent over 200 hours speaking to urban millennial pet parents, and all of them are saying the same thing. First, they don't know what preventative care really means. The vet is defining it for them, and let's just say they don't have aligned incentives. Second, ongoing care is a hassle. It's hard for a pet parent to keep up. And last, when they do go to the vet, the pricing is always a wild card. Pet parents need someone to vet the process for them, someone who has their back.
Hi, everyone. I'm Ashley, the co-founder and CTO. For the past few years, I've worked as a tech lead and software engineer at a 24/7 SaaS company, and I'm proud to lead the product development and marketing team at Vetted. Meet Emily and her dog, Milo. Emily will do anything for Milo to have the best life possible, from human-grade dog food to the best toys from BarkBox and a hip doggy daycare. So when Emily sees an ad like this a few times on Instagram and hears about us at Doggy Daycare, she becomes a Vetted member for $49 a month. After signing up, we send Emily the Vetted health kit you see here to her home. The kit is made up of products that are crucial for good pet health and are easy for a pet parent to do on their own. For example, the flea and tick preventative. Emily can handle that. She doesn't have to buy it from her vet for a marked up price. With push notifications from the Vetted app, Emily doesn't need to worry about forgetting Milo's dose. If she has any questions, she can always chat with a vet professional in our mobile app. We're empowering pet parents to take care of their pet's health at home, but pets do need to see the vet in person twice a year, so we've got that covered too. Emily can take Milo to a vet of her choice and we'll reimburse her up to a capped amount. After the appointment, Emily can upload the exam records to Milo's health log in the Vetted app, so she has easy access to them at all times, especially while traveling or for emergencies. We're doing something that no one else is doing. With our holistic solution, we make our customers into the best pet parents they can be. These aren't just pretty slides. We've already launched our alpha, and it's currently on 10 pet parents' phones. Next, we have our paid beta launch this July. We've recruited 25 of 40 pet parents who are paying for this service. In September, we'll expand our customer base with our pilot of 200 paid pet parents. We'll test our assumptions, refine, and launch our aggressive marketing campaign. And finally, Vetted will be in Chicago this Thanksgiving. So, how are we going to acquire customers and scale? We're leveraging my experience as a social media strategist while implementing a marketing strategy already proven by our advisor who acquired hundreds of thousands of pet parents for his company. We are investing $820K in our first 18 months as we expand from Chicago to DC and New York. So let's take a closer look at how we'll spend this money. The first is paid social media. Our target customers live on Instagram and TikTok. One of our interns is an influencer for vet students, and we're having her create paid content for these platforms. Companies in this industry are mission-driven. They care about the health of the pet, and that's why they're excited to partner with us. We already secured 2 marketing partnerships, one with an at-home pet diagnostic company and another with a pet memorial provider who will promote us to their 1 million customers. Some other promising conversations we've had are with breeders, adoption centers, and luxury apartment buildings. This marketing strategy will cost us $41 per user, getting us 20,000 users in our first 18 months.
Hi, I'm Greg, and I'm the CFO. As an economic consultant, I evaluated the financials of IP and analyzed consumer willingness to pay for product features. So let's take a deeper look at Vetted's financials. Our target customer is currently spending upwards of $900 a year to acquire similar products and services from various vendors. Chicago's Vetted membership is only $588 annually, allowing us to secure significant profit while offering incredible value to our customers. There are 3 key costs associated with providing our membership: the products in our preventative health kit, the in-house vet professionals providing virtual vet assistance, and reimbursement for the covered vet services. Accounting for these costs leaves us with an annual contribution margin of $160, or 27% per membership. Vetted has a really promising financial future. Let's run through why. First, our attractive price point will generate massive user growth. We will offer pet parents an alternative to the status quo of 100 to 500% industry markups. Second, we will lower our costs significantly by securing discounts from product manufacturers and partnering with vet clinics. Third, as an app that has a continuous relationship with our pet parents, we'll earn additional revenue by cross-selling relevant products to our members. Lastly, based on industry research and conversations with our advisors, we found that similar membership models have high customer retention and relatively low customer acquisition costs, leading to our estimated LTV to CAC ratio of 10. Our financial projections forecast a significant jump in revenue as we expand to additional US cities and broaden our original markets. By 2025, we anticipate revenue of $180 million while capturing less than 2% of our target user base.
Hi, everyone. I'm Delaney, the Chief Strategy Officer. I've spent the last 5.5 years helping human healthcare payers, providers, and pharmaceutical companies develop direct-to-consumer products, and I'm eager to bring the best of human health to pet health. If you think $180 million in 5 years is ambitious, what you need to understand is that we're playing in a giant marketplace. In 2020, US pet parents spent $33 billion on pet wellness alone. Our target market of city-based millennial pet parents spent $14 billion on pet wellness. If we capture 10% of our target market, this will be a $1.4 billion business. The pet industry, it's hot right now, but the products on the market are siloed. Many companies have entered this space, but are not approaching the white space in the industry. Pet parents want to be guided and empowered to give their pets the very best care. If we look at our indirect competitors, we'll see that the alternatives fall into one of 4 categories. We have digital forward veterinary clinics, which offer similar plans, but are capital intensive and are not able to scale. Wellness plans just don't offer at-home care. 24/7 platforms still require ongoing care, and digital health logs are disconnected from pet care. We are doing something no one else is doing. Vetted creates a continuous relationship with pet parents, bringing them peace of mind with the highest quality care for their pets.
You've already met some of our awesome team members. We're all passionate pet parents that want guidance so we could do better. Our team also consists of Dr. Shelby Smiley, our Chief Veterinary Officer who joins us from private practice, Seamus, who managed operations overseeing warehousing and supply chains, Geva, an engineer who specializes in app development and machine learning, our 2 vet student interns, Lindsay and Keely, who will create digital content for pet parents, and we can't forget the 2 that have the most to gain but are the laziest, Chief Dog Officer Shore and Chief Cat Officer Nico. We also built an incredibly powerful advisory board made up of veterinarians, pet insurance board members, successful entrepreneurs, and tech experts. Vetted is more than an idea. We're a young company that will succeed. Ashley and I have invested $25,000 into the business, have secured multiple investments, and have fundraising meetings lined up next week. With your investment, we'll make faster progress. We're asking for $2 million to launch in 3 markets, acquire 20,000 active memberships, and generate $6 million in revenue. Join us in making vetted customers the best pet parents they can be. Thank you.
Okay, very good. Now time for questions.
Okay, great. So I see here, John.
Hi, very nice presentation. We have a handful of investments in the direct consumer pet space, and I think what you're mentioning in those cities is very attractive and it's a great market. I'm asking a question from a little bit of bias here. My wife is a veterinarian who does house calls, so I'm wondering, given that your solution is allowing the pet owners, advocating them taking a little bit more of the care into their own hands, and at least my experience in and around the space is that pet owners listen very, very carefully to what their veterinarians recommend. How are you going to align yourselves with the veterinarians to endorse your solution? Because very often I've found that once the veterinarians line up against something, it just does not work very well.
Yeah, it's a great question, and I'm really thankful you asked that. We did go to 30 clinics in Chicago and speak to veterinarians, and our board is made up mostly of veterinarians. So what we saw is that because we want to be in the market as fast as possible, the right approach right now is to go after pet parents and bring the demand. But we absolutely want to have an in-network vet system, and we're going to bring in the vets and have them partner with us because our clients will be willing to pay, and veterinarians will be able to practice at the top of their license and perform services that have high margins. So that's going to be our next move once we bring in the pet parents. Okay, I see here Brent Hill.
Hi, thank you. I just wanted to clarify something. Do you expect this to coexist with pet insurance or be a replacement for pet insurance, or what's that relationship?
I'm so happy you asked that because I'd like to go to the our slide showing how we got to this idea in the first place, the conceptual journey. So we actually started as building smart collars for pets because we thought that would solve preventative health. And then we said, okay, we might go into insurance. We analyzed the insurance industry and we actually saw a huge problem with the pet insurance industry. I don't know if you guys know this, only 2% of pet parents have insurance. And that's because it's modeled after car insurance, property insurance, and not after human insurance. And millennial pet parents are not okay with that definition because we see them as starter children. So if we could go to the vision slide quickly. So our actual vision here is to start with preventative care, expand the scope to primary care, and then we'd like to be the new version of insurance that compares pets to humans and not to cars. With that, I'll go to Kevin. Thank you.
Sorry, great presentation. I was going to ask about reimbursement, but I'm not your target audience because I had kids first and then got the dog. But I would love to be a customer of this if you'll have me. We have kind of a special breed of dog because of allergies. How do you figure out, what kit to put together for what types of breeds of dogs and then cats? And then there's so many variations here. How do you think about that?
Absolutely. I feel your pain. I have a French bulldog, so tons of allergies there. If we could go to the preventative health kit slide. So what you'll see is how we decided this kit was based on what veterinarians say are crucial for pets. Every single year, they have to have these services, and they're services that don't need to be done at the vet. So they can be done at the pet parent's home, And that's where the real margins are coming in. They're saving a lot of money by doing this. So over time, we're not at allergies yet, but once we go into primary care, we go into insurance, that starts to cover the allergies, and we feel like we have a perfect synergy once we build the core of the business. Okay, I see Matt with the cute little pup.
Yeah, hey, Button had a couple of questions here, so I thought I'd ask for her.
We love Button.
Yeah, there we go. So she said that she loves the idea, and the convenience of doing it at home plays to a lot of the millennial trends that are out there. If I think about options that we've used, I've got the 2 dogs and kind of basically empty nested. PetSmart has Banfield. Banfield has, you can do a monthly, membership, and all the fees are reduced, and they're usually right nearby, so it's pretty convenient. Probably don't have Rockstar Vets, but I was just kind of curious how you thought about that, given a lot of people I know do Banfield.
Yes, thank you for asking. So the difference with our service and the competitors is that nobody is empowering and guiding the pet parent. So it's not just going to the vet, it's when you come home, what do? You have questions when you're not at the vet, and you need those questions to be answered. So we're really guiding the pet parent. We looked at different industry. We think that the baby industry has a lot to do with us. And we thought about what would be something similar. So we saw it as the difference between an OBGYN that delivers the baby and a doula or a midwife that comes home with you after the hospital and goes through the process with you and supports you and is always there for questions. We are going to be the doula for pet parents. And with that, I see Laura's asking.
Hi there. Nice presentation. Thank you. I'm sorry that my cat Sammy is not making an appearance here since she did earlier today. But I was going to ask the insurance question that's already been asked and answered. Part of what Matt asked is partly my next question. It seems to me that you could be easily disintermediated by the pet retailers who are already offering services, and because they could just essentially, copy the pricing model and put the package together. So I'm curious about how you're thinking about that, and I'm also curious about how you make what you're offering, your service, your products, unique, proprietary, more moldable, so that you don't have a great idea that can just be more efficiently delivered through existing players that are already in market and have some loyalty.
Yes, great question. So actually, someone who's doing something similar to us are the digital forward veterinary clinics. If we could go to the competition slide. So they're doing this. You'll see they're raising a lot of money right now from VC firms like Bond Vet, Modern Vet. These are different vets that are trying to do this, but they own the vet clinics. So they're capital intensive and don't have the ability to scale. One of the reasons we've made an aggressive ask to ask for $2 million right now is because we're running with this as fast as humanly possible. We do have first mover advantage. With that, we have scalability. We're going to provide the highest level customer service to the pet parents, and we're going to build that trust with pet parents. That is the focus of our business model right now. And we've already, through our strong connections with our advisor board, we've already built a lot of relationships with suppliers that we've cemented. So we believe that that will be significant barriers to entry. Over time, they'll continue with data. We're going to have the data on pet parents that most insurance providers are begging for. Okay, I don't see any more questions, but I would love questions.
Any more questions? It appears not. So, okay, well, thank you, Maya and team. And it looks like we are at the end of a great day and a little bit early, which is great. And I will ask the judges now to rate Vetted now that you've seen all the teams. And also you have judges, you have one more thing to do. We're asking you to rank the teams, and that way, now that you've seen them all, we can figure out a little bit more where they all fit. If and see if that matches the overall ratings. I want to thank everyone, the judges for a long day and for just being here. The Polsky staff for doing a great job. This seems to have worked very, very well. The presenting teams for doing a great job. It's stressful and you all did a terrific job. And last, I want to thank the viewers for watching. And what I would like to say is that we have a People's Choice Award. So what we will do going forward on the live stream is there will be, I think, 1-minute pitches from the teams if you want to review what you've seen. And then we ask you to vote for the teams that you think should win. And there will be an award for the winning team from the viewers. And we'll see if that matches what the judges end up doing. So that's what we're going to do. And now the judges will be placed in a judging room. And we will be back at 5 p.m. with the winners. So join me again in thanking everybody. And we look forward to seeing what the outcome is. Thanks.
Short-term rentals are the next gold rush in real estate. But if you want to invest in an Airbnb, you have to research the market, get a place, furnish it, list it, talk to your guests, let them in if they lock themselves out, and then clean the place after they leave. Imagine doing all this repeatedly. It's hard and time-consuming, and our customers want turnkey short-term rental investments, not a second job. And that's where Andy's STR comes in. We do all of that for you. Just tell us your budget and we'll get you a fully managed property. We'll figure out what location, type of property, and characteristics will maximize your returns. We partner with the best brokers who specialize in investments to make sure the transaction runs smoothly. And then after we furnish your property in a layout that will get you the most money, we list it and manage the cleaning and repairs for you. We've been operating like this for 2 years and we're ready to take it to the next level.
An indexed annuity can be viewed as a personal pension plan in which the interest earned is linked to a stock market index. Today, over $800 billion of American household savings are held in indexed annuities. Managing the risk of these annuities is incredibly challenging for insurance companies and a barrier to entry into this fast-growing industry. At Annuity Risk, we help insurers manage this risk in 2 ways. First, we hedge this risk by transacting on behalf of the insurer. We remove many frictions in the hedging process and save them lots of money. Second, we provide tool sets for option valuation, financial reporting, and customer data analytics, and these tool sets are crucial for their risk management operations. So using our solutions, annuity providers will be able to reduce their hedging expenses, boost their profitability, launch new annuity products quickly, and gain market share. We are now beginning to roll out our services and solutions to insurers and are seeing a great demand and excellent product market fit.
A few years ago, I lost both my mom and my grandma. And with them, 230 years of precious family history that I'm just not going to be able to pass on to my kids because it's scattered all over social media, my phone gallery, some even in a shoebox. We know there's so many people and families that struggle with missed parts of their family history. And that's why we created StoryEasel, a digital memory and heritage preservation platform that allows users to capture their family memories in an easy and collaborative way. And then we bring it into the 21st century using our machine learning and AI capabilities. Simply upload a text, video, or audio into the platform, and we'll help you transform it into a meaningful life story. Why wait until it's too late to realize the treasure? Start now. Sign up on StoryEasel.
We are Aina. At Aina, we believe that everyone is unique. We have different body sizes, shapes, styles, and comforts. And at Aina, we want you to be you.
When it comes to clothing, finding the right fit can feel like a guessing game. After serving hundreds of shoppers, we understand that finding the right size can seem impossible. Returns are a hassle, and there's never enough time. And given the current environment, shoppers are seeking contact-free experiences. This is where Aina can help. Let us show you.
Through our mobile application, shoppers start off by creating an Aina account. We take the shopper's complete body measurements with our 3D measurement technology, which requires no manual input by the shopper. As shown here, the shopper simply turns in a circle, and within a matter of seconds, we've captured their head-to-toe measurements, and they're free to shop as they normally would. Once on the retailer's site, we've packaged our experience in a try-it-on button that's found on each product page. Here, there are two options, a first-person view and a third-person view. Shown here is the 1P view, allowing the shopper to virtually try on any item of clothing, giving the shopper more confidence in their purchasing decisions, and in turn, solving our retailers' problems.
America is facing a huge aging problem. By 2030, demand largely outweighs supply for caregiving. It's a big problem with a $280 billion market. You might have experienced this with your own parents and grandparents, and the challenges of ensuring they're safe, well, and socially connected. At Ping, we help solve this by making caregiving more efficient. We have a SaaS platform and wearable technology that together focus on safety, wellness, and social connection. We're uniquely tackling all three through B2B channels. Competitors like Life Alert only focus on safety, and Apple Watch is consumer-facing with features too hard for elders. We're getting great traction in our target segments, senior living, home care. We have 8 customers and over 300 units because they get a nice ROI for labor reduction. We have the team to scale and win, with entrepreneurs from Booth, strong advisors, and distributors from AARP and Seniors Bluebook. Thank you.
Hello, I'm Dasha Shore, registered dietitian and founder of SHEVOLVE. At SHEVOLVE, we make nutrition supplementation more convenient and more enjoyable. I started SHEVOLVE because as a nutrition expert, I couldn't get my own mom to take her vitamin and mineral supplements. And this is because nobody actually enjoys taking pills. And pills, capsules, and powdery supplement formats are simply stealing the joy away from self-care. So I decided to change that. I partnered with a food scientist and we created SHEVOLVE Daily Bites. Our bites start with a simple foundation of lentils, almonds, honey, and dates. Then we incorporate science-backed nutrients to support heart health, bone and muscle health, cognitive function, hair, skin, and nails, and some of the other functions in the body. And of course, our soft and chewy bites are delicious, and they fit perfectly with morning coffee, afternoon tea, or maybe as part of a happy hour with the girlfriends. So with that, I invite you to check out our daily bites at SHEVOLVEnutrition.com and join the SHEVOLVE community.
Food, it's one of those things in life. Unless you're one of the 32 million Americans who spends every appetizer, entree, and dessert worrying about their food allergy. But don't take it from me. How many people do you know with a peanut allergy or lactose intolerance? Maybe it's even you. A cure for food allergies would change the world. So at Phlaxis, we're doing exactly that. Our cure is an inverse vaccine invented and patented by our CEO, Dr. Jeff Hubble, who has 75 existing patents in the medical space. He's already raised $78 million for this inverse vaccine in treating multiple sclerosis and celiac disease. At Phlaxis, we're taking the exact same technology and adapting it to treat food allergies. We're giving people a chance to live without fear, anxiety, and restriction. Join us, and you'll play a role in changing the world for the better.
Hey there, welcome to my morning routine. I'm Whitney, founder and CEO of Resette. Come on in. We talked one-on-one to 50 women and surveyed over 1,200. And we keep hearing the same thing over and over again. They struggle to adopt a multi-step skincare routine. And on top of that, they're wearing less and less makeup coverage. And that behavior has only been accelerated by their time in COVID. The number one aspect that they told us they're looking for when shopping for beauty products is to simplify and minimize steps. So instead of having to put on hyaluronic acid serum and then moisturizer, SPF, and then your foundation, we created a new category we call skinwear. So we take those effective skincare ingredients and put it right in their buildable makeup coverage, and then we personalize it to their skin goals, types, and preferences. Instead of getting them to adopt a whole new routine, we tap into one they already have, their morning makeup regimen. We started Reset because we believe you should never be putting something on your skin that isn't benefiting you. I'm joined by my COO, Vina, and our team, Anna, Alana, and Cicely, who collectively have expertise in launching and growing consumer startups and iconic brands.
Hi, everyone. We're PainNavigator. PainNavigator is reinventing how chronic pain is managed in the healthcare system today. We're an evidence-based pain management app that provides a customized, holistic solution to help those struggling with chronic pain. Our program includes exercise therapy, yoga, health psychology, and pain management education, and is proven in reducing pain, risk of opioid misuse, and depression. Currently, 126 million Americans struggle with chronic pain, and the current solutions are invasive, temporary, or addictive. Healthcare systems and insurers need a better solution for their patients. That's why we're on a mission to be the leading non-opioid solution for chronic pain.
My name is Leo. I am co-founder and CEO of MLTech. So being a researcher and crypto investor myself, I've seen that there is a lot of talent out there developing crypto strategies, and they want to bring it to the next level, but they cannot find capital nor good infrastructure to actually execute their ideas. So me and my technical co-founder, Marcos, started MLTech to solve this problem.
The solution that we bring to the cryptocurrency market is two-sided, right? We're bringing a solution to cryptocurrency researchers on one side and to investors on the other side.
We allow researchers to monetize their ideas while we abstract away all the complexities of crypto trading. For institutional investors, they can access the highly profitable and unique trading strategies. Our experienced team is ready to bring this to the next level. Get in touch with us to help us build the future of financial markets.
Hi everyone, I'm Maya, pet mom to Shore. And I'm Ashley, pet mom to Nico. And we're the founders of Vetted, an annual membership that solves preventative health for pet parents. 20 million urban millennials consider their pets starter children. I know that I want to give Shore the best care, but I'm not a vet. I don't know what I'm doing, and it's so overwhelming. And when I do go to the vet for guidance, I never know what services Shore needs or what the bill is going to look like.
That's where Vetted comes in. We're here to make our customers into the best pet parents they can be. With the Vetted membership, we'll send you this kit to your home so you don't have to pay the high cost for flea and tick preventatives or fecal tests. With our app, you get push notification reminders to brush your dog's teeth or clean his ears, and you can chat with us day or night. When you do need to go to the vet, we reimburse you for a list of crucial services. Your pets deserve a vetted pet parent, and we'll help you be one.
Okay. Let's, Christopher, you can turn off the music. We are back. And Mark, you're going to share your screen. So there we go. Okay, good. So good afternoon. I am Steve Kaplan, the Neubauer Family Professor at Chicago Booth, and I'm here with Mark Tebbe, Professor of Entrepreneurship. And we are here with the winners of the 2021 Edward L. Kaplan New Venture Challenge. And thank you for your patience. You know, every year we tell you it was a tough deliberation. And this year, the fact that we're 24 minutes late tells you it really was a tough deliberation. And people who know me know I hate to be late. So it really was tough. And it was a great year. So before we announce the winners, though, we want to thank the judges again for giving a full day to watch and evaluate the teams over Zoom. They were here from 8 till now, 8 till 5:30. This is, they have many things to do. We also want to thank our sponsors again for supporting the NVC program, as well as the teams through sponsorships and everything they give. We do have a few unique prizes to award this evening, which I'm going to run through quickly. First, as a major component of the Rajan COSA, I think you need to push the slide ahead. Mark? There we are, there's Rajan. As a major component of Rajan COSA's Student Entrepreneurs Program at the Polsky Center, we have the Rajan L. COSA First Place Prize. And that means that the winner of the New Venture Challenge will win at least $180,000 today. And I can tell you the amount is a fair amount higher than that, but Rajan's is the big piece of that. We have, next slide, we have the Moonshot Prize, which will be awarded to a team whose unique technologies are catalyzing innovative solutions to global challenges. And special thanks to Colleen and David Kesenick and Doug Monison for supporting the teams. And I am also the Kesenick faculty director at Polsky, so the Kesenicks have been very generous to us. And before we go forward, we want to note we're usually making this announcement in front of a big crowd in the Harper Center, where we'd have thunderous applause for the teams we're about to announce. And so since we can't do that today, instead, we ask that you celebrate their success on social media. And you can follow the hashtag Chicago NVC on Twitter or the Polsky Center account on Instagram. And please retweet and repost to show your support. Send their websites to your networks, post on LinkedIn, and so on. The teams have worked really hard to get here, and this is how we can promote their achievements. So now we're going to read out the awards, and you should know that we started with about $1 million to allocate to 12 teams. At the end, we did a forced ranking of the teams where we asked all the judges to rank their top 3. Every one of the 12 teams got at least 1 vote. That is the first time that has ever happened where every team had some support. So it tells you how deep the teams were this year and how hard it was to decide. We started, as I said, with $1 million. By the time we were done, we had over 1.5 million. So we will be announcing prizes today of 1.51 million. And we're not done because there was $75,000 that has been allocated, but the people weren't there to give it. So that's gonna, that will tick it up close to 1.6 million. Then we have second look on Tuesday where we will get some additional investments. So this 1.5 is a placeholder. It's gonna go higher and we'll go at least above 1.6 and probably higher. So here we are. There's our social media. So please keep that in mind. Take a look at it. And now, Mark, I'm going to hand it to you.
Oh, I was going to let you do it because all right. No problem.
We can do it together, but go ahead. Go ahead.
So this year, while the judges were deliberating, we asked the non-finals judges to review the teams that they saw today. They come up with a People's Choice Award. And so we did do that. It's the first time we've ever done it. It is a $5,000 grant. It is not an investment. So the team is free to use it, whatever they may choose, whether that's investing in the business or throwing a party. It is for $5,000. And the team that won the People's Choice Award today is Vetted. So let's applause for Vetted. Put on, and then the Vetted team, I can't see when they're up there. So do we want to have them come up and do the thing? Since I'm sharing this, there they are celebrating.
There they are. Very good. Congratulations.
Congratulations. All right. Now we get to the core components of the NVC. We're going to start from the finalist stage. Again, as we've seen in the last few years of the NVC, every team that's made it to the finals will end up with an investment from the Polsky Center or from the individual investors collectively. And we will start with finalists and move our way up. And so let's go ahead and start. The finalists, each one of the finalist teams will be receiving $20,000 of an investment of a safe agreement. So it's not 20,000 divided by the teams, it's 20,000 per team. And so the first team that's going to be recognized as an NVC finalist is deetz. So applaud for deetz. You want to pull deetz up? There's Donald. Yeah. Congratulations. All right. Next, we will go with the next one is going to be Ping, Sean and crew.
Sean.
I had to put my jacket back on because Sean was so daptly dressed. I want to make sure I was keeping up. And then the third finalist will be SHEVOLVE. And again, receiving 20,000, Dasha and crew. Congratulations. All right, now we move into the numbered prizes. And I will, as Steve alluded, this was an extremely competitive discussion and very interesting and challenging because all the teams scored so well in the overall ranking, both in terms of judging throughout the day, as well as the analysis at the end. And so one thing I would like to point out on this is we have made mistakes in the past. We've had teams that were in the lower part of the prize pool that in retrospect, we should have put higher up because they turned out to be like the best in that MVC class cohort. So do not read it as a judgment or read it as the judge's perspective based on your presentation today. And keep at your business and keep pushing at it because we've had some that have come in very low places, 8th, 9th out of 8 or 9, and they've just catapulted to the top.
And that's why I should add, we invest in all of the teams because we don't want to make that mistake. Another thing we should add is some of this money comes from Polsky and will benefit, the investment will benefit the Polsky Center and the NVC. Some of the money comes from the judges. So that's why the numbers won't be round numbers and they'll be different. And we will tell you later which of the judges were the ones who gave you money. And some of the coaches, actually.
Correct. All right. So there is the bottom 3. I just realized I'm probably made a mistake on the slides because I believe the next slide is going to say 10th, but that won't be the case. So somehow I've made a mistake, I believe. Let me now see. Oh, 9th. I did have it right. Okay, good. So our 9th place team will be receiving $32,500 in investment in a safe agreement. And that team will be PainNavigator. And
thank you,
Kelly. Congratulations.
Thanks so much.
All right. Congratulations. Remember, follow it on, put it on Twitter and social media and everything else like that. Let's now go on to the 8th place team. The The 8th place team will be receiving an investment of $45,000. And that team is StoryEasel. Nisa, do the team want to come on camera?
Woohoo! Thank you, everybody. Thanks to our family for putting up with us. And shout out to my team who've become family now.
Congratulations, Nisa and team. All right, moving now to 7th place. The 7th place team will be receiving investment of $50,000. And that team was Annuity Risk. Gaurav, do you want to come forward with your team?
We're thrilled. We're really thrilled.
Congratulations. All right, next we have the 6th place team. 6th place team will be receiving $77,500. And that team is ML Tech. Leo, would you like to come up with your team?
Thank you, everyone.
Thank you very much, Leo. Congratulations. Now we move to the 5th place team. The 5th place, and this is where the money starts climbing. 5th place team will be receiving an investment of $95,000. And let's just be clear. 10 years ago in the MVC, we did not give away $95,000 in total. We only gave away $75,000 in that cohort. So we are in new record territory. 5th place team with $95,000 is Aina. There's team.
Thank you. Thank you.
Congratulations. All right, coming up now to 4th place team. The 4th place team will be receiving an investment of the aptly named $111,250, and that will be team Resette. Whitney, you and the team come forward, please.
Thank you, guys.
Congratulations. Moving into 3rd place team. The 3rd place team will be receiving $188,750, and the team receiving that will be Vetted. Maya, would you like to come up with your team? And so you get that, plus you get the People's Choice Award on top of that. So congratulations to the whole Vetted team.
Yeah.
Leaves us to our final 2. We will announce the 2nd place, and then we will announce the 1st place. We debated how to do this. We'll announce 2nd place team. And the 2nd place team will be receiving an investment of $258,750. And that is team Phlaxis. They also received the Moonshot Award that Professor Kaplan mentioned at the beginning.
And that's included. It's included in that amount.
It's included in this amount. So hi, Carol. Congratulations to you and the team.
Thank you. Thank you very much.
And so that, of course, leaves our 1st place team who will be receiving the Retired Coastal MVC 1st place prize, as well as investment beyond that, for a total of $601,250, which is a record amount invested in any team in NVC, and is more than twice as much as what MVC was handed out in its totality in 5 years ago. That $601,250 will be going to, obviously, Andy's STR. Sebastian, you and the crew want to come up?
Yeah. Wow. That I can't believe it. It's like, wow. It's really exciting.
That's amazing.
Congratulations, Sebastian. Not only did you use Andes to get yourself into booth, you now have a little excess gift coming from booth.
Yeah. Yeah. It is, I mean, seriously, with so many great teams, I'm really shocked. I wasn't expecting this. Like, thank you very much. Thanks everyone. Thanks everybody at Booth, at Polsky. Like, great shout out to John, Moose, Larry, Mike, everybody. Really, like, it's really impressive. And thanks everybody at our team. Seriously, like, I think I was surprised at how hard everybody worked here. I'm really, really humbled and super thankful. Thanks a lot.
Well, congrats.
CEO, by the way, just in case everyone was curious.
Congratulations to all of the teams for today. This has been by far the most competitive NVC we have ever held. It is just very, very amazing of what we've accomplished over the last 25 years. And to wrap that up, I will turn it back over to Professor Kaplan, the creator of the MVC process.
I can't add very much to that other than, again, we like Sebastian, we had no idea who was going to win because the teams were all so good and all so different. They were from high tech to low tech, from fintech to consumer. It was really diverse, and we are very grateful that we get to work with all of you. And we are looking forward to seeing all of you become very successful because, as we said, this is not a zero-sum game, or zero-sum on the dollars, right? There's a fixed amount of dollars, but all of you can win. All of you can be successful. And if history is any guide, many of you will be. So, I just want to congratulate everybody who presented. I want to congratulate the teams that didn't make the finals, who can also be successful. And I want to thank everybody who's involved, the coaches, the Polsky team, the mentors, the in-class judges, the finals judges, and Mark Tebby. So thank you. And
and Professor Kaplan for having seen it through all these. But for the students, let's remind you, school's not over yet. We have an optional class if you'd like to attend on Monday where we'll do the debrief about the MVC. We will be doing it remote. So we will be doing it in dual modality. And then also remember, something new we've added for the MVC at 25 as an experiment is we've had a number of in-class judges and also other interested Polsky, friends of Polsky, who've said they wanted to meet with the teams and talk about it. So we will be doing on Tuesday, second look for that as well. So you're not done yet. So don't get too excited about it because the numbers could have a very good chance of going up for you even more so. But it was a phenomenal MVC.
Indeed. So thanks, and we'll see you all soon.
Hey, Chris, you want to put the final slide up?
Thanks, Steve. Thanks, Mark.
Thanks, everyone. Okay. Chris, there we go.